Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Tuesday, July 21st. I'm Alexis Christoforous, along with my co-anchor, Brian Sazi. Stock futures staging a nice, strong rally this morning. Investors are betting that governments around the world will come to the rescue with stimulus packages to bail out economies ravaged by the pandemic. Let's take a look at U.S. futures here at the top. We've got Dow futures up 164 points, Nasdaq futures up 74, that seemingly unstoppable tech rally continuing there, and we have S&P futures up 22 points. We also have stocks in Europe rallying, and after weeks of skepticism, Republicans here in the U.S. are now showing clear support for a fifth stimulus bill, and European leaders have agreed to a groundbreaking stimulus package worth nearly $860 billion. Yahoo Finance's Tom Belger is in London this morning and has more on this historic package. So, Tom, break this down for us. And also, I see European stocks rallying nicely on this news.
Yeah, it's injected some real momentum into European markets today. Most European leading indices up more than 1% today. Stocks in Germany, Italy up more than 1.7%. But a lot of it have been priced in, it's worth saying, in recent days to an extent further back. The euro hit a new 4-month high against the dollar on the open, but it's actually flat right now. But as you say, worth emphasizing, this really is a major, major breakthrough after 5 days of talks due to only be a 2-day summit, but it dragged on. And this is really significant. Very few people last week had expected a deal by now. You had so-called frugal northern states in Europe dragging their heels over unconditional grants that have now been agreed to struggling southern states. They do have some conditions attached, I should say, but they drove a hard bargain, those frugal countries. They've got handouts themselves in exchange for supporting this package, and they have now caved in, though. That's the remarkable art of the deal, the EU showing once again its ability to compromise. Back to you.
But Tom, correct me if I'm wrong, this has to be divided amongst 27 states. So while it is a large amount of money, is it really going to have an impact on these economies? And do you think this is it, or could there be more stimulus down the pike?
Yeah, it's a really good question. Analysts reckon you're going to see countries getting grants worth around 1.6% of total European GDP. That's pretty significant in the first couple of years. Some of the worst hit countries like Italy and Spain, they could be in line for 2.5% to 3.5% of GDP. So not small numbers, decent stimulus, and the impact on keeping borrowing cheap is worth highlighting as well. You've seen a rally in sovereign debt today, and you've seen Italian bonds falling to their lowest level since early March this morning. Two things to also point out, though. Firstly, this does need sign-off by a lot of countries' parliaments, and it could be early next year before the cash reaches real economies. And secondly, some say that cash, given the scale of the crisis, the size of the continent, as you suggest, it could be a fraction, really, of what a lot of countries need to get out of the crisis, particularly if you're Greece, Italy, Spain, and given the unprecedented hit they're taking to output and tax revenues. As for the question of what we might see more in the future, you can see this a couple of ways. It's hard to look into a crystal ball, but it is genuinely historic. It's the first time countries have borrowed together or will borrow together on the markets to fund a joint stimulus package. And if you're an investor, that's quite an important precedent for the EU to be setting. It's the possibility that if the crisis drags on and the countries come under even more pressure to act again, the EU comes under more pressure again, that you might see more stimulus that I suppose is boosting stocks too. Some even see this as a baby step towards wider fiscal integration to accompany monetary union in the EU. That's why it's such a significant announcement and breakthrough. Just on the other hand, though, it's worth saying lastly, this has exposed for all to see the real divisions within the EU as much as its unity, and shown how reluctant a lot of countries are to part with this kind of cash. And it became a test in the end of the EU's ability to do anything, to step up during a major crisis, as much as it was about the recovery from this unprecedented recession. Alexis.
All right, Tom, thanks. That's certainly a fluid situation there. We'll have to see if the U.S. takes a page from the EU's book on stimulus, because it could be a big day here in the U.S. over talks of our possible stimulus plan. Treasury Secretary Steven Mnuchin and White House Chief of Staff Mark Meadows are heading to Capitol Hill, where they're going to sit down with Republican and Democratic leaders in the hopes of working out a deal. Our D.C. correspondent Jessica Smith is here now with the latest. So, Jess, I guess the good news here is they're actually sitting down and going to talk this thing out.
Right. Talking is at least better than not talking, but they are still pretty far apart. There's a lot of work to do, even within the Republican Party. Mnuchin and Meadows are meeting with Senate Republicans today to outline their proposal so far. And one of the things that they have to really convince these lawmakers on is the payroll tax cut that President Trump has been pushing. President Trump has said over and over again that he wants to see a payroll tax cut, but many Republicans on the Hill are not too excited about that idea. There's also some conflict within the party when it comes to money for testing and money for schools. So there's still a long way to go within the Republican Party before they can really start negotiating with Democratic lawmakers. And as you mentioned, Mnuchin and Meadows are also meeting with Democratic leaders this afternoon at 3:15.
Jess, what's the likelihood we get another round of direct checks to Americans? And then, of course, that $600 in unemployment benefits, that extra money being tacked on weekly, is going to expire next Friday. So those are two big areas that people want to see if there's going to be any movement on in this stimulus package.
Yeah, that's the really big question here. And we heard yesterday from the administration in the Oval Office that they want to change the enhanced unemployment benefits. They don't want people making more on unemployment than they would be making at work. But Democratic lawmakers want to extend those benefits. They say they're keeping millions of people out of poverty. So that is a huge point of contention in this debate. As far as the stimulus checks, we've heard from the president that he would like to see another round of stimulus payments, though he has been more talkative about the payroll tax cut and liability protections recently. We've also heard from Democratic lawmakers, again, they want to get it done. Republicans, not so sure, and there are some that aren't too happy about that idea. We've heard from Majority Leader Mitch McConnell that he would like to see those checks go to people who maybe make $40,000 or less. So there seems to be some sort of an agreement about stimulus checks of some sort, but it might be more targeted than it was last time around.
All right, lots on the table for sure. Jessica Smith, thanks.
All right, earnings season is rolling right along. Let's bring in Emily McCormick for some instant analysis. Emily, stunning to see Coca-Cola out this morning. Note organic revenue down 22%. And I think they also may have signaled some form of restructuring plan on the horizon.
Absolutely, Brian. So taking a look at that organic revenue, that more than 20% slide really caught my attention as well, especially when we think about the same quarter last year. Coca-Cola had posted an organic sales climb of 6%. We also saw adjusted revenue down 33% over last year, did exceed expectations on the bottom line. Another really key metric that we saw from this second quarter report was on unit case volume. That was down 16% in the quarter, a 3% rise in the same period last year. Now, Coca-Cola did say that its global unit case volume trends are improving sequentially from a 25% drop in April, a drop of 10% in June. For July so far, unit case volume has been down in the mid-single digits globally. Now, a key quote from this release was, quote, performance has been driven by improving trends in away from home channels, along with sustained elevated sales in at-home channels. The improvement in away from home trends during the quarter closely correlated easing of lockdowns, and the company expects this correlation to continue in the second half of 2020. While the company believes the second quarter will be the most severely impacted quarter of the year, given the ongoing uncertainty surrounding the coronavirus pandemic and levels of lockdown, the ultimate impact on full year 2020 results is unknown. So just a look at what Coca-Cola is saying here. It did give a dire assessment of the second quarter, did signal that things are tentatively improving, although that progress could backslide at any time. We have shares of Coca-Cola up just over 3% in pre-market trading. Brian and Alexis?
And Emily, I had to do a double take reading Lockheed Martin's earnings. This company came out, actually raised their full year guidance, and profit margins in most of their segments were up. You will not hear many stories like that this earnings season.
Definitely, Brian. We saw better than expected results top and bottom lines, actually record backlog as well for Lockheed Martin, that coming in at more than $150 billion. And as you mentioned, also raising guide for the full year on virtually every major financial metric. So we have full year net sales and full year adjusted EPS also on the rise now. And what the company said was that favorable contract award timing and strong performance more than offset the impacts of COVID-19 on the company's financial results in the first half of 2020. So Lockheed, as an aerospace giant, really averting the misery that commercial aircraft manufacturers and airlines have seen over the past several months. Also want to point out as well that this was the first earnings we saw with CEO Jim Teichlet on taking the helm, of course, from Marilyn Houston. So really a strong report to kick off his tenure and a strong second quarter for Lockheed Martin. Shares of Lockheed up just over 3% as well in early trading. Brian and Alexis.
All right,
thanks, Alex.
Sorry, Brian. Thanks a lot, Emily. All right, we are about to get a major update from Novavax. I'm taking a look at the stock here in the pre-market, up nicely, gaining about 2%. It's about to unveil the latest progress in a COVID-19 vaccine. I want to check in with Yahoo Finance's Anjali Kamlani for more on this. So Anjali, what are we expecting Novavax to say here this morning?
Thanks, Alexa. So really what we're looking at is hearing a little bit more about their technology. They're going to be presenting in front of the International Society for Vaccines and really giving a better, just description, I guess, of what they're working on when it comes to this coronavirus vaccine, as well as in general, the Novavax technology. That is something that they're already at phase 3 with their flu vaccine, and is sort of the reason why they were able to get so far ahead when it comes to this vaccine with the coronavirus. So while and just a note, we actually are expecting results for their phase 1 by the end of the month, and that's going to be really exciting. As we've already said, July is in fact a very exciting month for vaccines, and we've already got Moderna, Pfizer, and Oxford, and now we're waiting for Novavax to come out next week. And then we also know that they are starting phase 3 for Moderna this month. So really a very robust month for vaccines, if you will.
And also, we got a little bit of encouraging news, I think, today, right? A slower rise, at least, in daily coronavirus cases in the U.S. What are they attributing that to?
So it's a multitude of things, but in large part to do with some of the states that did in fact take some steps to curb their surges. And so while we have seen those rising cases going into the 70,000 mark per day, that 60,000 per day was really an anomaly considering the number of cases we've seen in the past couple of weeks. And so that is encouraging news. We definitely still have to keep watching it, obviously, because we've seen how this can be sort of an uneven trend, but hopefully it's good news and that we'll continue to see downward cases.
All right, Anjali Kamlani, thanks for that. And stay with us because coming up after the break, we're going to take a look at a hearing going on today before lawmakers regarding those big pharma companies working on a COVID-19 vaccine. Again, we have got markets rallying here on the hopes that another big stimulus package is on the way from the U.S. government. Stay with us. More to come after this. Congress will be taking a deeper look at vaccines today. That's because leaders from some of the big pharma giants working on them, including AstraZeneca, Moderna, and Johnson & Johnson, will go before a House committee for a hearing. With us now is Chris Meekins, healthcare analyst at Raymond James. Good morning, Chris. What are you expecting to hear from this hearing this morning?
I think what we're going to hear is really two different things. I think one, there'll be a lot of questions about how quickly you can get a vaccine, how effective they think the vaccines are going to be, and really lawmakers will want to push the companies to commit to getting a drug done in a specific period of time. I think at the same time, on the opposite side of the aisle, you're likely to hear Democrats really push companies on drug pricing and how much they're going to price these vaccines. You have two of the companies, Johnson & Johnson and AstraZeneca, that have said they don't plan to make any money off of these vaccines and not going to make a profit off of it. You have Merck that's kind of said, well, we're going to make sure people have access to it if they need it. And then two, Moderna and Pfizer have not really made a commitment to that yet. Pfizer being noteworthy in that it isn't accepting any federal money so far in the development of their vaccine. And according to Steve Seedhouse, who's on our team, a biotech analyst that's tracking a lot of the science behind the vaccines, he actually thinks Pfizer is probably the leading candidate so far from an effectiveness standpoint.
Chris, do you think the lawmakers could pin these executives down and say, hey, you know what? You're not going to make any money on these drugs, and we need them quick?
I mean, I think some lawmakers are going to try to do that, no question, especially to the companies that have not made that commitment yet. I think the companies that have made the commitment, J&J, AstraZeneca, will highlight the fact that they're going to do it basically at cost. They're partnering with the government. They're going to try to get it out as quickly as possible. I think one of the other areas where we could see some fireworks is around conversations about whether the companies will prioritize U.S. customers when it comes to vaccine, or whether they're going to give it equally to the world and try to disperse it more broadly. I think there could be some really interesting fireworks today.
Chris, of course, all this news that we're hearing is somewhat confusing, but also pretty promising. But how long do you think realistically it might be until we get a vaccine for the masses? I mean, some companies are saying as early as December, but others are saying that timeline is really too aggressive.
I think there's no question it's aggressive, but just like in the 1960s, we were in the space race, we're now in the vaccine race. And you really have an unprecedented level of commitment from private industry as well as from the government. And unlike some of the mistakes they made with testing where they didn't have the swabs, the government's actually making sure they have all the supplies they need. Just this morning, my colleague Larry Kirsch, who covers medical devices and supplies, highlighted the fact that Becton Dickinson said that they would have, commitments to make more than 330 million basically vaccine deliverable devices. So you think syringes, and majority of those will be ready by the end of the year for the US and Canada. And so we're seeing really a complete commitment across the entire supply chain of what's necessary. And I'm encouraged by that. Now, the science has to work, and we haven't really had any bad science yet. And traditionally vaccines, you get some bad science. But right now, I think all things point to a really aggressive timeline and unprecedented level of success. And I'm excited.
In your latest note, Chris, you call the outbreak out of control. Do you think the only thing that gets this under control is a change in the White House?
What I'll say is I think there are ways you can get it under control. If everyone were to wear a mask, we'd see dramatic improvements. If people were to limit gatherings of indoor spaces, we'd see progress. We already saw just today, one county in Texas, McAllen, that has the city of McAllen, Hidalgo County, say basically they're going back to a shutdown order. The county judge ordered that has the authority there. So I think we're going to see additional aggressive actions. But I think part of what you're seeing from the earlier report is that we're going to have these swells. There's going to be upticks, and then people are going to really clamp down a bit and be more responsible, and we'll start to see it go down. And then people will loosen up again, and we'll see it go back up. And that's just going to be the waves we're on until we reach the fall, or until we get a vaccine at least. And so I think there are steps that can be taken. Remember that we don't see a change in the White House till the end of January. And I think we as a country can make significant progress before that.
Oh, Chris, Jared Blicker here. I just wanted to follow up on that. What happens if there is a Democratic sweep, any scenario with the election that really just changes the outlook for dealing with the COVID crisis in 2021?
I think we're going to have seen significant progress before that, before you see a new Congress put in or a new president in the White House. And I think both parties are capable of dealing with this crisis. You have really excellent career staff. We saw progress from the president yesterday where he tweeted out that it's a patriotic thing to wear a mask. And I was very excited to see that hopefully we're moving past that mask debate at this point. So I think that we're going to see continued progress. I think if you see a Democrat sweep, there will be some good things, like the idea that there could be sustained fiscal stimulus. On the flip side, I think investors would be worried because tax rates are probably going to go up on corporations, which is less than ideal for equities.
Chris, before we let you go, I know all of the focus has been on a vaccine, but should we be focusing more on a treatment instead, do you think?
I don't know that I believe it needs to be an either or. I think we are in a position where we can do all of the above. I think we really should be investing heavily in point of care and immediate rapid diagnostic tests to the point that you can, equivalent of a pregnancy test where you deal with that, you use the test, you get an immediate result. I think that additionally on the therapy side, we've seen some progress. Hopefully we have some more. And on the vaccine side, I think there's been a lot of focus on vaccines. We could do a little more to focus on therapy and testing, but really I think we can do an all of the above approach.
All right, Chris Meekins of Raymond James, thanks so much. And we will be back right after this. Big news this morning coming out of Tapestry. That's the parent company of Coach Kate Spade and Stuart Weitzman. The CEO, which just took the helm in September, resigning for personal reasons. Want to check in with Jared Blickery for the latest on Tapestry, Jared, and how's the market reacting?
Looks like Tapestry is trading to the upside in the pre-market, nearly 3%. And so Jide Zeitlin is stepping down, former chairman and CEO, or soon to be former chairman and CEO. And in his place, we have Joanne Crève-Wasserat, hope I got that right. As CFO, she is going to be the new interim CEO. And also they released some financial results, kind of pre-release here. Fourth quarter results exceeded internal expectations from a top and bottom line perspective. And they're also saying they ended the fiscal year with a significant cash balance of about $1.4 billion. And one more thing, they ended the year with gross margin expanding on a year-over-year basis as well.
So I want to bring Brian Sozzi in here. Brian, I know you watch Tapestry pretty closely. What do you make of Zeitlin stepping down and also this interim CEO?
I can't say that I'm surprised, having talked to G-Day in a good number of times in the past. I think he has a lot on his plate. But the new interim CEO, Joanne, she was the former CFO and COO at Abercrombie & Fitch. She's an extremely strong executive with a strong numbers background at a time for a company that is in the midst of a restructuring. So a good person to have in this business, leading the business. Also, too, the new CFO has been at the company for a little over 20 years, and she is no joke as well. Phenomenal person with numbers experience. I think you do have the right team leading the company right now.
All right, but Tapestry clearly in transition mode. Wall Street, at least, agreeing with the changes that are happening there. All right, want to get a look at other stocks moving today. IBM, one of our trending tickers on yahoofinance.com, Jared, revenue beat estimates because of the cloud, right? Up 30% there, I believe.
Yes, thank good for the cloud. Definitely a COVID story here. Second quarter revenue beat coming in at $18.12 billion, but it was down 5% year over year. I think that makes it 28 of the last 30 quarters seeing revenue declines. But the new CEO really building up that segment. That revenue was up 30% to $6.3 billion. It did beat on most of the revenue metrics, but just looking at the stock right now, it's up 4.7%. In the pre-market, and it is the Dow leader right now.
All right, and I want to get to the parent company of Men's Wearhouse. Layoffs coming here, store closures. I would imagine this is partly a pandemic-related story as well, Jared.
Yeah, it's just one of these other retail names getting decimated. Taylor Brands are cutting jobs by 20%, and they're closing up to 500 stores. And also their CFO, Calandra, is resigning. And in the place, we have a chief restructuring officer who's also the CFO. That's Holly Etlin. She's going to come in and try to make some changes here, but they're going to be very expensive.
That they will. All right, Jared, thank you. The opening bell coming up next. Welcome back. We have got a rally in futures as we await the opening bell at the New York Stock Exchange. New trading day about to start. And we had a triple-digit gain for the Dow in the futures. Nasdaq on pace again for a possible record because of that huge rally we've been seeing in tech. The Dow starting the day up about 190 points. And here are the headlines making the first trade front page. The Senate Banking Committee could give President Trump a big win today. Lawmakers are expected to approve Trump's controversial pick, Judy Shelton, to join the Federal Reserve's Board of Governors. Shelton is a proponent of tying the value of the dollar to gold and has said the Fed's power is, quote, quite unhealthy. You can expect that vote to happen at around 2 p.m. Eastern today and then go to the full Senate for a vote. President Trump says he plans to send federal troops to Chicago, New York, and Philadelphia, all of which are controlled by Democrats. He claims violence in those cities is out of control and that something needs to be done. The president is already being harshly criticized for sending federal agents to Portland, Oregon, where they have been detaining protesters. And some players from the San Francisco Giants kneeled during yesterday's national anthem ahead of a spring training game. The players not only had support from fellow players and staff, but also from Major League Baseball. The league's Twitter account replied to critics by saying supporting human rights is not political. All right, let's get to the market action. I can tell you right out of the gate here, the Nasdaq at a record high. Let's welcome David Nelson, Chief Strategist at Bell Point, to the program. Of course, you've got Jared Blickery with us and Brian Sozzi. Good morning, David. I'm going to start with this incredible rally we continue to see in tech. There doesn't seem to be anything that can stop these big tech names. I'm talking particularly about the FANGs. What's your take on them?
I don't think we should be surprised by that. All along, it was really large cap secular growth that drove the rally, largely because in many ways they had the best balance sheets. And in some ways, some companies like Netflix, for example, could easily sustain the pandemic because their business model even benefits from it. So we've been hiding out in those names. But I would agree, some of these names, certainly in the cloud space, they're literally in the stratosphere. We're not counting eyeballs just yet, but you've got a lot of names out there like a Twilio trading at 1,000 PE. You have a company like Zoom, 91 times sales. These are stratospheric numbers. And I think as the economy starts to unfold and as we go back to work, slowly but surely, people will start to move down the valuation chain and start to move more into cyclical stocks.
David, there's a note making the rounds this morning from RBC, noting that, I guess to your point, valuations are frightening. That's their words. Is it time to just sell? I look at some of these tech stocks, and they're trading as if GDP growth next year is going to be 30-40% in the US, which clearly that's not going to happen.
Yeah, it's hard to explain. And what I've had to do as a portfolio manager is really run a barbell strategy where I have some of those names to shore up one side of it, the growth side. But on the other side of it, I've got enough value to kick in as the pandemic, as we deal with the pandemic, as those numbers will subside. And actually, there's some good news on that because we are seeing some peaking in this second wave at this point. But as that happens, I think people are going to have to move into other industries, essential businesses like industrials. I don't care whether you're buying your goods from Amazon or from Walmart. Somebody's got to make it, somebody's got to ship it, and somebody's got to manufacture it. So I think there's room for everything. And frankly, right now, I think you're better off running a more balanced portfolio than trying to jam it all into tech.
David, you wrote in your note that there is this battle, you call it, between cyclical and secular growth right now. Who's winning the battle?
Secular growth is winning right now. You have the Nasdaq at an all-time high, and for a lot of us out here, maybe we're premature on some of these names. But I look at companies like Lockheed Martin. This is an industrial trades at a reasonable valuation. The last time I looked, Alexis, every corner of the planet is a geopolitical hotspot. I doubt defense spending is going to cut back, regardless of who's president.
David, stimulus top of mind for these markets right now. And the way I see the setup, and really, tell me if I'm wrong, potential disappointment. We're looking up, that gets extended, but at $300 instead of $600. Isn't the economy set up for a major disappointment off of that plan?
Yeah, maybe we pushed too far at this point, but maybe stocks are also sending a message. Stocks are a forward-looking mechanism, and we're looking backwards. And obviously, I think we can look back and safely say that April was the economic bottom. And right now, you get about $160 number in the S&P for next year. Stocks may be sending a message that we're going to get back to work sooner than we think. Last time I looked, the mortality rate on this disease is less than 1%. We're starting to see some peaking at this point. Last week, testing was up 14%, yet the positive rate was actually down 0.5%. So maybe we're starting to peak on this. One way or the other, I don't care if there's a fiscal stimulus, a monetary stimulus, the country has to go back to work because we cannot sustain this on fiscal and monetary policy alone.
Hey, David. Great to see you. I just want to ask you about the 10-year because it is sitting at 61 basis points, and we're talking about valuation of stocks. Stocks are at elevated valuations, at least the ones that are leading those big cap names, but relative to long-term rates, not necessarily so. How does that fit into your equation?
You're hitting on a key point because the first part of securities analysis starts with the risk-free rate. And when the risk-free rate is effectively zero, you can start to drive multiples much, much higher. You could even have an S&P trading at 2 times historic multiples with a risk-free rate at zero. That explains a lot of what we're seeing. There is no alternative. Where are you going to go? Where are you going to put your money? You're making 1.94% in the S&P just in dividends. Why would I want to sit in a 10-year treasury at 61 basis points?
Hey guys, I'd love to get Jared, you to jump in here if you want your opinion on gold, because it's up another 1.25% right now, above $1,800 an ounce. Why do you think we continue to see gold edge up? I think it's at its highest level since 2011 right now. I mean, and we continue to see that at the same time that we see the market rallying. Who are these investors who are jumping into gold as a hedge?
Yeah, we're kind of doing risk on and risk off at the same time. I'm sorry, Jared, I cut you off.
Oh, that's fine. I was just going to say, you look at the central banks, China, Russia, they're buying gold. Retail investors, especially in China, as their economy grows, the dollar goes down, and it makes these prices in commodities that much more robust. So it's kind of a cycle here, and it's also a safety trade. So if you think about if you're going to hedge your bets over the summer, especially when you have fewer traders on desk, lower liquidity, they're going into bonds, they're going into gold, and they're also going into silver. Silver is at a multi-year high as well, and it's been on a tear. You can see it's been accelerating to the upside here. So all of this says that investors are also, they're seeking protection in addition to wanting to be exposed to some kind of risk in order to get yield.
They want, I don't know, David, I think they want it all, huh?
It's a unique period of time, and I would just back up what Jared just said. Ditto to those comments. I own gold in several of our programs. As long as we're printing money at this pace, as long as money supply is increasing at this pace, and as long as the Federal Reserve is willing to expand their balance sheet, which is Mount Everest at this point, gold is going to trend higher, probably a lot higher.
David, are you putting on any Joe Biden trades? Biden's out today with a plan for elder care and education spending nearing $800 billion. A couple of weeks ago came out with an infrastructure plan. To me, it seems as though there are a lot of potential stock trades to put on off of those plans.
On the infrastructure side, for sure, I'm involved there. On education, I applaud that. I think that's probably the root of our problems. We're going to probably have to move to an education system that is more nationally based rather than state, because education today is funded by local property taxes. That's a problem because for some communities, they don't have the base. And that's why you get this disparate income, and it also leads to income inequality. But I don't have any particular trade that I can feed off of that. On the infrastructure side, names like Caterpillar and others come to mind.
What about stuff you're staying away from right now, especially with all, I mean, not only do we have question marks regarding the pandemic, but we don't know how things are going to shake out in this election. What are some areas you're just not touching at the moment, David?
I'm probably least exposed to what I would call, consumer cyclicals, but, close proximity businesses. I find big box retail, that's going to be a challenge. For restaurants, I just went to a restaurant sitting outdoors recently. By definition, if you're processing less people in a given day, you can't match your revenue from before unless you charge a lot more money. And that's maybe the risk for us in the future, that we're going to see inflation, because that would halt the Federal Reserve in its tracks.
All right, we're going to leave it there. David Nelson of Bell Point, always good to see you. Thanks.
Thank you. Thanks, everyone. Take care.
And be sure to tune in tonight at 5 p.m. Eastern for Yahoo Finance's All Market Summit Extra. We're going to be hearing from the Surgeon General, the CEOs of Carnival and Airbnb, and a lot of others about the state of the economy and what is next for the markets. That is going to be right here on yahoofinance.com and your favorite streaming device. And stay with us. We have more of the first trade straight ahead. Welcome back to the first trade. Amazon's biggest day, Prime Day, is being put on hold. The company reportedly said it will be later than expected, but no date yet. Yahoo Finance's tech editor, Dan Howley, is here with the details. So I was perplexed, Dan, when I heard this. Because of the pandemic, so much is happening online, probably more than ever before. Why would Amazon move their Prime Day?
Yeah, it mostly has to do with just the fact that they were so inundated during the initial outbreak of COVID-19 and the people having to need or the need to work from home or not being able to get out to stores, the fear that they shouldn't go to stores, that Amazon ended up with a huge backlog of people just purchasing essential goods. You know, toilet paper obviously was a huge thing, but then paper towels, cleaning goods, anything that normally they would go out to the store for, people were purchasing on Amazon. So that created a huge just flood for them. They ended up needing to staff up, similar to what they would do for the holidays. And that ended up causing issues with delivery time. So Prime Day is all about getting things, you know, basically the same way you would get them through Prime. You get them cheaply and you get them within 2 days usually. And so they weren't able to do that for a good chunk of the outbreak of the pandemic. And now that we're seeing these resurgences of the outbreaks in the Southwest, really throughout the country now, it's becoming more of a problem for Amazon to continue on. And I think that's why they realize, look, there's no reason to have Prime Day right now. We can push it to another date. People are still going to want to spend money. But right now, a lot don't have it. There are tons of people out of work. Millions have filed for unemployment. And we don't know when those people are going to get their jobs back. So for Amazon, it's a smart move to just move it down the line. I think that people will still obviously be excited for the deals when they come, but this time around, it just doesn't seem like it would be tenable for a July Prime Day.
Dan, one person not out of work is Amazon founder Jeff Bezos. The stock is up more than 30% since the company last reported earnings, dusting Walmart, dusting Target. Bezos is worth a lot more.
Yeah, I mean, look, the idea here is that Amazon has proven its worth really through Prime and through the fact that you can use its service for these kinds of needs, the essential needs that people have been reaching out to the company for throughout the pandemic. And I think now we're finally starting to get them back on track, you know, with deliveries and things along those lines. Goods are finally back in stock that haven't been in stock forever. Good luck finding dumbbells still, though. But I think, you know, one of the things for Amazon is that they finally really proved that, look, AWS, yes, that's a massive part of the company, but the actual delivery arm really is where Amazon made its bread and butter at first, and it proved that it's just as essential as a regular store would be for people in real life, a regular brick and mortar store.
I want to get your thoughts on this Bloomberg Billionaire Index because, of course, Jeff Bezos keeps getting richer. He's still the richest person in the world, but Elon Musk moving up the ladder. I think he was number 20 just a couple weeks ago, but Tesla's stock has been on this tear. And what is he, like 6th or 7th wealthiest person in the world?
Yeah, he's blown up, and don't imagine that it's not, you know, something that he thinks about on his own. We'll likely tweet about at some point, tweaking the shorts of Tesla. We'll probably see more shorts for sale. But, you know, it is interesting just because we've seen this run up on Tesla lately. They did perform well, obviously. They were talking about their deliveries and people purchasing the vehicles, but you know they still don't make as many vehicles as most major automakers. So it really is kind of blows your mind that they're more expensive or they're worth more now than the likes of Toyota, which is one of the largest automakers in the world and produces vehicles at a scale that Tesla just simply can't touch yet. So there's a lot of arguments on both sides. Yes, the technology is incredibly important. But they don't put out as many vehicles as the competitors. So it'll be interesting to see if we continue to stay where we are with Tesla right now.
And Dan, let me pick your brain real quick. Microsoft earnings are coming out soon. Is there one big number investors need to pay attention to?
Yeah, I think really it's going to come down to Azure and just the Windows 10, the more personal computing section. You know, there was some talk from BMO Capital Markets basically saying, look, Microsoft was benefiting from the sunsetting of previous versions of Windows and Windows Server. That gave them a boost for a few quarters, and that now the anniversary of that period is ending in this coming quarter. So going forward, there's going to be hard comparisons between the prior quarters and the ones to come, just because of the sunsetting of those older products. And I think, analysts or investors really might see that and think, wow, year over year, we're not seeing the same dramatic growth, but it's really just because those older products are now out of the market and people have started moving into the newer products. It doesn't necessarily mean that people are fleeing Azure or Windows personal computing. It's just that they don't have those same favorable comparisons. So I think Azure is going to continue to grow. Obviously, it's just driven Microsoft so high, and it'll continue to do so. It's the number 2 cloud computing platform next to AWS. So I think it's really going to be the Azure number again.
I want to get back to Amazon real quick. I'm seeing right now, crossing the wire, that Amazon has announced Prime Day in India will take place August 6th and 7th. Still no date, though, on when Prime Day will be here in the US. But where's Walmart in all of this? I mean, is this an opportunity for maybe Walmart to gain a little ground? Do you think, Dan?
It would be smart of them. Obviously, they're Amazon's largest competitor as far as the deliveries and purchasing goes. I think it would be interesting to see if they actually would do something along these lines and really take it to Amazon. Look, they could do this in August. Obviously, it would be a big lift on Walmart's part to put something together like that for August, but they could do it and still beat Amazon. We're thinking perhaps we'll see something in October from Amazon for Prime Day. So if Walmart can put something together ahead of time, that would really, really hurt Amazon, I think, and that's exactly what Walmart wants.
Yes, it is. All right, I want to get over to Jared Blickery for a moment because, Jared, I'm taking a look here at the Dow. All but 2 30 Dow stocks up right now, and leading the advance, ExxonMobil and Chevron. Let's not forget Coca-Cola out with earnings this morning. One of the big leaders here for the market. Dow up better than 250 points. What's going on?
Yeah, and while you were talking, everything is now green. Coca-Cola leading the way, Staples doing nicely on the back of that. We can see tech here in the green, Apple and Microsoft, but just barely. They were the early leaders. The Nasdaq was up more before the market opened, at least in the futures. And now we're seeing the value and cyclical trade really take hold here. Let's take a look at the sorted numbers here. And Exxon indeed in the lead along with Chevron. That says crude oil hits the highest level since February, and that's largely on reopening hopes, and especially the strength that we've seen in China recently. If we take a look at the Nasdaq, we are going to see some red. A lot of weakness now in some of the communication services stocks, seeing Netflix down about 0.8%, Facebook off about half of that, and some of the safety trades like Tesla and Zoom, those guys are down. Zoom is now off about 2.7%, still up 6% over the last 2 days. And then we can take a look at some of our travel stocks because those are popping as well, Alexis.
All right, Jared, thanks a lot. And have to mention NASDAQ hit a record high right out of the gate this morning. We'll be back with more of the first trade right after this. Biopharma company SORRENTO Therapeutics announced it is a step closer to get COVID patients out of the ICU faster. The company has received FDA clearance for a COVID-19 trial on 40 patients with moderate to severe lung-related symptoms. SORRENTO stock jumped 20% yesterday on that news. Joining us now is SORRENTO Therapeutics CEO and founder, Dr. Henry Ji. He joins us on the phone. We're also joined by Yahoo Finance's healthcare reporter, Anjali Kemlani. Dr. Ji, thanks for being with us. I guess briefly, just tell us what this experimental drug does exactly. I'm not sure we have the doctor right now, but Anjali, I'm going to go to you. I don't know how much you know about this particular treatment, but just overall, we've gotten a lot of news this week about potential vaccines. We're waiting for some news to come out from Novavax. What's the latest, and is there one particular company that seems to be ahead of the pack?
Right. So right now, for SORRENTO, it is an anti-inflammatory, and that's the drug that will help, like you mentioned, with sort of the cytokine storms, and that's really the deadliest part of this outbreak. And those are that's really what affects people the most. And it's typically seen when people are on ventilators, so the most severe cases. So they're starting that phase 2 trial, and that's what they got the approval for, and that's where that jumped. In the treatment space, there are many options, and we are continuing to see them. We know that some have already dropped out of the race. And so as we continue, it really is a matter of what is the most effective treatment. As of right now, from what I understand, remdesivir continues to be the only branded drug that is being used, but we do have the generic dexamethasone also being used, as well as, of course, the plasma therapy. So while all of those are already in hospitals, we're definitely waiting for some more encouraging news that should be coming out this fall. And of course, that's the stopgap that we're looking for to help reduce mortality as the vaccine race continues.
Anjali, is there any one company pulling ahead here?
Hey, hello, this is Henry G.
Do we have Dr. G with us?
Yes, yes.
We have time for one quick question. Dr. G, thanks for being with us. I know sometimes the technical stuff is challenging for us all, but we were just talking about your latest therapy. How soon will we be able to use this therapy on patients, do you believe?
Yes, we are right now planning to get into patient August. We already got the approval and for go ahead to get into human testing, and we'll get into August. And we'll be able to start the trials, and that trials probably last about 4 to 6 weeks. And if everything goes well, we should be able to see some safety and efficacy data. If it looks good, then we're going to move into a phase 3 large trials.
And can you explain for us briefly what this experimental drug is meant to do, doctor?
Yeah, so basically this drug is used to temper the immune response. The virus induces tremendous immune response in the body, and that's way over excess. That's causing cytokine storm. This drug is tempering the immune response to calm down the storm by suppress the cytokine release, which is multiple of them. That the single anti-cytokine type of drug may fail, but if you can broad spectrum that type of inhibition of the cytokine release, you may be able to do the job, tame the immune response.
This is Anjali here. Looking at your pipeline, I see that there's a variety of therapeutics that you're looking at, and one of them includes cancer pain. So this is a very interesting and new sort of platform to get into when you're looking at the response to the pandemic. How are you planning on getting this out there, and what is the strategy to ensure that your drug actually gets to the people the way that we're looking at remdesivir?
Yes, this drugs have been tested already in over 600 patients in the cancer space, and the drugs already finished the registrational phase 3 trials in the non-small cell lung cancer. For the cancer patient, it's a long-term use, so the safety profile is very encouraging, and we're very comfortable with the safety profile. So this perfectly fits into the cytokine storm that the COVID-19 patient experience. The same as cytokine release syndrome happens with cancer when you do CAR T therapy. And this drug potentially could be a perfect combination for CAR T therapy. In this case, going to be perfect for COVID-19 patients when they have a cytokine storm hitting them.
All right, Dr. Henry G. of Sorrento Therapeutics, thanks for being with us this morning. Want to take another quick look at the markets because we're at our best levels of the morning. The Dow up about 300 points right now. IBM and Coca-Cola, two big leaders there after they came out with better than expected earnings despite the pandemic. For IBM, the cloud business, one of the big winners there. And the Nasdaq at a record high as that big rally we've been seeing in tech seems to be unstoppable. It continues. This is all on the back of a big rally in Europe as they forge a historic coronavirus stimulus package there. We'll see what U.S. lawmakers do with a possible package here. Those talks start today. We have more of the first trade coming up. Don't go anywhere.
Welcome back to the first trade. You're seeing the market in rally mode. Dow is up more than 300 points, but IBM on its earnings call last night said growth has stalled, and Coca-Cola just said on its earnings release this morning, case volume down 10% in June. So then there's all that to deal with. Let's go right to Ines Ferre for a look at the markets. Ines?
And Brian, let's take a look at Coca-Cola right now. The stock is up more than 3%. Its earnings per share declined 32% year over year for its latest quarter. Organic revenue slid by more than 20%. Units case volume was down 16% in the quarter, but the company said its global unit case volume has been improving sequentially. Also, Coca-Cola believes that the second quarter was the most severely impacted of the year, and also said as the coronavirus pandemic continues to evolve, there is uncertainty around its ultimate impact. Therefore, the company's full year financial and operating results cannot be reasonably estimated at this time. Let's take a look also at Lockheed Martin, which reported earnings as well this morning. Lockheed Martin up more than 2% after beating on the top and the bottom line for its latest quarter. Quarterly profit came in at $5.79 per share. Net sales improved across all segments, and the company reported a record backlog. Also, Lockheed Martin raised its 2020 full year forecast. And then looking at Albertsons Companies, which recently IPO'd, went public at the end of June, pricing its IPO at $16 a share, received initiations from Wall Street, very bullish, rated overweight at Wells Fargo, a buy at B of A, at Citi, at Guggenheim, outperform at BMO. Brian?
They love their grocery stores. All right, let's stay on the markets here and bring in Mike Muscio. He is president of FBB Capital Partners. Mike, good to see you this morning here. Are you starting to get terrified or become terrified of stock valuations here? And do you think it all ends badly in the seasonally weak August?
Valuations are definitely stretched, and there's two different stories going on right now, and they're very linked, right, Brian? There's the story of the virus and the real economy in Main Street, and then there's the story of Wall Street, and that's what we're talking about this week and next week. And what we're seeing is beating or meeting much lowered expectations from the second quarter, and I don't think that, at least right now, that there's much debate that the second quarter was likely the bottom. And so, yes, you need to see some improvement. We think we need to see some improvement in the second half with the virus and the real economy in order for the valuations right now of stocks to be justified long-term going into the end of the year.
You know, Michael, the second half is going to include a presidential election. Are you paying attention to that now? It seems as though the market is not. Joe Biden is leading President Trump in nearly every poll you see, but we've seen polls be wrong before. So how are you sort of dealing with the upcoming election when you're taking a look at client portfolios?
It's probably the second most frequent question we get, right? That's the virus and then the election. And the way we think about it is we're investing in individual companies for the long run that we think are positioned well to perform well, whether it's a Republican or a Democratic administration. There is a real potential impact to, most notably, to tax reform, right? With a change of administration. But right now, I think the market is kind of looking through that and much more focused on the virus. So it doesn't mean that it doesn't matter. But it probably matters a little bit less than everybody expects that it might.
Mike, I think this market, many folks in the market think this market hinges on stimulus. So if we get an unemployment top up at only $300 instead of the $600 currently, that's a big potential plunge in spending. How do you think the market will react?
Near term, maybe a little bearish. Long term, probably a little bit more bullish, Brian, because you're talking about and a return to work alignment in terms of an incentive, and that's more aligned with kind of what unemployment insurance is supposed to be. And it doesn't mean that there won't be a near-term real economic impact, but the idea of extending the $600 extra a week and having 75% of people that are at home making more money on unemployment than they would in the working economy is probably not long-term bullish.
When you say bearish, do you think we could see a quick 10% correction if that plan disappoints?
Absolutely. Yeah, absolutely. Don't ever underestimate the political intransigence in an election season and the potential near-term impact to markets. And we've seen that. We saw that play out in 2008, much closer to an election, right? I mean, that the TARP plan failed in September before it passed in October, and that was 6 weeks ahead of an election. We're still looking at a 100-day mark here, so that's certainly possible. The path of least resistance, or most probable, is that we get some kind of deal. It's not going to be $3 trillion. It's probably not going to be $1 trillion. It's probably going to be somewhere in the middle. And I do think for investors, you're starting to see with what happened in the Eurozone today with fiscal stimulus, you're starting to see fiscal policy kind of match across borders as well, similar to how monetary policy has for a number of years. So that could be interesting. That's more stimulus. And that could, on its own, provide some support to stocks, even at these valuations.
Even if it's not all that investors hope it will be, if we get this fifth stimulus package, the fact that we're just getting more relief, would that be enough to help this market sustain, or are we going to have a meaningful pullback here before we can start to rally again?
Yeah, I think that near term, don't fight the Fed, don't fight the dollars of fiscal and monetary policy. So I do think my personal opinion, our opinion of our investment committee is that stocks are where they are because of combined stimulus, not because of valuation. We're trading at 25, 26 times this year's likely number, and 20 times next year's number. And so at 32.50 or whatever the S&P is today, markets continue to be kind of priced for perfection. And any kind of near-term disappointment, most likely on the earnings front or the virus front. While the stimulus is definitely helping support, that does not prevent a near-term correction of 5, 10, or even 15%. And to Brian's earlier point, getting into July and August, we wouldn't be surprised to see that at all.
Mike, is this the Joe Biden for president stock market rally? Is it any small surprise that you're seeing Joe Biden ahead, depending what poll you look at, up 10 points over President Trump? That we're seeing the market continue to rally. Perhaps he gets through a major infrastructure plan. Perhaps he overturns healthcare, and a good number of stocks go up.
Yeah, it's possible. Perhaps he reinstates a lot of regulations that have been relaxed, and definitively one of the things is to move the tax rate. So I think the market's rally is right now much less driven on election things and items, and much more driven by fiscal and monetary policy. It doesn't mean that won't change, particularly as you get into the conventions, and then followed shortly thereafter by the debates. And you're looking for a moment. This has not been a traditional year, 2020. It certainly has not been a traditional election year. So we haven't had the advantage of seeing candidates on a trail. So the debates are maybe going to be a little bit more meaningful this year than they are typically.
How concerned are you about consumer spending? I mean, we saw consumer sentiment take a hit, perhaps no big surprise there, but there's a survey out today saying that 1 in 4 Americans say this pandemic has affected their savings adversely. I mean, the consumer was what helped this economy prop itself up ahead of the pandemic. How concerned are you that the consumer just is not going to be there in the second half of the year?
About 70% concerned. That's about the percentage of the economy that consumers make up. And to the earlier point on the unemployment benefits, one of the pros of the $600 extra is that those folks had money to buy things, not only maybe that they need, but we also saw savings rates go up with that, actually. So consumers are spending. I think digital spending is the one area of the market that's expected to actually be marginally higher with earnings for the quarter. But it is a big portion. It is the biggest portion of our economy. I will say one near-term positive is we have a lot of clients who still have mortgages on a first or a second property. And just in the last week, we saw long-term mortgages take out their previous low levels. And there's an opportunity there for clients that previously had some burnout through the last low interest rate environment, where they'd refied at 3.75 or 3.875%, which is by historical standards a great rate. But when you start dropping down to 3%, or you get a 15-year at 2.5%, you may see some additional stimulative spending aspects attached to that.
All right, I'll leave it there. Mike Muscio, president of FBB Capital Partners. Good to see you. Enjoy the rest of the week.
Good to see you guys. Thank you.
All right, do stick around. Much more ahead on the first trade. On the other side of the break, we'll dive into Uber. Welcome back to the first trade. Let's get right to Inez Ferre for a look at Uber. Inez?
And Brian, a final showdown in the UK at the UK Supreme Court on whether drivers should be classified in the UK as employees or contractors. That means freelancers. Now, the court had ruled in favor of the drivers back in 2016. Uber lost an appeal in 2018, but this would really have major implications in the UK. Also, implications for the gig economy, how workers are classified. The drivers are saying that by classifying them as contractors, Uber avoids offering holiday pay, paid rest breaks, also national minimum wage. Meanwhile, Uber says it is a ride-hailing app. It is not like a traditional taxi company. It acts like an agent. It doesn't own the cars. Now, the hearing will last 2 days, but a ruling could take place within months. Brian?
All right, switching gears, eBay accepted a big offer of its own for once. The auction site is selling its classified ad business section for $9.2 billion. Here to break it down is our tech editor, Dan Alley. Dan, does this mean that eBay's website will get easier to use? Will they improve the website? Because it's just not where it needs to be.
Yeah, that's the hope. Basically, what's happening here is eBay's going to shed the classified business and sell it to Adevinta, which is a Norwegian company. The deal is valued at $9.2 billion. They're going to get $2.5 billion in cash and then 540 million shares of the combined entity. eBay will have a 44% stake in it and then have 33% of voting rights. And basically what Adevinta is another ad classified kind of business that works throughout Europe and South America, things along those lines. eBay's classified business really wasn't functioning in the US. It did function in the same areas though. And the idea here is for Adevinta to get kind of a greater foothold in Germany. That's the largest economy in Europe. So obviously they want to get there. And it's part of, Starboard's vision and Elliott Partners' vision, Elliott Management's vision for kind of putting eBay back on track to get the actual website to not be a train wreck. That's really what this is about. Shed those secondary businesses, focus on the core, try to better take on something like Amazon, which eBay is just continually lost out to. And, as you said, the website itself is not something that's appealing to go to. It's difficult to use at times. I personally had bad experiences using eBay in the past. So, it's not really the first thing that a lot of people look to anymore when they go shopping online, but it used to be. Now, obviously, that's Amazon. So I think a lot of this is going to be them driving that cash into eBay itself and rebranding it or revamping it even so that it's more appealing for consumers and not just kind of a secondary site that you would go to if you can't find what you're looking for on Amazon or Walmart.
I think you make an excellent point. I have also experienced that when I go to eBay and try to buy something. It's just not a very intuitive site. And I find myself struggling a little bit. But, what does the future of eBay look like? Could you see a scenario where somebody buys up an eBay? I mean, look, it got rid of PayPal. It's losing ground to Amazon. Facebook has a competing section to eBay. That's been growing nicely. So, what are the prospects for eBay? I understand they're trying to slim down. Could they possibly be slimming down because there's, a greater end to this story and perhaps they sell themselves?
I mean, that could be an out for them, but I think it really is about building themselves back up so that they can take on Facebook's marketplace, like you said, which is a huge competitor for them now. And there's plenty of other classified services out there. I mean, Nextdoor has their own free and for sale section. That lists about $2 billion worth of merchandise every month. So that's a competitor. Facebook Marketplace, though, obviously the biggest competitor there. And it's easier to get to, right? It's already on Facebook. Facebook has 2.5 billion users throughout their different services, so it's easier for people to access. And I think really what it comes down to is making eBay more appealing to users. It still feels like it's stuck back in the 90s or early 2000s when people were still using the service as a go-to, and Amazon wasn't what it is today, the juggernaut that people use for regular shopping. It would be interesting to see if eBay is able to pick this back up and once again kind of reclaim at least some of the ground it's lost to Amazon over time.
Dan, how crazy is it to think that maybe a Walmart might have interest in buying the rest of eBay? Walmart, the past, I would say 6 months, has slowly started to expand its marketplace business.
Yeah, I mean, that would be something that would help Walmart a great deal. They wouldn't have to start, really from scratch, is where they would be compared to what eBay has right now. Not necessarily starting from scratch entirely, but it would be helpful for them. Clearly, I mean, really, what Walmart wants to do is take down Amazon, and there's no better way to do that than by building up quickly. Throwing in an Amazon there, an eBay there, would really help them. But again, it would come down to cleaning up eBay itself and making it more appealing. Walmart's site, they do offer third-party marketplaces or third-party sellers through their marketplace. So it's not as if it would be completely out of the realm of possibility for them to have something along these lines. And it really would help them. I think it would have to be a separate entity, though, that really, demarcates that this is pre-owned rather than something you're getting new.
All right, Dan Halley, thanks so much. Alexis, this news just crossing the wires. Walmart will close on Thanksgiving Day. And I have to be honest, that stinks for me because for the past 12, 15 years, I've gone to stores on Thanksgiving and taken photos, assessed what's happening in retail. Now, no mas.
I know you are big on eat that turkey and then hit those stores. I am usually cleaning up from the feast I've made, so I am not out there with you shopping. But yeah, big news from Walmart. Sam's Club also not going to open on Thanksgiving Day. And, I think a lot of things go into that decision. Of course, certainly in a year of a pandemic, you don't want to go into those crowded stores and take advantage of those Thanksgiving Day sales. That could certainly be part of it. And also Walmart just wanting to let its employees, have that day to be with family and friends. So I applaud Walmart.
It sounds like I'll actually have a Thanksgiving this year. Maybe you can invite me over via Zoom.
Oh, there's always enough food. Let's go. Forget the Zoom. Come on over.
All right, appreciate it, Alexis. Good looking out. All right, do stick around. Much more ahead on the first trade.
Democratic presidential hopeful Joe Biden is rolling out another proposal today designed to boost the economy. It is a sweeping plan for government-funded child and elder care, and it comes with a pretty hefty price tag, $775 billion. Yahoo Finance's senior columnist Rick Newman is joining us for this one. So Rick, let me guess, part of paying for this is going to come in the form of higher taxes, right?
What, you don't want to know about the benefits first? You only want to know about the taxes?
All right. Give us the benefits.
Of course it's going to be in higher taxes. And here's an interesting wrinkle. Biden wants to repeal tax breaks for real estate developers. Can you think of any prominent real estate developers that might hurt? And that's going to be over 10 years. So that price tag you gave, 775 billion, that's over 10 years. So call it $80 billion per year. It's a combination of elder care and child care, and it's not health care. So for elder care, seniors are already covered under Medicare, but it would be a big expansion of community services, home care. A lot of this would be in underserved communities. Some of it would happen through expansions to Medicaid. And then childcare, I think the big item there is universal pre-kindergarten for 3-year-olds and 4-year-olds. Economists generally think that's a great idea. That is associated with much higher outcomes in school for those kids. Plus, it's a form of childcare for working parents. So this is another long laundry list of benefits, which, if it had any chance of passing, would also come with new taxes.
Rick, Biden is really hitting President Trump with a few uppercuts. A couple weeks ago, infrastructure plan, this big spending plan. At a time like this, I'm sure all people are going to see is we might get some more money and we're going to get some help from the government. And you know what? We need it. Here's my vote for Biden.
I guess that's what he's hoping. So the flip side of that, of course, is that this does feed into President Trump's socialism claim, because it's a lot of expanded government benefits, which would come with higher taxes. Now, I would not characterize it as socialism. I would characterize it as just more government activism. And in many ways, the areas that Joe Biden is targeting are areas where, the systems that we have are failing. I mean, we're seeing now with so many people losing their jobs, we're seeing millions of people are losing healthcare coverage because it's tied to their jobs. So that's something we're going to hear a lot more about from Biden, I think, in the future, is better healthcare. So he's trying to hit all the problems that people are feeling in their real lives. He also has his own plan for addressing the pandemic, if it is still a problem, come next January, when he would take office if he wins. The way it's going, we're doing so poorly with containing the virus, it could still be a problem. So that's part of his plan as well.
All right, leave it there. Rick Newman, always good to see you.
See you guys.
All right, do stick around. Much more ahead on the first trade. Welcome back to the first trade. Let's get right to Inez Ferre for a look at several stocks. Inez, the axe is swinging at several companies.
Yeah, that's right, including LinkedIn. Microsoft's LinkedIn will be cutting about 960 jobs. That's 6% of its global workforce. The pandemic has really slowed down hiring for companies, and the job cuts will be across sales and hiring divisions. Also, we're just taking a look at Tailored Brands this morning, the parent company of Men's Warehouse, cutting some 20% of its corporate positions, closing up to 500 stores. A C-suite change at the company as well. CFO Jack Calandra will be departing Tailored Brands, and Holly Etlin has been appointed as Chief Restructuring Officer. Looking at Tapestry, that stock is up more than 2%. The maker of Coach, a top leadership change there with Chairman and CEO Jide Zeitlin leaving the company for personal reasons, effective immediately. Zeitlin had taken over that CEO position back in the fall of 2019. The company's CFO will become interim CEO, and also the global head of investor relations and corporate communications has been named interim CFO. Also, the company reported its fourth quarter, preliminary results, which say that they exceeded internal expectations on the top and the bottom line. The results will be announced in August. Brian?
All right, thanks so much, Inez. Managing through a crisis, companies across the board are looking to recover after getting hit by the coronavirus. Here to discuss that more is Susan Magrino, CEO of Magrino PR, alongside Chief Revenue Officer Alan Magrino. Good to see you both this morning. Both of you are no strangers to the power lunch. This was the name of the game for many years. What has replaced the power lunch in corporate communications?
Well, I think communication is more important than ever, and so is PR. It's always been important, but now we're finding that brands and businesses really need to be smart, savvy. They've got to pivot. They've got to figure out new ways to communicate. Something that we did, we have a number of clients in the spirit space. We did a virtual tasting of Whispering Angel last week on Bastille Day on the 14th of July to sort of celebrate the French heritage of the brand. I think that what everybody is finding is that we've got to be able to continue to move our products. We are seeing lots of great things happening in home, certainly with Martha Stewart, who we've worked with for many years. Has got very strong brands at Macy's, Wayfair, as well as Drew Barrymore with a furniture line at Walmart.com. So I think we're really trying to make sure that we're communicating in the areas of where there's need and where we can, but it's primarily virtual.
Alan, talk to me about some of your higher end brands. You have some clients, luxury brand clients, Christie's Real Estate, Moet Hennessy. You were just talking about spirits and how you did a virtual tasting recently. What have they been telling you? And are you seeing demand for their services fall off significantly during the stay-at-home time?
Well, I think for Moet Hennessy, I mean, people are saying, everyone's drinking more, and there are, from the retail level, their sales are up, but obviously the on-premise has been affected with restaurants being closed. But we are doing virtual tastings. Susan was mentioning the communication and staying out there. This is not a time to go quiet and put your head down and hope you just get through it. You've really got to grab it and go out there and adapt and be more flexible. One thing we've been doing is we're offering some new services. We don't have the runway anymore of a 6-month launch. It's quick. It's 30, 90 days because we have to help these businesses. So we're working with them is adapting their stories and adapting to the new normal.
And I think your point on real estate, we've certainly seen that with Christie's International Real Estate. It's been in greater demand, obviously, with people leaving major parts of the country and wanting to go to other parts, people who rented, want to buy. That trend is being seen in lots and lots of places. So we've actually been busier than ever on that. It's been very interesting to see the strength there.
I think that really is interesting because people might think PR companies like yours are really hurting now as companies sort of look for ways to save money and their marketing budgets may be smaller. What has the business been like for you in terms of just mere survival at this point? Did you apply for a PPP loan and did you get one?
We did apply for a PPP loan. We were fortunate to get it and have satisfied all the requirements for that. So that's certainly been helpful, as it has been for many, many businesses. I think that our team, we've got a terrific team of experts where we know what we're doing in terms of our categories and our expertise. And there's still a lot of that, we're in a business that's about face-to-face communication. We're in a business that's about relationships. And I think that's more important than ever. My lifestyle in New York City would be going to, maybe 2 to 3 events a day in between what I was doing in the office. And you've kind of lost all of that. So how do you replace it? You replace it by staying in touch with people, whether they're clients, contacts, associates, media. I think that part of it is, you've got to be reaching out and proactive at all times.
Right. And I think we're fortunate that we're not just in one vertical either. I mean, I think agencies that focused only in one area that got severely impacted or in trouble. But, our consumer and our wines and spirits brands are very strong. I mean, Cuisinart makes bread makers, and everybody knows, their bread maker sales are up 54%. So there are some, bright spots and silver linings, and that's what we're focusing on. And we're also taking the opportunity to, make the agency a client, doing for ourselves what we do for all our clients, and really looking inward and how can we come out of this even stronger.
And we do go ahead.
No, just to say we have to leave it there. But everyone's certainly at home making bread. I can definitely attest to that one. Susan Magrino, CEO of Magrino PR, alongside Chief Revenue Officer Alan Magrino. Good to see you.
Thank you. Thanks for having us.
I do want to touch on some breaking news we just saw across the wires. Dow Jones reporting that Tapestry's board is probing now former CEO Jide Zeitlin. Find that surprising, but we'll keep you abreast on that story as it continues to develop on the other side of the break. Welcome back to the first trade. IBM earnings last night were a bit mixed, but the chip stocks are doing well and trending on yahoofinance.com right now. Inez Ferreira is back with the details. Inez, AMD, NVIDIA, doing pretty well.
Yeah, that's right. And if you just take a look at the semiconductor ETF SMH, that earlier hit a new high. Right now, we're seeing a little bit of retreating back just a bit. But earlier also, the iShares, the Philadelphia Semiconductor ETF, the SOX, was also at new highs, intraday highs as well. I do want to mention Taiwan Semiconductor because that stock is also touching new highs today. This is after a report from an Asian newspaper that Japan is looking to work with TSMC to make a new factory, a domestic chip plant. Now, the company has told Reuters that no deal is in place yet, but it didn't rule out one in the future. I want to point out what's been happening with IBM after IBM reported its quarterly results. The stock is up now more than 1.5%. Its earnings per share came in at $2.18. Total revenue came in at $18.12 billion. That was down 5% year over year. Its cloud revenue came in at $6.3 billion. That was up 30%, and the company's gross profit margin came in at 48%. That was up from 47% last year. A little bit of color from their conference call with new CEO Arvind Krishna saying it's likely that we see that the economic recovery is looking to be longer and more proactive than what we might have hoped for in March. CFO Jim Kavanaugh said, as the pandemic intensified and the macroeconomic climate worsened, clients quickly shifted their focus to operational stability and cash preservation. This resulted in a delay in both the existing projects and new commitments, especially in projects that are more discretionary or with longer time to value. So a little bit of color there on what happened during the quarter and what they're expecting as well, Brian.
All right, staying on the pandemic, confirmed cases of COVID-19 are on the rise in states like California, Florida, and Kentucky. Question is now, are we testing enough? And how accessible are these tests? Here to discuss that more is the CEO of Change Healthcare, Neil DiCrescenzo. Neil, good to see you this morning. Your business and where you sit atop the company, interesting insight into testing in America. What is the problem here? More people are in fact getting testing, but what does it take? Why is it taking so long to get the results back?
Well, I think, Brian, a big challenge for the industry is access to testing on a scale that we really never envisioned. We're one of the largest networks in U.S. healthcare, processing 15 billion transactions, 1.5 trillion of the U.S. healthcare system. Last week, I think we moved around 18 million medical records across the country. But testing is obviously on a level that we never really contemplated before the pandemic. So what we've tried to do is to figure out how we can make it easier for patients to access testing and get the results back both to themselves and their physicians. Some people aren't aware, but in this country, only about half of the physicians have access to a simple electronic way to submit orders so their patients can get to these testing centers and get tested and get the electronic results back. This is something that we focused on for a number of years. Some of them have access to it, but it costs them money. So one of the big things we've tried to do is open up access for free to our lab network, which is one of the largest in the country with 1,400 labs, over 100 of which are doing COVID tests. So we really think improving access and making it simpler for physicians and patients will help the issues that you mentioned.
How are you, Neil, how are you using technology to lower the cost of things like getting a COVID-19 test for all people?
Well, Alexis, a lot of this is trying to take out the friction in the system. I think we all recognize that healthcare has a long way to go to be as convenient as a lot of the retail and other experiences we have in our normal lives. So what we've tried to do is to make sure that our infrastructure is available to more people, especially in rural areas, underserved communities, where you're not necessarily going to have all the investment in the infrastructure or the applications to make this simpler for physicians, for the labs, for the results reporting, and getting the results back to the patient. So we thought the appropriate thing to do is to take cost out of the equation and really open up our network so everyone can use it and hopefully find the most available, convenient for the patient, and the closest way for people to get tested and get their results as fast as possible.
Neil, your business has been impacted by the reduced number of elective procedures because of the coronavirus pandemic. These procedures are not getting done. Have you seen any trend improvement in that? Are you collecting payments from physicians? Has anything improved?
Yeah, it really has come back, Brian. I think what we've seen as the economy's opened up, as you can imagine, a number of people, it may be called elective procedures, but they might be pretty important to those patients and really advised by their physicians. So we have seen the rebound since the economies have opened up. Obviously now with some of the almost reclosures and some of the other challenges we've seen, it's become quite spotty and more regional than what we had obviously hoped as we all looked at getting out of the more national lockdown situation. So we are seeing it coming back, although I would also mention that part of it is really the demand that existed when we were more in a national lockdown for people to go get these procedures or talk to their physicians and deal with their chronic illnesses in ways that they maybe found more difficult when they really had to stay at home.
Just following up on that, Neil, do you think this quarter is the bottom for your business? And as economies start to potentially open up in the back half of the year, hopefully, your road to recovery might be there?
Well, I think we're still talking to our customers every day, which include most of the large health plans and providers and really the whole ecosystem of U.S. healthcare. And I don't think any of us know yet, Brian. Obviously, we've all been disheartened by some of the challenges we've seen over the last few weeks, the increase in cases, obviously the continuing increase in the deaths. So I think we're going to just have to wait and see on how the virus is handled, including in these local areas, to see what the impact is over the course of the year.
And Neil, how much do you think telemedicine is just going to be part of our everyday healthcare going forward, even post this pandemic? We've seen that so many of us have not been able to go physically to the doctor's office, so we've had to do these visits. I mean, obviously, some visits cannot be done via telemedicine, but what's your take on that going forward?
You know, Alexis, this is here to stay. I think it's clear not only among the payers and providers in this country, but also the federal agencies, that they understand how this could be more convenient for patients. It provides a level of flexibility that often the patients also appreciate. We've done a lot of work making sure that all the coding and billing and all the mechanisms that make sure the care is appropriate, because as you say, not everything can be done through telehealth, is done in a clinically supported manner. So I think we've actually put an infrastructure, of course, like many things that have happened in this pandemic, in an incredibly short period of time, to see, telehealth volumes going up 3, 5, 10 times. And a lot of that's going to stay because I think people have gotten used to it. And obviously, we're not out of this pandemic yet. And I think the federal agencies, the people who reimburse for care, have become increasingly comfortable with it over the last number of months as well.
Neil, how difficult is it to do what you do at your company with most of your workforce at home?
Well, I'm really proud of the workforce to change healthcare, Brian. I mean, we went to working from home like many companies very quickly, given we're really the infrastructure for the U.S. healthcare system, the way it's held up, and have allowed, including frontline healthcare workers, not to worry about things like also getting reimbursed and making sure they can keep their practices, including smaller rural hospitals or smaller doctor practices, afloat. So I think what we really went to this work from home approach, but because of the infrastructure we had put in place over so many years and the robust nature of our infrastructure, we were able to keep the U.S. healthcare system continue to be running, and a lot of pride in that in our employees, and I think a lot of satisfaction, hopefully, among our customers.
Yes, I'm sure. All right, let's leave it there. Neil DeCrescenzo, CEO of Change Healthcare. Good to see you. Enjoy the rest of the week.
Thank you.
All right, preventing the spread of COVID-19 is the best way to eradicate the virus, but wearing a mask has unfortunately become a public debate. During Yahoo Finance's All Markets Summit Extra, we'll be hearing from the Surgeon General, Dr. Jerome Adams, on why it's important for people to take the extra step and wear a mask.
The other important thing I want people to know is that masks actually don't inhibit your freedom. They don't inhibit your choice. They enable freedom and enable more choices, because we know that if we can get 90% of people to wear face coverings and get people to practice at least 6 feet of social distancing from their neighbors and practice good hand hygiene, that we can reopen and then we can stay open and we can get back to schools, to worship, to college football in the fall, and to the other things that people want to do. You'll have more choices if you wear a face covering.
All right, for more on what the Surgeon General has to say, along with other influential leaders, check out Yahoo Finance's All Markets Summit Extra. That's happening tonight at 5 p.m. Eastern on yahoofinance.com and your favorite streaming service. Yours truly sitting down with Carnival Cruise Line CEO Arnold Donald. Very much excited to do that one. Do stick around. Much more ahead on The First Trade. Welcome back to the first trade. Ford has officially rolled out a racing version of its new electric vehicle, the Mach-E. It unveiled the Mustang Mach-E 1400, which has 7 electric motors and can reach a top speed of 160 miles per hour. And yes, has 1,400 horsepower, hence that name. Autoblog editor-in-chief Greg Migliori joins us now with his take on the vehicle. Greg, the floor is yours. This car looks insane. Is it a car?
So it's a car, it's a race car. I think it looks amazing. It really underscores that performance element of the Mustang Mach-E. There's no getting around it. The Mach-E is going to be a crossover. That's fine with me, but that's not okay with everybody. That was sort of the one controversial piece of calling the Mach-E a Mustang. What's the best way to answer critics? Build a race car. So I think the timing is really good to release something like this. Ford's still basking in the glow of the Bronco, which I think we're all pretty excited about. And the F-150 reveal, like, don't forget about that. That's the most important vehicle they make. That reveal was just a month ago. That went really well. So to me, this just kind of continues the momentum.
Hey, Greg, you know, there are a good amount of electric hybrid supercars out there that make 1,000 or more horsepower, but few do it in 7 motors. Do you think that this is overkill? I mean, who really needs this?
Well, I think it's a discussion starter. It's the idea is to get people really excited about the Mustang, the Ford brand, electric cars, that sort of thing. They called it a one-of-a-kind prototype, which to me is sort of like they're signaling in the press release, this is about what this is going to be. I don't expect they're going to build too many of these. But the idea is to sort of extend the idea of what a Mustang could be. Hey, it's a crossover. Hey, it's on the racetrack, it's on the street. It's a traditional gasoline engine, it's also electric. And to me, just, you know, like Brian said earlier, just looking at it, I think they really succeeded there. It looks amazing, it's crazy. You look at that hood, it looks like a fighter jet. The fender flares are crazy, there's all these different vents. So I think in that sense, you know, the idea is more like just, hey, it's Tuesday morning, let's have a Mustang race car, more than any real practical considerations.
Speaking of crazy, Greg, while we have you here, I would love to get your reaction to this. Yesterday, we spoke to Mobileye CEO about when we might see autonomous cars. Take a listen.
We believe that if 2022 was self-driving robotaxis, 2025 would be the start of consumers.
Greg, is that realistic? Will we really see self-driving cars on the road in a big way by 2025? Don't they have to clear some serious regulatory hurdles?
Yeah, I don't really think 2025 is realistic. I think this is one of those examples where the goalposts just keep getting moved farther back. They could certainly have self-driving cars in some forms sooner than that. We actually have them right now in pilot programs throughout the US and, you know, many different markets. I don't think it's realistic for mainstream adoption in the United States by 2025. I don't think it's, you know, maybe 2030. That's when we would see mainstream. And by that, I mean like individual people owning autonomous cars. I think around 2025, we could see more, you know, some taxis, shuttles in a very more like defined scope. But to me, at that point, you're almost just getting to almost like individual public transportation at that point. It's not quite that like space age feel of, you know, autonomous flying cars.
Hey, Greg, what about Tesla vehicles as sort of these super race cars, if you will? Because we saw Tesla's Model X SUV actually beat a lot of other cars in drag races. So, I mean, at the end of the day, does speed sell even if owners aren't going to use that speed?
Absolutely. I think Tesla race cars would be amazing. I think they have, so they're electric, obviously, and they have all that low end torque, which means right off the line, right off your immediate acceleration, your Tesla's going to really take off. I've driven a few different Teslas. They're amazing. They, you know, they really will like rip your head off, you know, pickle your insides when you really get on the throttle, such as it is. So I think they'd be amazing on the track. I don't really think Tesla needs to sort of shine up its racing image. I think the move for them is more to tap into this like need, this idea that we must have electric cars and they must be a certain way, and then almost capture the idea of what a Tesla is. And that's what their buyers are going to want, and that's what's going to bring them new buyers too, I think.
Greg, can you believe Tesla's stock price? It has gone through the roof. Is there really that much excitement that this company will just dominate the entire auto industry within 5 years?
I don't think within the industry there's that sort of sentiment, but I think from just a pure speculative, from a pure, hey, what's an interesting stock? What's a company that's always in the news? I mean, it's way easier to understand what a Tesla is, what a car is, and then look at its stock numbers, which make my head explode sometimes, and sort of wrap your head around that versus looking at some nuanced mutual fund or trying to figure out what the bond market's doing. I mean, car companies are very complex, but everybody, like almost everybody has a car, and it's a very easy idea to understand, I think. And that's why I think in some ways the stock is so exciting and appealing to some people, is it's an easy notion, and then it has so much energy.
Well, I'll just say this, Greg, if Tesla doesn't blow away earnings when it reports this week, the insides of some bullish investors might be pickled. We'll leave it there, though. Autoblog editor-in-chief Greg Migliori, always good to see you.
Thank you.
Let's go right to Inez Ferre for a look at the markets. Inez?
And Brian, just taking a look at Tesla, since you were just talking about it, down more than 1%. JMP Securities cut Tesla to market perform from market outperform. Tesla, of course, will be reporting its earnings tomorrow after the close. A lot of expectations for those quarterly results. Let's take a look at what's happening with Apple. Apple says it is aiming to become carbon neutral by 2030. Its corporate operations are already carbon neutral. This could expand the goal to its supply chain and also its product life cycle. That's the aim. Looking at Ulta Beauty, that stock is up more than 2%. This is after Ulta Beauty said that it is temporarily reducing new store openings and closing a limited number of stores this year. The company said that it has completed its phased reopening process, and to date, approximately 50% of those people who were furloughed in April have been reactivated. Taking a look at the stock year to date, it's down 19% year to date. And then just looking at Amazon, which yesterday was soaring more than 7%, today pulling back just a little bit, down more than 1%. Amazon is delaying its Prime Day in the US, usually held in mid-July. And then looking at the overall markets, what's happening here, we're looking at the Dow. Coca-Cola more than 3% after reporting its quarterly results. Also taking a look at energy stocks, which today are leading the gains. Industrials also leading as well. And then if we just take a look at the Nasdaq 100, you can see that some of these big tech names, big cap tech names that were up yesterday, today are pulling back just a little bit, Brian.
Inez, real quickly, can you pull up a chart on Tapestry?
Yes, I can. I'll pull it up right now.
That story is just, it's captivating.
Yes, it is. So the stock is up more than 3%. There you go. You can see it here. And
Wow.
Year to date, it's down 49%.
Very much an unfolding story. All right. Thanks so much, Inez. Do stick around. On the Move is next. They'll dive into all things markets and the big race to ink another fiscal stimulus plan. Do stick around. Much more ahead.
And welcome to Yahoo Finance. I'm Adam Shapiro along with Julie Hyman. We're watching a bit of a mixed rally on Wall Street. The Nasdaq is off about 20 points, but the Dow is up around 300 points. The S&P 500 is up almost 20 points. And some of the things which are driving headlines, earnings season. We plow ahead. Coke beat this morning despite a drop in sales. And after the bell, we're going to get Snap and United Airlines. Raymond James analyst Savanthi Syth will join us in about 15 minutes to break down where the airlines stand, as several will report this week. Markets are also getting a boost here and overseas after EU leaders reached a $2 trillion deal to stimulate the economy. We'll head to London to find out when that plan, or what it offers, as lawmakers here in the United States debate additional stimulus for the United States. And Treasury Secretary Steven Mnuchin says it is his goal to have stimulus, a deal worked out by the end of next week. Elon Musk is the fifth wealthiest person on the planet as his fortune passed $74 billion. We're on Tesla watch as shares closed yesterday up roughly 9.5%. They were above $1,640 a share. Investors are awaiting Tesla's latest earnings report due after the bell tomorrow. Microsoft's LinkedIn says it's going to cut 6% of its global workforce as the coronavirus pandemic hits jobs and cuts demand for what LinkedIn does, recruitment. The CEO said recruiting, quote, continues to be impacted as fewer companies need to hire at the same volume they did previously. And part of that, the coronavirus pandemic. The cases so far worldwide, 14.7 million people testing positive. The number of dead exceeds 610,000. In the United States, we have 3.8 million people who've tested positive. The number of dead approaching 141,000. But investors right now are watching earnings reports, and we begin with Coke. Largest drop in revenue in more than 2 decades, down 28% in the second quarter, although it was on target with estimates, $7.2 billion in sales. Earnings per share fell 33% in the quarter, 42 cents per share. Global unit case volume, that shrank by 16%, although believe this, volume trends may be improving. They actually plunged in April 25%. They were about 10% in June. So far in July, volume has fallen mid-single digits. And the CEO, James Quincy, he said, quote, "We believe the second quarter will prove to be the most challenging of the year." Julie?
I'm watching IBM, Adam. The shares right now are up about 1.4%, and they've been helping to buoy the Dow, but they have given up some of their earlier gains. So that's something to continue to watch. The company standout was the cloud. Cloud revenues up 30%. They make up about a third now of IBM's overall revenues. At least they did this quarter, even as overall revenue at IBM fell by 5.5%. It still beat estimates, as did earnings per share, coming in at $2.18. That's about 10 cents above what the average analyst estimate was. Gross margins also expanding at 3 of the company's 5 units, and overall expanding as well to 48%. 47% was that gross margin a year earlier. By the way, this was, I believe, the first quarter that the company's reporting under its new CEO, Arvind Krishna, who replaced Ginny Rometty, remember, as CEO on April 6th, Adam.
And then there's Lockheed, defense contractor, had better than expected second quarter revenue, $16.2 billion. That was up year over year from $14.4 billion. Earnings were also up year over year, $1.6 billion. Now, this is the first report. Yes, another new CEO, Jim Taiclet, who took over in June. Lockheed slowed production, by the way, in May of the F-35 stealth fighter because of supply chain issues related to the pandemic. The increase in defense spending since 2018 has helped Lockheed, but there are shortages of parts. Congress was taking issue with that in June. Year to date, the stock is down 6%, but it's up about 2% over the last 52 weeks. We're going to talk about earnings. We're going to talk about a lot with Steve Sosnick, Interactive Brokers Chief Options Strategist. About the S&P tech surge is where I wanted to start with you. And I realize this might be a broader subject, but I'm hearing a lot of people say beware, especially if you're someone conservative who does maybe an index fund, the S&P 500, because it's driven so much by the tech stocks, the big tech stocks. What do you say to those people?
I say they're right to be concerned about this. We're going into an earnings season with very little clarity, with very high expectations, with stocks priced to perfection. And you have a situation where the top 5 stocks, Apple, Microsoft, Amazon, Facebook, Alphabet, which is actually counts twice because there's 2 classes of Google, but those stocks make up just under a quarter of the S&P 500 and about half of the Nasdaq, the NDX. So there doesn't leave you much room to hide in a broader index. The benefits of diversification are somewhat minimized when you have a concentration like that. To put things in perspective, the equal weighted S&P index, SPW, was down 0.5% yesterday. That shows you how concentrated the gains were. Amazon put on the equivalent, almost the equivalent of an AstraZeneca yesterday in terms of market cap.
Steve, this has been a concern and a criticism for a while now, right? I mean, even before coronavirus, we saw a lot of the gains for the past several years concentrated in these large cap names. So 2 questions. 1, what's going to change it? And 2, if you can't get that protection and diversification by buying an index fund or ETF, how do you get it?
Well, a couple different things to unpack. What changes it? It's going to be something. It's probably, well, the first thing would be earnings, because we really do have to wrestle with the earnings season that's coming now. All these companies are reporting in the next couple of weeks. Most of what we're seeing has been multiple expansion. You know, think about it. Apple's a double since last year. You know, Amazon and Microsoft up 50% since last year. I'm doing it sort of roughly, but there's a lot of perfection priced in there. And the problem is, if you get a severe disappointment from one of those, it's tough for everybody to run to the exits. What that means is you'd want to start. You can't diversify really through an index. What you want to start doing is diversifying, either moving into different weighting the sectors a little bit different than the S&P does, or starting to use puts as a downside hedge. Most people right now, puts have fallen out of favor. The put call ratio is not today. It's off the lows a little bit, but it's been flirting with lows that we really haven't seen in ages. That usually signifies that we've kind of reached the end, because the end of a short-term move, if not a longer-term move, because there's so many people piling into speculative calls and thinking, what do I need to hedge for with puts? Especially right now, I think the thought is, why buy a put if the Fed's going to give me one?
Steve, it's Brian Chung here. Great to speak with you again. I want to get a picture from you of who the players on the field are right now. If you rewind to maybe about a month ago, we were talking about the day traders of the world, a lot of these retail investors, Robinhood traders. Have you seen that dynamic still be in play with the market dynamics that we're seeing now? Is there a lot of interest from those retail investors, maybe first-time investors, in those types of options or puts? And if not, what's really the name of the game here? Is passive investing really still the king here?
Well, first of all, I don't think those people are buying puts. We have made it easier, and you could see from all the brokerage firms, including ours, we've had big account growth. There's clearly new money coming in. I think a lot of the stimulus actually went into the stock market in lieu of savings accounts. Not necessarily a bad thing, but when you make something cheaper, you get more of it. So we've made it cheaper and easier. It's never been cheaper to buy stocks. It's never been easier because of fractional shares. Most of those people are still trying to ride the wave higher. I don't blame them. But what that means is you get into very crowded trades. It's sort of, you know, and I wonder that if and when this thing reverses, do you sort of get a little hand wringing that this is a house that we built ourselves in the industry. But right now, I think you're seeing people speculating on the upside. These are people who are banking on winners. It's not necessarily wrong certainly right in the short term, but let's see how it's not going to be easy if everybody decides to change their mind at once.
Hey, Steve, I did want to ask you a question about an article. I think it was in the Journal this morning and it's in line with the S&P perhaps being a little bit too pricey for a lot of people, making the case that, for instance, corporate debt and above junk, obviously, that the yield is not only better there, but that it's much less expensive over the long term compared to the S&P, and that you should consider that. What advice would you have for people who read that article and thinking it's time to shift?
Well, I think selectively that may be the case. First of all, remember, the Fed is actively participating in the corporate bond market. They are not actively participating in the equity market. So if you're based on the Fed thesis, where the Fed, by the way, has kept their balance sheet roughly flat to slightly down for the last 6 weeks, despite the common narrative of the endlessly accommodative Fed, there is a logic to going into higher quality corporate bonds in some cases, because you're not seeing, let's say, in so many cases, you're not seeing the dividends helping you as much as you might from the corporate debt side. It's selective. This is more of a right now. The problem is the market probably is biasing more towards someone who's selective, although in the short term it's biased toward just close your eyes and buy the big caps.
All right. We want to thank Steve Sosnick for joining us. Always a pleasure to have you here. Steve Sosnick is Interactive Brokers Chief Options Strategist. We wish you the best. We want to head across the Atlantic to London because we were talking about it's a total package of about $2 trillion, not quite that in euros. But Tom Belger is going to break it down for us because it's partial grants, it's partial promises of more budget next year. Tom?
Yeah, we got confirmation this morning in the early hours of this remarkable breaking of the deadlock among EU leaders of 27 states. It came in the form, actually, of just a one-word tweet from a leading EU official that just read, deal. And it's worth emphasizing first, last week even, you had very few people expecting to get a breakthrough so soon, some not at all, because these divisions relate to a group of so-called frugal northern states really dragging their heels over the package of grants and loans in the recovery fund that's been agreed particularly to southern struggling states. They drove a really hard bargain. They got handouts themselves as the price for their support, but they have now caved in. And that's pushed up most European stocks. For a second day today, there's a rally in sovereign debt. A lot of it had been priced in recent days. That's why, and to some extent further back, that's why you've seen the euro near flat today. But it is still hovering around 4-month highs against the dollar. To answer your question on what the package looks like, a decent chunk of this money will be the EU's multi-year budget. Some of the spending just brought forward, but really the attention is on the 750 billion euro package. It's about $860 billion. It's about half and half grants and loans. And really, it's the southern countries that are in line to benefit most. Analysts are saying overall, it's about 1.5%, 1.6% of total EU GDP that's going to be dispersed in the first couple of years. But if you're Italy or Spain, really struggling most from this crisis, they could be in line for 2.5%, 3.5% of GDP. So a decent stimulus there, and genuinely historic. Because it's the first time that countries will borrow together through the EU for a joint stimulus package. And if you're an investor, that's a pretty important precedent to set, because you can imagine that if this crisis drags on, or if there's even another crisis, the EU might just come under pressure again for more of the same kind of thing. So some people are really seeing this as a baby step of sorts to wider fiscal integration within the EU. Which is why it's got so much attention and positivity from investors. Personally, I'm not sure we should get too carried away. You should bear in mind, if you're looking at this, a lot of the cash isn't actually going to be dispersed until the middle of next year in the real economy. And if you're a shopkeeper, if you're a listed company in a lot of countries, it's a question now of survival. So the questions about whether that cash will reach you fast enough. Some say that this cash still, however big it is, it's just a fraction of what Greece, Italy, Spain need to get out of the crisis, given how serious it is. So
that question of survival, Tom, is the question here in the United States as well. I mean, Jessica Smith is standing by because we have this stimulus debate now unfolding with promises from Mitch McConnell to cap stimulus at $1 trillion. But that's pie crust, easily made, easily broken, right?
Yeah, and today the administration is on Capitol Hill talking to lawmakers. Treasury Secretary Stephen Mnuchin and the White House Chief of Staff, Mark Meadows, are there right now. Mnuchin told reporters the goal is to get a deal by the end of next week. We do expect Majority Leader Mitch McConnell to unveil the Republican proposal sometime this week. He calls this plan a starting point for negotiations with Democratic lawmakers, but there's still a lot to work out even among Republicans. You have the payroll tax cut. President Trump has talked a lot about that. He talked about it yesterday, saying that it's something that's a priority for the next round of relief. Take a listen.
I think it's a very important thing. It's very good. It's been proven to be successful. It's a big saving for the people. It's a tremendous saving, and I think it's an incentive for companies to hire their workers back and to keep their workers.
Now, Republicans on the Hill, even yesterday, after hearing that from President Trump, have expressed some skepticism about a payroll tax cut. There's also some conflict within the party about funding for schools and when it comes to some other issues like funding for testing. So Democratic leader Chuck Schumer says that, Republicans have been putting this off for months now, and now he's saying maybe it's because they can't get their act together and agree among themselves.
The nation is raging in crisis. The Republican Party has been paralyzed, stopping and blocking action that Democrats have sought to deal with the problem.
Now, we did just hear from Majority Leader Mitch McConnell on the Senate floor a few minutes ago, and he said that this next round, the Republican plan, will include $105 billion for educators, a second round of PPP, and more direct payments to Americans, though he didn't say how much those payments would be or who exactly would be receiving them. So we'll keep you updated as these negotiations continue.
All right, we've already seen Congress step in to assist the airlines through programs in the CARES Act. But what's going to happen come October 1st with the airlines? We had United, we have Americans saying that they put out the warn notices that they may have to lay employees off on October 1st. Sevanthi Saith is a Raymond James analyst who covers the airlines and a friend of the program who we invite in right now because United Airlines is going to report second quarter earnings after the bell today. Nobody expects anything too, terrific here, Sevanthi, but you pointed out in your most recent note to clients that momentum from the trough of mid-March into mid-June appears to have stalled with absolute fare levels reverting from the highs seen in mid-June. I think what you're saying is the recovery in the airlines took a reverse.
Yes, at best, I think it's stabilized. So it's a, as Delta talked about last week, it's going to be a choppy recovery. And the choppiness has started before. We knew heading into the fall, corporate clients needed to come back in that September timeframe. We knew there was risk there. But with the COVID rates rising, with places like California reversing their openings and places like New York applying quarantines, there's definitely been an impact on demand. And we've seen things at demand levels, kind of the momentum stalling and pricing kind of pulling back.
Savi, we know when you look at airlines, you look at the balance sheet. I know a lot of people are watching the furloughs. I am curious if, though, when you look at demand, when you look at traffic, when you look at pricing, are there big differentiations among the airlines right now, or are they all seeing the same sort of changes, drops right now in demand?
That's a good question. And what's historically, you would see legacy airlines like American, Delta, and United, and even Southwest to a fair extent, driving a lot of demand from business travelers. Today, we're driving most of the demand is leisure. You might have some small SME businesses traveling, but it's really leisure. And so I think the level of revenue impact is probably greater on airlines that have historically relied more on corporate demand. But generally, everybody, I think, is seeing the same impact. It's especially right now. I think early on, you could have said the differences within states on their willingness to travel, with the coastal customers generally being a little bit more cautious. But today, I think with the level of rates increasing everywhere, I think all the airlines are seeing a very similar trend.
When you talk about travel, Savi, Delta, Ed Bastian talked about not getting back to business travel the way it was in 2019 for a long time. But Delta's also, the window hasn't closed yet on early retirements, but they've had really dramatic numbers. It's 17,400. It's almost 20% of their workforce is saying, yeah, we'll take the early out. Whereas at United, it's so far only 4%. Are the other airlines going to have enough people say, I'll take the early retirement to avoid the layoffs, do you think?
And I think they need to do more work, and they are. You heard yesterday, I think United came to a new agreement with their pilots on a couple of different packages. So we might see more uptake, and we'll have to see. It's interesting, if you look at the warn notice levels, it looks like American and United have talked about 30 to 40% of their overall workforce receiving warn notices. Now, that doesn't mean that's the level that they're going to need to reduce, but definitely you need a lot more kind of voluntary levels to increase. Again, the benefit of voluntary is good all around because you're making a decision as an employee to, what is right for you, and it's good for morale, so you're not having involuntary layoffs. And also from a cost standpoint, usually, involuntary furloughs impact the most junior employees, and they're a lot lower paid and more productive than some of the senior employees. And so, it's a good thing to kind of get more voluntary, and I think the airlines are working towards it as we head into the fourth quarter.
As you study the space overall, do you anticipate there can be consolidation out of this period of time? Do you expect some interesting tie-ups to emerge as there are more cost-cutting measures, and there can be more negotiating power perhaps on the side of the acquirer?
Yeah, right now I think everybody's just focused on survival. So I'm not sure that in the very near term there will be any tie-ups, but we've always kind of felt that, longer term there's probably opportunity for tie-ups, maybe not as much in kind of the big four area, just because of the view from, I think it would be hard to get it past Congress and the government. But from a smaller airline perspective, I think there's opportunities. I don't think we'll see that in the near term. Never say never, but I think this is an opportunity for airlines to kind of look and see where the fit is.
Sevanthi Syth is an analyst at Raymond James, and she writes a weekly note on the airlines, one of the most comprehensive that a lot of us get to read. We appreciate your being here, Sevanthi Syth. All the best to you. And as we head to break, we want to take a look at some of the stocks on the move. eBay shares are up, at least they were up 1% at the opening bell, but now they have fallen. They're down almost 2%. And this is after news that they reached a deal to sell their classified business to the Norway-based Advinta, a classified ads publisher. That deal, $9.2 billion. eBay is going to get $2.5 billion in cash. The rest is going to be shares of the company in Norway. Also, how can you avoid Tesla? They're going to report tomorrow after the bell, and right now shares are off about 15%. And this has to do with JMP Securities analyst Joseph Osha, who downgraded Tesla to market perform from market outperform. He said the company's valuations right now slightly exceed the $1,500 price target that JMP had suggested. Other than that, though, during the earnings call tomorrow, they think that the price is fairly reflected in the stock price. We're going to have much more Yahoo Finance on the move after this. Welcome back to Yahoo Finance. Dow is up about 330 points. S&P 500 up over 20 points. Nasdaq is off by about 20 points. President Trump tweeted this morning that, quote, we are united in our effort to defeat the invisible China virus. And many people say that it is patriotic to wear a face mask when you can't socially distance. Now, he, of course, had spent several months not wearing a mask and making a public show of it. There's much more to discuss in regards to the coronavirus and wearing a mask and the debate over masks. Angelique Kemlani is with us right now, and tell us more about that and the interview you did with the Surgeon General.
Thank you, Adam. Yep. So we did finally get some sort of clarity and some progress on this movement to push for mask wearing that health experts have actually been asking for quite some time. While it isn't an actual national strategy or any kind of national guideline, it is a significant step in that direction. So that is something that we've heard from all the White House coronavirus task force members, including the Surgeon General. And if you listen to what he said, he also was pushing for that.
The other important thing I want people to know is that masks actually don't inhibit your freedom. They don't inhibit your choice. They enable freedom and enable more choices, because we know that if we can get 90% of people to wear face coverings and get people to practice at least 6 feet of social distancing from their neighbors and practice good hand hygiene, that we can reopen and then we can stay open and we can get back to schools, to worship, to college football in the fall, and to the other things that people want to do. You'll have more choices if you wear a face covering.
So as you can hear, pushing for that as the opposite of what some of the criticism has been, which is that mask wearing is in fact infringing on civil liberties. And so the U.S. Surgeon General pushing back on that. Meanwhile, we know that President Trump is set to restart briefings after stopping them in late April. And so that's something that many are looking forward to. However, the tone of it should be different this time. Some are saying we have medical experts like Dr. Rob Davidson saying that, it should be different. We should be focusing on facts. And so there's a lot of concern about what these new briefings will be like, whether or not the tone will in fact change, or whether they will be similar to what we were seeing before. Adam?
Angelique, when you talk about the briefings in season 2 of all of that, will the same cast of characters be there? Will we see Anthony Fauci at these briefings, or will it be solo president?
It is unclear at this time, but obviously everyone is hoping to hear from everyone.
All right, Angelique Kemlani, who follows health as well as the COVID-19 pandemic for us. Want to let everybody know that you want to make sure you tune in today at 5 o'clock Eastern for our special all-market summit looking at the road to recovery. The guests include Surgeon General Jerome Adams and Airbnb CEO Brian Chesky. You don't want to miss it. Welcome back to Yahoo Finance on the Move. I'm Adam Shapiro along with Julie Hyman. You remember that famous TV ad, oil up, gold down? Not today. Gold's up over 1%. We want to talk about why investors seem to be flocking to gold. We're going to do that with Joe Cavatoni. He's the World Gold Council head of Americas, and we appreciate your being here. Why are people seeking safety in gold? It's an old play, isn't it?
It's an old play. I love the quote. I love the reference. But the reality is gold is doing exactly what we described to people it does when you need it most. Market risk and uncertainty, flock to safe haven, liquidity when you need it. That's why investors are speaking with their dollars, record flows into exchange traded funds, not only in the US market, but global, over $45 billion into ETFs worldwide. Speaking with their dollars, it's doing what it does. It adds a ballast to your portfolio and provides liquidity.
Joe, it's Julie here. What has tended to happen, because we've had periods in the past, even though this is record flows, we've had periods in the past where we've seen big inflows into gold. What tends to happen momentum-wise? Do we tend to see that kind of sustained demand during periods of uncertainty in the broader world? And then do we also see sustained increases in prices, or do we see more of a stability kind of phenomenon?
Great question. The two drivers of gold can be broken down into strategic and tactical. Momentum tends to be tactical. So in the short term, what we see in the momentum environment is the price spiking and dropping and sometimes correlating with assets on the short term. But more importantly, on the longer term and strategically, we see either economic expansion or market risk and uncertainty being the real strategic longer term drives of the trajectory and the price of gold. Right now, economic expansion really clearly not what's driving the price of gold. Investments, investors, central bank holdings driving the price through market risk and uncertainty. It existed before 2020. We were highlighting it in our outlook, geopolitical risks, potential political change here and the regime and change in the US, tensions with trade, all of these factors were there. COVID-19 has just amplified it, made it a lot more concerning and a lot more challenging for people. So what you see is the price will continue to trend up. And the other factor that I want to highlight that people should pay close attention to is where real rates are in terms of what you achieve when you invest in bonds.
So let's that's a great, I'm glad you said that, because I heard commentary yesterday that if you look at where long-term bonds are right now, and then you add in the actual real inflation rate, you're actually looking at a negative yield, which is what might be driving people to gold. Is it that, or is it just fear? Because a lot of people buying a gold ETF may not be doing that kind of math.
It's both. And actually, we've highlighted that in our mid-year outlook. When you look at what you're trying to achieve, which is returns that can be predicted and calculated and reliable while preserving your assets, you have to look at your bond portfolio and understand exactly what it achieves. The carry on gold right now is in positive territory. That's why you're seeing people adding it. They're not replacing bonds. They're adding it to their bond portfolio. They're adding it to their portfolio allocation. It delivers when you need it. And actually, one last thing to highlight, when you need liquidity, gold's a go-to instrument. Gold's going to be there and preserve its earnings. You might see some tracking with other assets and risk in terms of markets moving and volatility, but what you'll find is liquidity will be there for you when you need it.
Hey, Joe, so I know predicting the future is very difficult, especially during these times, but we have Citigroup with a $2,000 price target. They say it's a 30% chance gold could reach that point in the next 6 to 9 months. Do you expect that to be the case? And if so, what might the catalyst might be? And if not, what are the downside risks from a pricing standpoint?
Keep watching the real rate environment. Keep paying attention to the political risks that are out there. Actually, Citibank, Goldman, other firms are all putting price points that are all leading to allocations, demand increasing, particularly in investments. Watch the central bank space. Overall, we have a tool that's available for people to use, Quorum. It's on our website, goldhub.org. You can check it out. It'll help you project the long-term growth expectation for gold during a supply-demand calculation. Ultimately, what you need to pay attention to is where real rates are going and the risks that existed before COVID-19.
And of course, thinking back just a year ago, right, at least in our conversations on Yahoo Finance, a lot of the chatter around gold was in relation to cryptocurrencies, and just thinking about Grayscale Investments campaign, Drop Gold, Buy Bitcoin, just thinking about how you're reaching the younger audiences, the first-time investors, helping them diversify their portfolios. What sorts of messaging are you sending out, and do you feel like it's been successful during this time?
So the messaging is still the same. Bitcoin, cryptocurrencies, really interesting, really opportunistic for people, different investment. Gold's delivering exactly what it needs to deliver. We're on platforms, we're in wealth management offerings, we are advertising. The ETF market in particular is designed to serve the needs of all investors, irrespective of age and how you want to go about investing. And actually, what we're seeing is consumption across the board, institutional and retail. It's happening. It's a different investment. It has a place in people's portfolio.
And of course, Joe, investing in gold itself or in a gold-based ETF, backed ETF is not the only way. People are buying miners too. And there was a story out today on Bloomberg that pointed out that it's not just the largest miners that are drawing interest now, it's the so-called junior miners, right? The smaller companies, in some cases that have more debt, for example. So what are the sort of advantages and pitfalls of looking at those smaller companies?
Well, investors that are more familiar with equity investment and understanding the complexities of understanding how companies work will find that mining stocks will definitely benefit from a buoyant gold market, but they're also going to have the opportunity to express their investment views by doing that same equity analysis they do on any company. So looking at the mining companies is a mechanism for going about investing in gold, but different to owning the precious metal itself because of the facts you just highlighted. You know, debt to equity ratios, different ways of earnings, expansion, supply, production, all the different factors that go into owning mining companies.
Joe Gavatoni is World Gold Council's head of Americas, and as the saying goes, oil up, gold up. Perhaps another time we can talk about something less exciting like aluminum. All the best to you. Thank you for being here.
Thanks for having me.
As we head to break, I want to let you know that shares of Walmart right now are trading, as you can see. I'm going to pull it up on the computer. They are up roughly 1.3%. This as Walmart has announced it's going to give workers the day off on Thanksgiving. The retailer is also planning to hand out another round of special cash bonuses to nearly 1.5 million of its associates. Full-time workers, that excludes salaried office staff, will receive $300, while part-time or temporary workers are still going to get a bonus of $150. It's a total of $428 million. Julia LaRoche has much more on this a little bit later during On the Move. Yahoo Finance news on the move. The FBI says the prime suspect in the fatal shooting at a federal judge's home in New Jersey may have taken his own life. The FBI identified attorney Roy Dan Hollander as the possible shooter who killed Judge Esther Salas's 20-year-old son and injured her husband Sunday night. Hollander died from a gunshot, which the FBI says may have been self-inflicted.
Florida teachers don't feel safe enough to resume in-person schooling, so they are suing Governor Ron DeSantis. The state's largest teachers union filed the lawsuit, which says DeSantis and other officials have filed a state constitutional mandate to keep public schools, quote, safe and secure. Florida's planning to fully reopen schools next month, even as the state reported 10,000 new coronavirus cases yesterday.
And the NFL, as well as the Players Union, have agreed on daily COVID-19 testing protocols so that training camps can start. That's according to CNN. They obtained an agreement from the league and the union. The league has also offered the Players Union a deal to cancel the preseason this summer and let players and teams focus on staying healthy. The NFL wants to start its regular season in September. The union's assistant executive director tweeted last night that the league did not offer or give up preseason games. We're going to shift gears to a different kind of game, and that's filling the vacancies on the Board of Governors at the Federal Reserve. Judy Shelton is expected to get the nod to proceed from the Senate Banking Committee, and Brian Chung, as well as the panel, are going to weigh in on this. What do we need to know about Judy Shelton? Is she really a gold hawk?
Well, Adam, here's what we're watching for. At 2 p.m. today, the Senate Banking Committee is going to hold a vote on clearing the path to nomination for 2 Federal Reserve nominees from the White House, from President Trump, that being a former economic advisor to that Trump campaign, Judy Shelton, in addition to St. Louis Fed economist Christopher Waller. Christopher Waller, a longtime Fed economist, has been someone that is not too controversial. His views on economics have been thoroughly vetted by the Senate Banking Committee when they had their hearings some time ago. But Judy Shelton, really the one in view, as you mentioned, Adam, because of her controversial takes on things like the gold standard, her advocacy to reinstate the gold standard, which interestingly she backpedaled on when she did ultimately face the Senate Banking Committee for a hearing that was last year. Keep in mind that both of these nominations have been pending for over a year now, and the concern here is that the Senate Republicans and the White House might be trying to jam these nominations through before the election comes around in November this year. Now, one other thing that's worth mentioning is that even though this is a committee vote, there still needs to be a full Senate floor vote. What we do know is that it's a 13-12 break in terms of Republicans and Democrats on this committee. And we did hear from Senator John Kennedy, a Republican from Louisiana, yesterday saying that he would support her nomination through the committee. But you still need to get, even after this committee vote today, a full majority on the Senate floor, where the Republicans, with a 3 head count majority over the Democrats, can afford to lose only that amount, 3 Republicans, in order to get both of these individuals ultimately passed. So definitely something worth watching in the next couple months as this confirmation process does continue to slug along.
Hey, Brian, talk to me about sort of historic Federal Reserve Board dynamics. In other words, you tend to think of really the heads, the Fed board presidents, like Jay Powell now, as being sort of a unifier, right? As usually their voice is the one that wins out. Have there been instances, though, where there has been much more dissent within the board that then has affected the decision-making process, like there potentially could be with the Judy Shelton?
Definitely, Julie. There's been many iterations of this Federal Reserve Board over time. A lot of people forget that it's not just the Fed chairman. There is a board of a number of other appointed officials, Senate-confirmed officials on that board as well. But you can even see the dissent right now. Lael Brainerd, for example, who was an Obama appointee, has dissented on a number of regulatory-related issues over the past few years. But that doesn't necessarily translate over to monetary policy, where she's pretty much been in line with Chairman Powell, and then before that, Chairwoman Yellen. Now, you can rewind to even the Greenspan era. There was definitely era of dissent there. Kevin Warsh, being governor, was someone who clashed at times with other members of the board. Now, Judy Shelton, the argument for those that do support her nomination here is that she would provide some sort of diversity to the Fed board. But the other concern is that she also could be in line to be the next Fed chair, if it is indeed the case that Donald Trump wins the election in November. The idea is that his disappointment with the way that Jay Powell handled the economy leading up to the coronavirus crisis could actually spur his firing and the replacement of Judy Shelton, who is actually a self-proclaimed unorthodox economist at the top of this extremely important institution. So definitely something worth watching there, and something that will probably catch the ire of a lot of Democrats as this confirmation process does carry on 2 p.m. today, in addition to whenever it does face a full Senate floor vote.
All right, we're going to keep an eye on that. We know Brian Chung is always keeping an eye on that and matters regarding the Federal Reserve. Want to let you know that keeping an eye on dividends is something that our next guest after the commercial break is going to share with us as to how it can help you improve your income picture. Welcome back to Yahoo Finance on the Move. We want to talk about dividends right now. And to help make this case and discussion move forward, I want to show you Home Depot right now. Shares of Home Depot up about 1%. They're trading at $262 and some change. But if you dig deep into the Yahoo Finance page, into the metrics, you'll see that the annual dividend is $6. It's $1.50 a quarter. The yield is 2.3%. Why should you pay attention to that, especially if you're a no-risk conservative investor? Our next guest is going to make the case on dividends. Mark Lichtenfeld, the Oxford Club's chief income strategist, joins us now. And I use the Home Depot example to help bring home something you shared with us, that, compounding even at a 4% dividend yield without adding money is going to pay off for you in the long run, right?
Absolutely. It's the greatest wealth building tool that I know of in the markets, especially for long-term investors. If you can just set it and forget it, and especially if you reinvest your dividends, the compounding machine really generates tremendous returns. And I can throw out all kinds of numbers for you if you're interested, but the first one I'll just throw out, a 4% dividend yield on a stock that doesn't move for, let's say, 10 years. Stock just never moves. After 10 years, if you reinvest those dividends, you'd have $18,300. So, an 83% return on a stock that never moved.
And Mark, is the goal here to try to pinpoint companies that are going to be raising their dividend over time, that have sort of stable, high dividend yields? Which do you think are better plays?
So what I look for are companies that are raising their dividends every year. Now, obviously, you need a certain starting point, a certain threshold to invest in a company with a 1% dividend yield. Even if they raise it quite a bit every year, probably won't get that compounding to help you. It won't get your compounding to the spot that you want it to be to reach your goal. So I usually look for at least a 3 to 4% dividend yield to start, and a company that has, let's say, 8 to 10% dividend growth per year on average over the long term. And if you can get that, you're gonna triple your money in 10 years, most likely.
But let me ask you about this, and I'm going to cite the Rolling Stones poster behind you when I say I can't get no satisfaction, because if you played a dividend stock like, say, Royal Dutch Shell, for years, the dividend yield on that was very healthy. And I mean, most recently was as high as 6%, and they cut the dividend. I mean, how do you, this kind of play is a portion of a portfolio, but it's not the all or nothing, right?
Exactly. And I do think it should be a large part of your long-term growth strategy, or your long-term strategy. Certainly you want to sprinkle in some growth stocks, but you never want to quite set it and forget it. You want to set it, and you don't have to track it every single day, but you do want to keep an eye on things and understand if their free cash flow is growing or if it's falling. Obviously the oil sector is a little bit of a different animal in that we've seen absolute crashes in the commodity price, which has hurt earnings and cash flow as well. But generally speaking, when you're holding these companies for the long term, you want to watch their free cash flow. And as long as their free cash flow isn't falling to the point where they can't cover their dividend anymore, then you should be fine. I mean, generally speaking, companies with ample free cash flow don't cut their dividends.
And Mark, just thinking about the nature of the Oxford Club, of course, we know that it is selective, but it's not a secret organization. As we're in the throes of trying to make sure there's economic empowerment to different groups and different sorts of populations, especially those who have been disproportionately disadvantaged during coronavirus, how are you bridging that gap? Because this dividend strategy is a simple one, and everyone can get access to something like that, right?
Absolutely. So we have a free website, wealthyretirement.com, that has all kinds of strategies and advice for investors, from absolute beginners to very experienced investors. And every Wednesday, I actually talk about a dividend company and whether their dividend is safe. So there are a lot of things, a lot of free resources that we offer on wealthyretirement.com, and I invite everybody to take a look at it.
Hey, Mark, it's Brian Chung here. One of my favorite financial terms is DRIP, the idea of repaying your dividends into new investments. Is that a good strategy right now in the volatility that we're seeing in the market? Should people be taking that income and then putting it back into equities or other types of investments?
Yeah, I think that's always, or I should say almost always, a great thing to do, a great strategy, because human emotion is an investor's worst enemy. And to try to time the market and say, well, the market's really high right now, I'm not gonna reinvest the dividends, I'm gonna hold off, or the market's really poor right now, things are tanking, I'm gonna hold off. That is almost always the worst strategy. What you want to do is really not have to think about things, because the average investor and even professional investors are often very wrong, especially at inflection points. So if you can reinvest your dividends over the long term without thinking about it, when the market's high, when the market's low, when the market's right in the middle, in the sweet spot, you're going to make money rather than trying to time the market. You'll always, almost always, be wrong when you're trying to time the market like that.
And we give you the last word. Mark Lichtenfeld, the Oxford Club's chief income strategist. We appreciate your being here. We'll be right back after this. We are watching markets here at Yahoo Finance, and the person who's keeping an eye on it for us is Jared Blickery. What can you tell us?
We got energy and bank stocks on fire. Throw industrials into the mix, and the Dow is leading the way. It's up over 1% or 284 points, as you see right there. The Nasdaq is trailing. It's down 0.6%. And so we're still seeing this bifurcated market where we either have value and cyclicals leading or the FANGs leading. And today it's value and cyclicals. Here's the S&P 500 up 0.4%. And the price action today, after gapping up, been kind of sideways since then, but still sitting on those gains. Over the last 2 months, we're going to note that we have broken definitively out of this channel that we were trading in for about 6 weeks, have broken to the upside. And with that, we're also seeing bond yields curiously low here, hugging about 0.6%. And usually we see the FANGs outperform on these days, but not today. Then we'll take a quick look at the VIX Fear Index. That is down below 25. I believe that's for the first time since either June, or you might have to go back a few months prior to that. And then we got a lot of outperformance by the safety trade. We got gold futures up 1% at multi-year highs. Haven't seen that price since 2011. Silver futures up 6%, having their best day in months. Haven't seen these prices since about 2014. And copper as well. That is on a tear. Let's take a look at our heat maps because we got FANGs under pressure. You can see all that red to the left side there. Those are the growth stocks. And then sprinkled in there, we got some of the more safety trades and also some of the travel trade items like the airlines and the cruise lines. Those are outperforming today. And then in the Dow, we have Exxon up 6%, Chevron up over 6%. Haven't seen that kind of strength from energy names in at least a month for most of them. If we sort by performance here, we can see, besides those two at the top, we got Boeing up 4%, American Express on the travel play up over 3%, and to the downside, we just see those tech names we've been talking about. Here's the travel items, and we can see Trip.com up 3%, United up 4%, and Royal Caribbean, those cruise lines are up about 2 to 3%. Finally, let's take a look at the banks because those have been outperforming as well. Some standouts are Wells Fargo up 6%, finally catching a break, or maybe it's just short covering. We'll have to see. But the other big names like JPM and Bank of America all up more than 2 or 3% here. Adam.
Jared, thank you very much. As we go to break, want to let you know that when we come back, we're going to be talking about Amazon. Shares are down a little bit today, but Julie's going to lead the discussion with an analyst from Jefferies. They just raised their price target on Amazon as well. So we're going to have all of that for you in the next hour.
You're watching On the Move on Yahoo Finance. I'm Julie Hyman, along with Adam Shapiro. Our colleagues Julie LaRoche and Dan Roberts are going to be joining us over the next hour. We've got a mixed picture for stocks today. Once again, this divergence that we've been seeing between the Dow and the Nasdaq. The Dow today is the winner. It's up 1.2%. The S&P is in the middle, up about 0.5%, and the Nasdaq is down 0.5%, as we consider earnings reports from companies like IBM, which is trading higher, as well as Coca-Cola, which is also trading higher in today's session. Some of the headlines that we're watching at this hour: the Department of Justice has now come out with more specifics on what it says have been hacking attacks on COVID-19 research here in the United States, including vaccine research. They say hackers targeted information there, and they have come out with a complaint to that effect. We will continue to be tracking that. On the corporate front, Walmart says it's going to be closing on Thanksgiving. It's going to be offering some bonuses to workers. We will have more on that with Julia during the course of the hour, but that's something that folks are paying a lot of attention to today. And people are also paying a lot of attention to the companies that have yet to come out with earnings. I'm taking a look at Amazon, which is down 2.5%. It's coming out with its numbers next week, but the stock yesterday had its best single day gain going back to December of 2018. That's after a couple of analysts raised their price targets. Today, the company is officially postponing its Prime Day sales event. Previously, we basically knew it wasn't happening because it didn't happen in the month of July as it usually does. We're going to bring in Brent Thill now. He is an analyst at Jefferies who covers Amazon. He's one of the folks who raised his target on the stock yesterday, along with a peer over at Goldman Sachs. We're going to talk about Microsoft and preview those earnings in a moment as well. But Brent, I did want to ask you about Amazon. We don't know exactly when Prime Day is going to happen, but is every day Prime Day now? I mean, are they seeing... We know that Prime Day brings with it a lot of extra traffic. Do we know what kind of traffic Amazon is seeing regularly at this point?
I think you nailed it. We don't think Prime Day is a requirement based on what's happening with COVID. Right? We're increasingly turning to Amazon, other services like Chewy, eBay, increasingly more online, and even Target and Walmart's online service to fulfill this, because none of us want to actually go to a physical spot to be potentially exposed. So we don't believe that this really matters at this point. We think that the delay is not going to be material financially. And as the Target CEO said back in April, every day was like a Black Friday day. So I think that is a great analogy to use across e-commerce, that we're seeing just ongoing strength. And remember, Amazon isn't just about retail. You have an advertising business. You have a giant software business with AWS, which is a dominant platform for cloud. They have over 60% market share when you monitor both Microsoft and Google next to them. So we think ultimately, again, there's multiple facets that are driving Amazon, not just the retail business.
But one of the things driving them, Brent, possibly now that investors can buy a slice of a stock, is that perhaps artificially pushing up these values right now and getting ahead of themselves?
So I think overall technology, we've seen a massive inflection. No one expected valuations to be 25% higher into COVID. I think what happened from a portfolio manager perspective is no one wants to own banks. They don't want to own hotel companies, airlines. I mean, look at how bad those stocks are. So what you've seen is more of a portfolio manager rush to technology, given the recurring visibility, given the tailwinds we're seeing in the work from home. And one thing that's bonding this all together is the internet, right? And these services are getting multiple improvements. So can multiples last like this forever? No. What we've said is you've seen massive multiple expansion. Now the fundamentals have to come through. Expectations are super high. Amazon's business in every turn we can see fundamentally is benefiting. The question is, can they meet the expectation, which is, again, the most elevated we've seen, with the stock up over 60% year to date.
Brent, Dan Roberts here. If we expand out just from Amazon, a lot of the big tech names, especially the FANG names, have just surged in the last couple months. And in some cases, that's because they're seen as stay-at-home plays like Netflix. But for the most part, it also just seems like, tech continues to rise and those continue to be a good bet. Especially with Facebook, it's been interesting because you've got the so-called ad boycott, and yet it really hasn't mattered much for the stock. It's funny to think back when the story around big tech was all the regulatory hurdles. And for a while, pre-pandemic, all you heard about was lawmakers saying, we're going after Facebook, we're going after Amazon for potential antitrust, Google. Has all of that gone away for the moment? Has the pandemic kind of made everyone forget about the previous concerns over size for these companies?
Antitrust hasn't gone away, but I would just say that software stocks are trading at 30 times revenue and Facebook's trading at 20 times earnings. So when you think about many of these internet names are reflective in their multiples. And so it's the number one question we get from internet investors, what's going to happen from a regulatory perspective. It's not going away. But what we've said is that if you invested in Microsoft in the 90s because the EU was going to break them up, that was a bad idea. You missed a 1,000-point move. So what we're saying is obey regulatory, watch it, pay attention, but do not let it shade your investment conclusion long-term about that these are great platforms that ultimately, like this ad boycott, I mean, every one of these companies, Arc'teryx, Patagonia, they're all coming back. Okay, they all have to stand out in the short term, but they're all going to come back. And we think that the press isn't talking loudly enough about what Facebook has done for small businesses. I mean, there are 800 million global small businesses, 160 million use Facebook every day, and only 8 million pay. So, it doesn't matter if Patagonia or Disney leaves, you've got thousands of small businesses realize that they can find the people on the community in Facebook, and now Facebook is letting them sell their services, both product and service-oriented services on their platform. So I think we look at it a little bit differently, and we think ultimately this is more noise than a fundamental risk.
Hi, Brent. Julia LaRoche here. Interesting point that you bring up about small businesses. And you have to imagine some of them are actually probably taking advantage of the platform now with so many of the bigger players on the sidelines. I do want to just turn a bit more to e-commerce, the growth we've seen, the behavioral changes from the consumer. What do you think continues to drive that and make that sticky? And to add to that, is it a risk if we don't get more stimulus or PPP or maybe even a boost to the unemployment going forward, especially if we have another wave of the pandemic?
The COVID numbers, are not getting better, right? And so ultimately that shifts more to e-com. I think secondarily, we're all comfortable with e-com now. And even if you look at the older generation, my parents, right, they'd love going to Target or Walmart because it was social. They don't want to go there. They're the most susceptible. So you had an older demographic, your generation, that was adverse to buying on e-com because they had a lot of time. They weren't like us. We weren't working. I don't have time to go to the store. I need it delivered. So ultimately, I think you have an older demographic that's now come into the mix. And I think it's more sustainable. All the survey work we do is more sustainable about e-com that, my kids, for example, don't care about going to a Foot Locker to buy shoes. They just are like, Dad, I want to play outside. I want to spend 2 seconds on Amazon. They'll be delivered tomorrow. So I think both the older and younger demographic has shifted. I think this is long lasting. There's no vaccine in sight. And so ultimately that's going to continue. If we get a vaccine, ultimately, I still think the tailwinds are there. You're seeing physical retailers shut their stores down at an alarming rate. And you continue to see, I think that it's broad based, Chewy, eBay, you go across the board, all these e-com vendors are seeing the same tailwinds Amazon's seeing. So what we'd say is that it's not just about the one-stop shop Amazon, it is helping multiple boats lift as the tide's lifting across the board.
And Brent, to bring it back to Microsoft, it's going to also help raise the boats of cloud, right? The power, all this stuff. Is Azure going to be the big thing that you're going to be watching for in Microsoft's quarter? I know also we should be paying attention to the video game business, especially with everybody at home too. What's going to be the big question for you going into this earnings report?
Well, we think there are 3 tailwinds to Microsoft's business. Microsoft Teams, it's their killer app. Many companies are implementing Teams to collaborate remotely wherever we work. So that's number 1. How well is Teams doing? 2 is Azure. To your point, they are the number 2 against Amazon. And number 3 is the gaming space, right? You can look at the consumption at home. Gaming is off the charts. So that business is doing well. I think the big questions are, how is their on-prem server business doing? How is the Windows business doing? Given what's happened, there has been a surge in PC demand. As people work at home, they need new devices. So that actually helps. So how long lasting is that going to be? And I think Ultimately, Microsoft has been growing double digits with margin improvement. Can they continue to commit to double-digit growth and margin improvement at the scale and size that they're at today in this environment? And their commercial backlog number last quarter dropped, which is a future sign of growth. We're looking at the backlog numbers as well. So there are multiple pieces we're looking at. Ultimately, last quarter, investors gave them a hall pass. They didn't have a great quarter. They took down the guide, and the stock went up 10% points more. It's because they don't want to own travel. They don't want to own airlines. They don't want to own banks. They don't want to own any of these alternative asset classes. Technology continues to power, I think, where a lot of our clients are sitting.
Yep, it's definitely where the crowd has been going. Brent Thill, thank you so much for spending some time with us. Brent joining us there from Northern California. He's an analyst at Jefferies. Appreciate it.
Thank you.
All right, let's broaden it out now and take a look at what's going on overall in stocks, and in particular, the valuations. Dan I is joining us now. He's Fort Pitt head of asset allocation and equity research. He's joining us from Harrisburg, PA. Dan, stocks obviously have seen this recovery from the lows, and there's been all of this debate about what the shape of the recovery is in the economy. You say there is probably a V-shaped recovery, but here's the question. Is that already priced into stocks at these levels?
Hi, Julie. Thanks for having me. And I think that's really the $64,000 questions that our investors are asking themselves. In our view, we think that the massive monetary and fiscal stimulus efforts have largely been successful in restoring investor confidence, backstopping credit markets, and really helping to bridge the gap for displaced workers. We think we've gotten through the worst of the economic declines and contractions in earnings, in corporate earnings. And we've been really encouraged by some of the economic data that we've seen, very strong employment reports, a consistent downtrend in unemployment claims, and very strong retail sales for May and June. The Fed's estimating that we'll see a 13% advance in Q3 GDP. And a lot of other economists are even more optimistic. So we think that there's a lot of positives and support for that bullish V-shaped recovery narrative. But we're also very cognizant that we're 45% off those those late March lows, and that does price in a lot of optimism. It already prices in a lot of good news. Valuations are high. It doesn't leave a lot of room in our view for an unexpected outcome, but we still see a lot of attractive opportunities outside of broad market indices.
Dan, where are those opportunities?
Well, good question. I think I'll take the other side of the coin to start from your previous guest. We do want to own the banks, and one of those is JP Morgan. Obviously, banks have had a rough 2020, but we think that JP Morgan's second quarter earnings call or results really highlight the benefits of their diversified business model and the strength of their management team. JP Morgan just posted a record quarterly revenue result, even with the backdrop of the worst economic contraction since the Great Depression. So we think that's a positive in anybody's book. They're managing expenses very well. Undemanding valuation. They trade less than 12 times, expected earnings for 2021. We think their dividend is safe. A 3.7% dividend yield in an ultra low interest rate environment looks extremely attractive to us. And we see some catalysts out there as well. The company has booked, massive loan loss provisions over the last 2 quarters, and at some point, that will turn and reverse into, reserve releases, which would be a very strong tailwind for the stock.
Dan, it's interesting, again, sort of piggybacking off what we just heard Brent Thill talking about, that all these people are getting into large cap technology right now. You didn't send us large cap tech as one of your picks. However, you sent us something that is what I would call tech adjacent or dependent on tech, right? Which is Digital Realty. It's a data center REIT. Do you get some of the maybe growth qualities of a Microsoft or a large cap tech company without getting the valuation, or how pricey are some of these data center REITs right now?
Yeah, so I think that's a really good question. And, I know, Brent just mentioned, some software companies trading at, 30 times sales. It's generally not the type of valuation that we're comfortable with. So we've looked at, other ways to play that theme, the technology theme, the theme of increased, capital expenditures or CapEx from these large technology companies, and digital realty, we think is a really good way to play that. So digital realty owns and operates 275 data centers across more than 20 countries. And it's a really, simple and easy to understand business model in our view. They provide the power, the cooling, and the physical storage space for, network infrastructure. Some of their largest clients are the big cloud players, the social media companies, and telecom. So we think it's a good way to benefit from those trends and the long-term trend of just a more connected world. And it's not necessarily a dramatically cheap stock. It trades at about 24 or 25 times funds from operation, a little bit different metric for REITs there, but significantly less expensive than a lot of the high-flying tech stocks.
Dan, thank you. Dan I is Fort Pitt Head of Asset Allocation and Equity Research. I appreciate your time. And sorry if you hear my dog barking in the background right now. We want to turn to politics now and the intersection of politics and the economy, because Joe Biden is out with a new plan for something that he is calling the caring economy. It has to do with child care and the nation's caregiving economy. It's a big plan, pretty ambitious plan. Rick Newman has been digging into it. What stands out to you?
Well, he wants to improve elder care. This is not health care because that's covered under Medicare, but this is activities for seniors, home care, that's important. There are a lot of activities that seniors have to get on a waiting list for through Medicaid. So Biden wants to make these things more available to seniors, and he'd pay for it with, it's expensive. It's about $75 or $80 billion per year, and he would pay for this through by repealing taxes on commercial real estate developers. Can anybody think of a prominent commercial real estate developer? And he'd also go after high-end tax cheats. Also, child care. The biggest thing he wants to do there is establish universal pre-kindergarten for 3- and 4-year-olds. That is considered a really good move to boost educational outcomes all the way through the education system. And it's also a form of child care for parents, for working parents. So he wants to do that. He says this is going to create 5 million jobs. I think we should be skeptical of that. This, of course, would probably require a Democratic Senate. But Biden's basically just laying out a vision of all the things he's going to do for people if he becomes president, and Democrats sweep by taking control of the Senate.
Rick, I'm curious, politicians love to give away other people's money, especially in an election year. How do the Republicans attack this and say we can't afford it when we've seen a lot of Republican spending, but we're in the midst of an almost $4 trillion let's spend money like there's no tomorrow?
I think you're going to hear Republicans attack this with generalities. I mean, we've already heard the word socialism, Adam. I mean, this, Trump calls this fringe radical democratic socialism. It's not radical democratic socialism. It certainly is more, it's a more generous set of government benefits. And that's going to be that's the test for voters this year. Are they in a mood in the midst of this coronavirus pandemic and a pretty bad recession to say it's probably okay to tax businesses and the wealthy more to get more benefits for people, or are they going to turn against that? Don't know.
All right, well, to be determined then, and stay tuned right here. We want to take a look at a couple of stocks on the move. Thank you, Rick. Right now, one of them is Tapestry. The CEO is under a lot of scrutiny, or should I say the former CEO, because Jide Zeitlin is stepping down effective immediately as CEO of that company. Dow Jones is reporting there had been a board investigation into his personal behavior, that a woman in his past, about 10 years ago, alleged that Zeitlin had posed as a photographer to try to entice her into a relationship. We don't know what the outcome of that investigation was, but we do know he has stepped down. The chief financial officer at the company is going to be the interim CEO. Zeitlin, by the way, had been chairman since 2014. He became CEO last September and is one of the few Black CEOs in the Fortune 500. We're also looking at Philip Morris. That company came out with its earnings that beat estimates. Even as cigarette shipment volume fell 17.6%, but its heated tobacco business did well. Shipment volume there up 24.3%. So that is a stock that we are continuing to watch, and we'll be right back. Amidst the coronavirus pandemic, there has been a lot of discussion about the devastating effect in particular that it has had on minority communities. That is true as well of the LGBTQ community. And joining us now to talk more about that is Ty Cobb. He is the Human Resource Council Senior Director of Strategic Initiatives and Research. He's joining us from Washington right now. Ty, thank you for being here with us. So talk me through some of the numbers here and what we have seen, not just health-wise, but also economically as a result of the pandemic.
Well, that's great, and thanks for having me. I'm with the Human Rights Campaign, and when the pandemic first hit, we really looked at how we expected this to impact the LGBT community, and we thought it was going to have quite a disparate impact based on a couple of factors. One, we're employed in industries. 40% of us are in retail, restaurants, or in schools, and these industries are highly impacted by the pandemic. We're more likely to live in poverty as a community. We are less likely to have access to benefits like paid leave or access to medical insurance. And then also we're more likely to have conditions like asthma and other respiratory conditions that make the pandemic or the virus more deadly.
Ty, hey, it's Adam Shapiro. So what should be done? Because when we talk about everybody who's getting hit by this, I mean, you can slice it 1,000 ways. There are lesbian, gay, transgendered folk of color who are getting hit simply because they're people of color. I mean, is it government or is it going to be the private sector that steps in here?
Well, you're exactly right on all of that. We continue to do research with PSV Research and a series of polls to understand exactly how the community is being impacted. And what we found is that we're experiencing a cut of work hours that are greater than the general population. We're reducing our spending. There's more worrying. If you look at LGBTQ people of color, they're more likely to be unemployed due to the pandemic. And here's one stat to leave with you is, if you are an LGBT or a transgender person of color, and the general population is experiencing unemployment somewhere over 10% based on the pandemic, your likelihood as being a transgender person of color and experiencing unemployment is 1 in 4. And so I think these numbers matter because they help us create policy solutions that can actually support the community to ensure that benefits eligibility expands, and also that in new government programs that are being built, we ensure there are mechanisms to prevent discrimination.
And so what do those mechanisms look like, Ty, and how do you sort of build that into benefits and aid programs to try to make things sort of more equitable? I mean, one other stat that you brought us, I believe, is that about 1 in 5 LGBTQ adults in the United States live in poverty. The same rate amongst their straight and cisgender counterparts is 16%. So again, how do you sort of prevent discrimination or improve the system, the systemic issues, right, to bring those numbers down, those poverty levels down?
Right. Well, I think we hit several systemic issues, whether it's racism, transphobia, homophobia, classism. But really what we're looking at right now is we're seeing a aid package that's about to run out, and we're looking at the Hill and don't have a legislative solution for more aid. And so we're working on the Hill to continue to advocate we need to get more dollars in people's pockets and ensure that new programs that are developed within the various aid packages actually do not discriminate against LGBTQ people.
Ty Cobb with the Human Rights Campaign, thank you very much for joining us. We appreciate it.
Thank you.
And coming up, we'll continue to watch markets. We will also talk about what is going on with sports, specifically Olympic sports right now in terms of the delays and what athletes are doing in the meantime. We'll be right back. Many sports leagues are discussing how to get back. And in fact, some of them are already getting back without fans in the stands. Not true for the Olympics, however. We are still seeing a delay there until next year. Let's talk more about that. Not just the Olympics, but the Special Olympics as well. Ibtihaj Muhammad is a Special Olympics global ambassador. She's also an Olympic medalist in fencing. She is joining us right now. And so as we see these delays for Olympic athletes, what effect is that having not just on their training regimen and momentum, but also on their livelihood as we see these gaps in activity?
Well, the quarantine, I think, has been difficult for all of us, particularly for athletes. I can't even imagine what it's like for those who are in the middle of training, in the best shape of their lives, or even on the cusp of qualifying for their first, second, or third Olympic team. It's definitely a difficult moment, but I like to err on the side of positivity and say that this is a moment for athletes to continue to develop their craft and hopefully come out better and stronger for Tokyo 2021.
Ibtihaj, Dan Roberts here. Thanks for joining us. Just one more on the Olympics. Can you tell us a little bit, I mean, how many of these athletes might not be able to compete 1 year later if they were going to be able to? I mean, obviously, you know, you prepare for the Olympics to be a certain time. And of course, we should tell viewers, you know, fencing is a summer Olympic sport. And then you find out it's going to be a year later. And many of them, maybe you can just readjust. But for some people, you know, we had interviewed Justin Gatlin on one of our shows a few months back. They might be right near that age where pushing it a year means they might not necessarily be able to compete. I mean, how many athletes are dealing with that decision right now?
That's a really good point. I know for a lot of athletes who may have been on the edge of, you know, that age cutoff, now we'll have a bunch of athletes who are now eligible for the next Olympics. But like to Justin's point, you have athletes that were, you know, ready to start families or embarking on new careers, going to graduate school, and now having to either make that just tough decision of deterring those acceptances or maybe retiring altogether.
Yeah. And then while we have you, let's broaden this out to athletes and social issues. Obviously, you've been very outspoken, and it seems like during this time, people are finally starting to realize that, you know, athletes have that platform to speak out on social issues. I mean, it's funny, we had a guest yesterday pointing out when Nike got a lot of credit a few years back for endorsing Colin Kaepernick, and how very rapidly the shift has become that brands are realizing that, you know, they're going to get criticized if they don't, you know, promote that kind of thing and give athletes the space to speak out and support that. I mean, what kind of shift have you seen among athletes, whether it's Olympians or just athletes in the US pro leagues, in terms of realizing not only that it's safe to speak out about all the issues, you know, whether it's Black Lives Matter, everything we're talking about right now, versus a few years back, there was sort of, it was seen as for some a risk to their brand to be too outspoken on political issues.
I mean, we can rewind to 4 years ago where it was very taboo to, you know, speak about social issues, to acknowledge some of the issues that exist within the boundaries of our own nation. And what I love about this moment is that it is encouraging change. And even if that means on the side of athletes and really getting comfortable, being uncomfortable, using their platforms to be agents of change, I feel like I have been a part of this marathon my entire life as not just an African-American woman, but also as a religious minority in sport. It's been a difficult journey, but I love that more athletes are saying that this is our fight. And if we don't all come together and come together fast, just on the idea that things need to change, we need to be more inclusive, I think that we'll get to this destination of inclusivity a lot faster.
It's Adam Shapiro here. I'm curious, you're a global ambassador for Special Olympics, and I imagine you are in touch with athletes worldwide from the friendships you've made. And you wrote about what was happening in our country in 2017 from the perspective of the parents and special athletes who might be overseas, or even athletes who you are friends with from the Olympics. What are they saying to you about what's happening right now in our country? Because, for instance, the Black Lives Matter movement is worldwide. It's not just the United States.
Mm-hmm. Well, the disparities that we see exist that specifically have targeted the Black community, not just here in the US, but globally, it's something that's been happening for hundreds of years, right? It is systemic. And how do we change it? Like, what do we do? I think a lot of that can start and does start in sport. When we look at our younger athletes, I think that they are looking to athletes like Colin Kaepernick, even historical figures like Muhammad Ali, as their guiding light in this moment, and choosing to be agents of change is really important. And the sooner I think you're able to come to that decision, I think the better.
Hi, it's Julia LaRoche here. And we have you as a Special Olympics ambassador, also a medalist yourself representing the U.S. Tell us more about what you're doing with the Special Olympics. What can we expect and what's next for you?
So I've been working with the Special Olympics for a few years now. Michelle Kwan is one of my great friends. She's a longtime supporter and ambassador of the Special Olympics. And what I see in this nonprofit is just change and them wanting to see change for athletes and people with intellectual disabilities. One of the biggest changes that we've seen happen for the Special Olympics is a donation, a very large donation of $25 million over 4 years from the Crown Prince of Abu Dhabi to develop the Unified Champion Schools program in 6 different countries, 2 of which I've gone to, both Rwanda and Egypt. There's this message within Special Olympics that everyone belongs. And it's something that I've seen in working with them. Last year, we had the World Games in Abu Dhabi, and it was really nice to see these athletes from dozens of nations arrive and feel a part of the sport movement. And this is what I've always loved and appreciate about sports, you know, to promote inclusion, but also to push the messaging that, you know, we all belong.
You, a few years ago, wrote an open letter to President Trump in which you talked about the value of immigrants to this nation. And I'm hearing from what you're saying that obviously that goes for you across all different kinds of people, with your representation with the Special Olympics, with your religion, with your color, all of it. I'm wondering, with all the progress and all the attention that we have seen over the past several months because of the Black Lives Matter movement, how much do you think, to get a little political here, how much do you think President Trump has been an obstacle? And do you think that the country can really move forward on these issues while he remains president?
It's important for us to acknowledge that the current president that we have should be a representation of us and in the America that we want to see. And that strong messaging and the mission of Special Olympics is something that we can use as a nation, right, to cultivate inclusive mindsets, to overcome the fear of difference, and create cultures and opportunities where everyone's accepted, everyone's valued, and everyone's welcome. So I've always lived my life with that mindset, which is why Special Olympics seem like such a natural partnership for me. And to do so, not just for those with intellectual disabilities, but also for their families. And I don't like where we are as a nation right now because it does feel very divisive. But again, I am a person who likes to see opportunity in things. And this is an opportunity for us to grow and to change and be willing to change as a nation.
Ibtihaj, thank you so much for your perspective today. Ibtihaj Muhammad is a U.S. Olympic medalist and a Special Olympics Global Ambassador. Thank you.
Thanks for having me.
Well, coming up, we are going to talk about how perhaps the next tranche of congressional federal stimulus can be aimed at promoting a new economy, not just the old ways of economic growth. Steve Case is going to join us in just a bit. You're watching On the Move on Yahoo Finance. I'm Julie Hyman with Adam Shapiro. What should we do in terms of the new stimulus? How should Congress be approaching it? A new op-ed by Steve Case says Congress needs to stop solely backing efforts to restore the old economic reality and focus on how to develop a new one. Steve Case is joining us now. He is the Revolution chairman and the co-founder of AOL. He's joining us from Connecticut. Steve, it's good to see you. So what do you mean by a new economy in this particular case?
Well, first of all, Congress, I think, did a good job of moving quickly to try to triage the situation, stabilize the situation by providing some funding for existing businesses. That was important. But the reason why there now needs to be focused on new businesses, really young startups, is because that's where the jobs get created. Small business accounts for a lot of jobs, but not a lot of net job growth. Big business, Fortune 500, also accounts for a lot of jobs, but not a lot of net job growth. The net job growth comes from the young companies, the new companies, the startup companies. So now we need to focus on them and make sure, as part of this phase 4 package, that there is now focus on the startups, so we can really be focusing on the companies of tomorrow, really the industries of tomorrow, and be creating jobs for the future that will offset some of the jobs we inevitably will be losing because of this crisis.
Steve, it's Julia LaRoche. I know you have some experience working with the Jobs Act in the past and some other pieces of legislation. How hopeful are you that we will actually see some of these changes? And do you think that Congress understands the importance of the startup ecosystem in this country?
Well, some do, some don't. I did work on the Jobs Act, the Jumpstarting Our Business Startups Act 8 years ago. The nice thing about that, it did pass with broad bipartisan support. One of the things I learned is even though in Washington, D.C. this day, the Republicans and Democrats don't seem to agree on much, they do tend to agree when it comes to entrepreneurship, innovation, job creation. So I hope that momentum will continue as part of this phase 4 discussion. I think it's early to say what will exactly happen. Obviously, what I'm trying to do is make sure these issues are front and center and there is more focus on them, including on some of the legislation that's already been introduced, for example, in the Senate by Senator Klobuchar. One piece of her legislation would provide some Treasury funding to regional venture funds, so that would be helpful. So hopefully the focus will be more and more on these new companies that are going to be the big job creators, not just looking in the rearview mirror at the economy of yesterday. And part of that is because I hear a lot of it, we need to return to normal. We're hoping to get through this crisis and return to normal. I don't think we want to return to normal. Normal didn't actually work that well for a lot of people. We need to do better than that when we come out of this crisis. We can only do that if we're backing more companies that are creating new jobs. And we're doing that not just in places like Silicon Valley, but doing that all over the country. And only if we do it in a more inclusive way, including backing female founders and Black and brown founders, not just the white guys in Silicon Valley.
Yeah, it kind of reminds me of your book, The Third Wave, and just the acceleration that we've been seeing. And also, you just brought this up. What is like 75% of VC funding goes to the 3 states, Massachusetts, right, New York, and California. You've been doing a lot of work with Rise of the Rest. Talk to us a bit more about that and the importance of this and what it could mean for the social fabric of our country if we don't have meaningful action and bring jobs to some of these states that frankly just don't get access to the funding.
Well, part of my view of this third wave of the internet, when sectors like healthcare and food and agriculture, smart cities, things like that are kind of up for grabs, there's enormous opportunity for change, enormous opportunity for growth, including creating some very valuable companies. And they're going to acquire some domain expertise, understanding how healthcare works, understanding how farmers work. It's not just about the software, not just about the technology, there's a broader kind of cultural systems piece. That creates enormous opportunities for these rising cities all around the country that have largely been left out in the last couple of decades when it really was about apps, it really was about software, it really was about Silicon Valley. But we need to make sure the capital flows there because in the last 20 years, because there hasn't been much venture capital in most parts of the country, there haven't been a lot of breakout successes in most parts of the country. Most people in those parts of the country, whether they grew up there, went to school there, left. Massive brain drain to go to places on the coast. We need to slow that brain drain and create a boomerang of people returning. So that's why this capital piece and hopefully what Congress will do as part of this next phase 4 legislation will create the capital that can drive the creation of more regional venture funds, more of these companies in different parts of the country, Ohio, Pennsylvania, Michigan, Wisconsin, some great states, a lot of really talented people who haven't had the same opportunity other people have had on the places like Silicon Valley to start and scale companies. And as a result, their communities have suffered. And to your question, a lot of jobs do get destroyed. We need to make sure we're offsetting the jobs that are lost by jobs that are created. We've done that in the past. 200 years ago, 90% of us worked on farms. Now it's less than 2%. because we pivoted from the agricultural revolution to the industrial revolution. Now we need to make sure we're pushing forward on the digital revolution.
Steve, what kind of lessons from your own fund and how you choose with whom to invest could you give to Congress? And do you intentionally, with your fund, seek out people other than the white guys in Silicon Valley?
Well, we have three funds at Revolution. Revolution Growth, which is a later stage fund back in companies like Sweet Green and Convene and Clear, Tempest, Scopely, a lot of great companies. We also have Revolution Ventures, more at that Series A, Series B side. And then we also have the Rise of the Rest Seed Fund. And the Rise of the Rest Seed Fund is geographically focused. We invest outside of Silicon Valley and New York City and Boston. The seed fund invested in over 100 companies in more than 70 cities, more than 30 states. And we're finding remarkable companies that really do have the ability to go the distance if they get the capital and you can surround them with the right team. So I think I'm very optimistic about these rising cities, and many of the folks in Congress representing these states that have often been left out have a real opportunity if they put this legislation front and center around startups. Just the data on that, the last election 4 years ago, President Trump won 30 states. And if you added up all the venture capital that went to all 30 states, it was 15%, 15%. So when people talked about post-election, that part of what he was kind of connecting with a lot of people in different parts of the country that were feeling left out, they were feeling left out because they kind of had been left out. The innovation for the future, the jobs for the future were being created in other places, and they were seeing job loss in their families, they were seeing job loss in their communities. So that's part of the reason why, just from a national policy imperative standpoint, we need to make sure we level the playing field so capital flows more broadly to more people in more places, jobs are created more evenly across the country. We really have a more inclusive innovation economy that brings everybody along.
Steve, Dan Roberts here. While we have you, got to ask you about big tech and what's been going on. I mean, in your op-ed, you mentioned helping entrepreneurs and helping Main Street and small businesses, and yet, the biggest tech names have weathered the pandemic just fine, and the stocks have been surging. Facebook is one great example. I mean, we see a lot of headlines about the ad spending boycott. Hasn't mattered much to the stock. And there was a stat yesterday, something like the top 5 or 6 names in the Nasdaq now account for more than 50% of the value. I'm just curious your take there. I mean, it sort of was, FANG was the bet in stocks before the pandemic, and that has continued to be the case. And are they kind of too big now to fail? Names like Amazon, Google, Facebook.
Well, they're obviously amazing success stories, so hats off to them. But I do think they're starting to see, Facebook in particular, but other companies as well, more scrutiny. Indeed, next week there's a congressional hearing where the CEOs of the big tech companies will be testifying. Some of that is focused on some antitrust kind of issues, or should some of these companies be broken up? Some of it's also focused on, particularly in the case of Facebook, what should be done with these platforms in terms of, are they doing a sufficient job in terms of encouraging constructive versus destructive conversations. So I'm not surprised they're getting more scrutiny as they become much more important in parts of our society and much more important parts of the economy, even start influencing things like elections. It shouldn't surprise anybody that there is more attention paid to them. So they've done a great job building enormously valuable franchises and incredibly powerful platforms. They probably do, particularly Facebook, do need to do a little bit better job of shouldering responsibility they now have in our society.
And Steve, before we let you go, special purpose acquisition companies have become all the rage. I know DraftKings, a Revolution-backed company, that was how they were able to list publicly. What do you make of it now? Is that the way to go versus the traditional initial public offering?
I think it depends. There are companies that do prefer the traditional IPO path. We've backed a number of them. There's some even starting to look at the idea of direct listings. But for some, a SPAC is a way to consider going public, and that particularly worked effectively for DraftKings because it wasn't just DraftKings going public. As part of that, they're using the capital from the SPAC, the special purpose acquisition vehicle, to acquire another company. So they really all came together as part of that. So SPACs have a long history. I think they are becoming much more mainstream than they were before. The success of DraftKings, which is now $11-12 billion market value company, I think has demonstrated that. I know there are more SPACs being raised, and more companies, including some in our portfolio, who are talking to some of the SPAC sponsors. So I think it is a viable path to go public, but there are still some who will prefer the more traditional IPO path, and others that also might look, particularly if they're well capitalized, at a direct listing.
Steve, good to get some time with you. Steve Case is Revolution chairman. You can check out that Washington Post op-ed. That is the place where it ran. Thanks, Steve. Appreciate it.
Thank you.
We'll be right back. It is time for Word on the Street, where we check in with our panelists, find out what they are watching. Julia is watching Walmart's decision to close on Thanksgiving, but not only that, they are giving more cash to their employees. Julia, what does this look like?
Yeah, Julie, Walmart actually hasn't closed all of its stores on the Thanksgiving holiday since the late 1980s. Keep in mind, this is actually a time where they usually get a jump start on those in-store Black Friday sales. I know in the last 2 years, they've at least opened the stores at 6 p.m. local time. They have about 5,000 stores. Now, U.S. CEO John Furner put out a memo to all of the associates just announcing that, look, during this unprecedented and really challenging year for people who've really been working very hard on the front lines, he wants to give them all the day off to spend time with their families. And actually in the memo, he pointed out that this suggestion came from an associate at a store in Texas, and that they followed through with it. They thought, hey, this is a great idea. Walmart is also handing out cash bonuses. Year to date, they've handed out, with the newest round here, about $1.1 billion in special cash bonuses. The latest round will be about $428 billion. So if you're a full-time Walmart associate, you'll get $300 cash. If you're part-time or temporary, you'll get $150 cash. These are summer bonuses. You have to be with the company by July 31st. They will hit paychecks on August 20th. And this is in addition to their basic incentive bonuses. Also, drivers will get these bonuses, folks who work at distribution facilities, those sorts of things. The only ones who won't get the bonuses are the salaried office workers. So really, this is about the folks who are in stores, in the distribution centers, on the road, front lines of the pandemic here.
Hey, Julia, will other retailers follow suit? And might we finally see the end of the biggest falsehood in the world, the Black Friday chaos we always go through?
Look, I think it's a pretty good point that was brought up. You're talking about a totally different way of shopping. And I don't know. This is going to be a story I'm going to want to follow. I don't know if you're going to see the crowds rushing in like they used to. Maybe one prediction I'll put out there is I think e-commerce is just going to be off the charts this year for the Black Friday holiday season. Also contingent on how the overall economy is, how the consumer's feeling, those sorts of things. But I don't think you're going to see the crowds, at least not at this point.
Here's hoping that there's no more of those Black Friday stampedes. Dan Roberts, I immediately thought of you when the headline came out that Tenet was going to be delayed. And indeed, that's what you're watching, and the effect on the movie theater industry. It ain't good.
Yeah, it was the third delay, and this time no new date given, although interestingly, Toby Emmerich, who is the Warner Brothers studio chief, said there will be a new 2020 date given imminently. And interesting that he specified 2020. I mean, we all see where this is going, right? These two big blockbusters, Tenet and Mulan, have been going back and forth, pushing their theatrical releases a little later. And that came after, in May, Disney CEO Bob Chapek specifically said he was pleased that a competitor's big movie would be coming out 1 week before ours so that we can see how that does. Well, then that wasn't the case because Tenet delayed. That made Mulan first. Then Mulan delayed. So now Tenet has no official new theatrical release date, and Mulan is still set for late August. But I got to think Disney's going to push that further. And the reason it affects movie theaters is because, well, why reopen? Not to mention, of course, the pandemic and whether people will be comfortable going to theaters, but why reopen if you don't have a big anchor blockbuster to show for it? There are a couple of smaller indie films that are still set for a theatrical release in August, but I don't think those are going to end up coming out either. And then, of course, the inevitable next question everyone has is, well, could they just drop Tenet on streaming? You know, do it on digital download, or maybe they can put it on Warner Media's new streaming service. But man, it's a big, you know, Christopher Nolan action pick that was supposed to go in IMAX. I don't think they want to put that thing on streaming. I think even if they have to wait a year, they're going to want to put that in theaters.
I also wonder, Dan, how much control the auteurs have in these cases. In other words, would Nolan really protest if his movie was just going to be released in streaming, and how much pull does he have in making that decision?
Yes, I think he has more pull than others, and he's known to be pretty prickly and, you know, wants what he wants with his movies. What's interesting is Variety is reporting that now Warner Brothers is considering putting Tenet out abroad, outside the US first. And that's very interesting for two reasons. First of all, what if spoilers leak? Because his movies are kept very secretive and they usually have twist endings. But second of all, it would be a real brazen reminder of how America failed to contain the pandemic. I mean, if this American big budget blockbuster from an American director gets put out, you know, outside the US.
Yeah, it's a good point, Dan. All right, Dan, thank you so much. Julia, thank you. Adam, as always, thank you. And I want to remind you to make sure you tune in at 5 p.m. Eastern today. It's our special All Markets Summit looking at the road to recovery. Guests include the Surgeon General, Jerome Adams, and the Airbnb CEO, Brian Chesky. You don't want to miss that. Again, it's at 5 p.m. today. But there's much more Yahoo Finance coming your way. Keep it right here.
Welcome into live market coverage, everybody. You're watching The Ticker, and I'm Zach Guzman. And right now we have stocks mixed today. The Nasdaq in the red, off by about 0.4%. as the S&P and the Dow move into positive territory here. The Dow been trading up all day. Right now, the biggest gainer up by about 1.2% over in the S&P. The largest gains being posted by the energy sector, up nearly 6%, as crude jumps back above 41.50 a barrel, enjoying a nice 2% rally today. Of course, though, the Dow catching a boost from a 1-2 punch of optimism from giants in IBM and Coca-Cola, both delivering upbeat outlooks in their quarterly updates. And that seems to be the trend so far as we move further along in earnings season here. According to Refinitiv, of the 58 companies in the S&P 500 so far reporting, 77.6 reporting above analyst expectations, at least on the earnings front. That's pacing above the average over the last 4 quarters that we've seen, with about a 71% beat ratio. It's a similar story on the top line for companies reporting revenue so far. So that's a positive. Also, market sentiment was already catching a boost after the EU's executive arm, the European Commission, agreed to a 750 billion euro stimulus package. And that comes as a 4th relief bill is being discussed here in the US, as Republicans are set to have their first discussions with top Democrats in Washington, D.C. And we'll be chatting about that later on in the show, and why, if you did get stimulus checks already in prior rounds, why it's looking positive for you to get yet another round of stimulus checks. But we'll be chatting that later. But first, I want to dig into the executives from biotechs working on the top vaccine contenders, including Moderna, Pfizer, and AstraZeneca, and others giving their updates and vaccine timelines to the House Committee on Energy and Commerce today. The testimony being closely watched for a better sense on when exactly we should expect vaccines to be ready to hit the public. And for more on that, we're joined by Yahoo Finance's Anjali Khemlani, who's been watching that. And Anjali, seems to be going pretty positively there in the updates that we're getting so far.
Thanks, Zach. Yep, it definitely was a very robust and sort of widespread hearing. We'd heard a lot of different things, and while the focus was supposed to be on the safety and efficacy of these vaccines and the concerns around the sped up timeline and the FDA sort of expediting the process, and whether or not we can trust a vaccine that comes out of these companies, there were also other concerns about the supply chain and whether or not many of these companies are relying on resources in China in order to do this. And so a lot of those themes that have been discussed during this outbreak, whether you're discussing vaccine nationalism or supply chains abroad, and of course we saw how those were disrupted at the start of the outbreak. So all of this came together in the couple of hours long, I think about 3 now, and still a little bit going, testimony. We did hear from multiple companies, and the speakers included Pfizer, AstraZeneca, Johnson & Johnson, Moderna, and Merck. And so these are some of the key companies that we've seen in this race, as some of the larger players, as well as some of those smaller biotechs that have gotten the federal government support. And what was really interesting were 2 key points. One about the timeline and when we can, in fact, expect these vaccines to come out, as well as some concerns about really just where these are going to be not only manufactured, but also distributed. And also we had Representative Frank Pallone really bring up some interesting points. So take a listen to what he had to say.
I think right now they say the vaccine has to be 50% effective. But let's say, let me give you a scenario where the FDA changes its guidance and says, oh, it only has to be 20% effective or 10% effective. Or they keep to the guidance, but you know that yours is only 10 or 20% effective and they approve it anyway. What would you do as manufacturers to help us out in that regard, on the assumption that we can't trust the FDA?
First of all of our interactions with the regulators have given us no evidence that they're lowering the standards or thinking about lowering their standards. Secondly, as a company, we will always think about safety and efficacy first and foremost, and making sure that we have an effective medicine.
So definitely hearing about that safety and efficacy, that has been the concern, and concerns about whether or not the FDA will be able to deal with political pressure to let go of a vaccine as soon as it is proven successful. Zach?
All right, the update there from Yahoo Finance, essentially. Kamani, appreciate you bringing us that. Meantime, there is a little bit of optimism here as we've seen the overall case count fall here in the U.S. over the last couple of days after we hit new highs over the weekend. So people hoping that we're moving in the right direction there, as we again are still months away from even the earliest timelines here and seeing that vaccine come through. So for a focus on what we need to do in the interim, I want to bring on our next guest here, Dr. Adrian Burrows, family medicine physician and CFP Physicians Group CEO, joins us right now. Dr. Burrows, I first just want to ask you about the update that we got a little bit ago from the New York Times reporting on some new CDC data showing that the number of people infected with coronavirus in parts of the U.S. is potentially as much as 13 times higher than what we're seeing in terms of positive case counts right now. So what would you, I guess, point to in terms of how we should be looking at how the cases could actually be way higher than what's being reported right now?
Well, I think that, first of all, thanks for having me on. I appreciate that. I think that for certain we have more people infected than we're aware of. I think there are a lot of people who are asymptomatic, as you know, that are positive for COVID-19. There are plenty that have mild cases that don't feel the need to be tested or self-quarantining. So I do think the numbers are much higher than are being reported.
Yeah, I mean, on that front, I guess it's kind of, again, this kind of back and forth between you have people saying, look, we shouldn't be shutting down over this disease because it's, if there are more people out there who actually have it and aren't dying, then it's not that big of a deal. But then again, you have the other people on the other side, especially in the medical community here, talking about how the stresses that's being placed on the healthcare system is really why this is so problematic. And we're seeing that right now in your state as well. Hospitalizations in Florida rising 2.4% today. That would be an increase of 517. That would be the most on record so far in Florida. So how stretched do you think that the system is becoming in states like yours? And is a full shutdown needed to avoid some of these stresses going too far?
And that's a wonderful question. So Florida has had 28 consecutive days above 5,000 cases. We've had several days above 10,000 cases. Today we had our maximum in terms of our high in terms of hospitalizations. In my area in Orlando, Florida, where I am, we are definitely stretched to capacity. We have several of our major cities that are in that same situation. So that is why we stress to the public, and then you'll hear many doctors say the same thing that I'm saying, that it's imperative that not only they take it seriously, but that the government actually consider potentially shutting down if this persists.
And I guess, I would just stress too, and I don't want to be alarmist. We never want to be alarmist on this show, but really the summer was I guess, kind of the time people were optimistic that we would see this as our window to really prepare for what a lot of people are afraid will be a secondary peak when we hit the fall and winter. And on that front, of course, the ongoing discussion that we've been having here is what's going to happen with schools reopening. We got the update from the governor of Missouri, Mike Parson, downplaying the risks for kids out there, catching a lot of heat for his idea that the kids have to go back to school no matter the circumstances, and that if they get it, the kids will be able to get over it. So what's the way that you think people should be looking at the risks associated with going back to school? As we know, there is still that risk of maybe kids coming back and bringing the virus into the house, infecting more susceptible populations in the elderly.
And I've always tried to err on the side of being conservative when it comes to things we don't fully understand. And coronavirus information has varied almost day to day at times in terms of what we think is happening and what is actually happening. The reality is I'm a firm believer that everyone should take every precaution possible to not contract COVID-19, wearing masks, social distancing, etc. If I'm wrong, which is possible, then the worst thing is that you're outside wearing a mask when you don't need to. But for the people that are saying that it's okay to go back, what if they're wrong? That's what my problem is, because they have the potential to be causing a worsening of the greatest pandemic we've ever seen.
Yeah, and that's obviously what a lot of people want to avoid here. But a lot of that comes back to testing and making sure that those who might be what we're talking about here in kind of those asymptomatic carriers, we've seen a lot of super spreader events tied to people just like that. So obviously testing becomes important. I understand even in your practice, you waited longer than a week to get some of these results back, and the backlog in testing is something that we've heard a lot of complaints about. Myself here, waiting in New York about a week for antibody testing. So what have you seen on the testing front in Florida, and how that has continued to be a problem here in really trying to get a handle on this if you do have someone who is positive?
So testing was a big problem. Having testing supplies was a big problem at the beginning. Now the problem is the processing of the tests. The issue is that we are running the tests, but the labs are inundated with so many tests that they don't have the capacities to run them. They're outsourcing the labs to other labs to process and run these tests. And in one case, I had a patient that waited 16 days to get a result. Well, you know, the normal quarantine period is 14 days. So it's hard to have someone quarantine themselves beyond that 14-day period when they don't have a test result. It's hard to contact trace to identify all the people they may have come into contact with if they're positive when you're waiting this long. And that's just because the system is just completely overwhelmed, especially here in my state.
Yeah, it also kind of makes it a moot point if you can just quarantine for 14 days and really, you know, wait that long for a test. But you are in Orlando, and on the topic of tests, we have been seeing the NBA in terms of preparing to bring their season back here, obviously testing a lot of their players and doing so with private labs, but also on an expedited timeline. They don't have to wait that long to get their tests back. So when we think about the criticisms of that, as a lot of people continue to wait, is it really a zero-sum game here, or is that the way the public should be looking at this and maybe, I guess, pushing back on some of the criticisms here that the NBA is taking tests out of the hands of the public? What's your thought?
Well, yeah, so, you know, I have been very open about this topic. I'm a huge NBA fan, hardcore, Orlando Magic fan. I'm a huge MLS fan, but these pro sport leagues are in my town. They're testing themselves daily to semi-daily, which I think is an overutilization. The NBA reported that they had no positive COVID cases in their bubble. So if it's truly a bubble, then and you're not having any positive cases at this point, why are you continuing to test and, in my opinion, overutilize the system? You know, we're about to have a decision that parents have to make to send their kids back to school. Every parent would love to have their kid tested every day and know that their child is sitting next to another child that's negative for COVID. They don't have that luxury. So I think that when you're dealing with these pro sports leagues that are utilizing these tests this way, I don't believe that that's right at all.
And not only that, but as you mentioned, they're in a bubble, and really that's kind of the fears here and why you would need to test if you're interacting with people who haven't been tested. And as you're talking about schools, that's obviously a very different flip side of the coin when you're dealing with teachers and kids going home and back and forth. So it sounds like it'd be a very different situation than the one we're talking about here. So what do you think might be needed when we think about other resources coming down the pike here in this fourth wave of a stimulus bill? A lot of things being discussed, the White House saying that they won't get in the way in blocking resources going to testing and contact tracing. But what more do you think at this point is needed to be certain about reopening schools?
Well, so I think that, first of all, we have to decrease the burden that's on the labs currently. So for the labs that are over capacity, perhaps using labs that are in another state that are not at capacity, you know, and a state that they have less COVID cases and maybe more availability to run the labs, have the labs transported from my state to another state. You know, doing those types of things, trying to make the teachers feel comfortable, because in my state, the teachers are not comfortable. They're suing our state because they don't feel like everything has been done properly to ensure their safety as teachers. It's a big problem that, you know, and I give people credit for trying different things, but I don't think that we're anywhere near close to being prepared for the start of the school year.
And a lot of people are very worried about that, as it's already July 21st. And every day you get a little bit closer to opening back up. Dr. Adrian Burrows, appreciate you taking the time to chat with us today.
Thank you very much.
All right, we're going to take a quick break here. On the other side, digging into what Republicans and Democrats might be able to agree to and why stimulus checks are very much on the table. If you believe Senate Majority Leader Mitch McConnell will bring you those updates from Washington, D.C. right after this. Welcome back to live market coverage here on the ticker as we await what could be agreed to in a fourth round of relief after the CARES Act here. Today, Treasury Secretary Stephen Mnuchin, as well as White House Chief of Staff Mark Meadows, met with key Republicans here to get everyone lined up before meeting with key Democrats. And if you believe the leader of the Senate, in Mitch McConnell, it sounds like stimulus checks are very much on the table here for both sides to agree to. And for more on what we should be watching, I want to bring on Yahoo Finance's Jessica Smith, who has more details from how these talks are going. Jess?
Yeah, we're starting to learn more about the Republican proposal that Majority Leader Mitch McConnell says is a starting point for negotiations with Democratic lawmakers. On the Senate floor today, he talked about some of the things that are going to be in the GOP plan. He says $105 billion for reopening schools, more money for childcare, a second round of targeted PPP so that those loans for small businesses who are struggling amid the pandemic. He also said a second round of direct payments, but he didn't say who would be getting those stimulus checks. He didn't provide a lot of details there. In the past, he has said that he would maybe like to see that threshold be lowered to $40,000. So people making less than $40,000 a year being eligible for those stimulus checks. He also talked about liability protections. That's something that the president and Republicans have really been pushing for. But McConnell on the floor today did not mention a payroll tax cut. That is something that the president wants to see, but Republicans on the Hill are not fans of that idea. It's not a very popular idea on Capitol Hill at all. There's also some contention about funding for testing and funding from schools within the Republican Party. So they still have some things they need to work on amongst themselves before they can start negotiating with Democratic lawmakers. And on the Senate floor, Minority Leader Chuck Schumer spoke about that division. He says the reason our Republican colleagues have taken so long to put even this inadequate proposal together is because they are paralyzed by internal divisions among themselves and by division with the president. So he did say that the current GOP proposal falls short and lawmakers should be working on it together instead of having a Republican plan first. He is set to meet with Mnuchin and Meadows along with Speaker Pelosi at 3:15 this afternoon. Zach?
Yeah, let's not forget too, I mean, we talk about how far apart these sides are. There is a dollar figure attached to this too. When we think about Republicans eyeing that $1 trillion mark, and then the HEROES Act with Democrats in the House put through at $3 trillion, there's a large gap between what really they're pushing for. So, I mean, what do you think are the biggest cost associated items there that might be prohibitive in getting agreement between Republicans and Democrats?
Yeah, there are a lot of things that the two parties really have to work on. The one that's just top of mind for me is those enhanced unemployment benefits. Those end at the end of this month. The people stop receiving those payments at the end of this week on the 25th. So that's something they really need to address. And it seems like they're kind of far apart on this. Republicans want to phase those out. They don't want people making more at home on unemployment than they would at work, but Democrats say it's keeping people afloat and they want to extend those. The House voted to extend those through January. So we'll see what kind of compromise they land on in the coming days.
All right, the latest there out of Washington, D.C. from Jessica Smith. Appreciate you bringing us that. It's also not only those added uninsurance benefits that we're waiting to see in terms of things rolling off at the end of the month. Another key component of the CARES Act was an additional 120-day moratorium on evictions, and that is expiring on July 25th as well. So we are seeing increased concerns in a lot of cities across the country, some states coming out to bridge that gap, but a lot of concerns about what could happen if that also expires. And for more on that, we're joined by our next guest, Peter Hepburn. He's an assistant professor of sociology at Rutgers University, Newark, as well as a research fellow for the Eviction Lab at Princeton University. And Professor Hepburn, when we look at this, I mean, this is something that the Eviction Lab has been tracking in a lot of towns that have been, I guess, infamous for high eviction rates. And you're starting to see potentially signs that as that moratorium rolls off, that you could see a lot more evictions. So what are you watching right now, and what is the early data telling us?
Yeah, thanks for having me on, Zach. We're very worried about this in cities across the United States. What we've tried to build at the Eviction Lab in the last few months is a system that allows us to track eviction filings in real time and to see how many new cases are coming through the courts in a given week. And what we've seen is that those new eviction filings declined precipitously in the middle of March and have stayed below historical averages since then in most cities that we're able to track. But as local moratoriums have been phased out and as courts have started to reopen, those numbers are increasing. We're seeing increasing number of cases in Houston every month. That's doubled between April and May, and then doubled again from May to June. In Milwaukee, the state of Wisconsin was covered by an eviction moratorium until the end of May. Within the first week of June, new eviction filings had spiked to above historical averages.
Yeah, and we saw that just looking at your report too, about a 10% jump over the last 4 weeks after we saw that moratorium roll off. There are, as you said, some other places that have kind of gone in the reverse. Tucson, which makes your guys' top 25 list for cities in terms of eviction rates. The state of Arizona, Governor Doug Ducey there, extending his executive order that put a stay on evictions until October 31st. That was set to expire pretty soon here, so kind of coming down to the wire. But when we think about the position of some of these states and cities to really extend those, how much of that is really tied to additional funding that will come from the federal level, and thinking about how the CARES Act actually helped prolong protections here for a lot of renters?
Yeah, absolutely. I mean, the best estimates are that the CARES Act eviction moratorium covered between 28 and 45% of renter households in the US. So that, I mean, at least a third of renting households were effectively covered by that moratorium, which provides an enormous amount of protection from the federal level. State and local moratoriums help to protect additional renters. When you look at other solutions, and especially emergency rental assistance, which has been instituted in many cities and counties, we haven't seen a concomitant effort at the federal level. And one thing that we hope to see in the coming weeks as these negotiations proceed is some sort of federal emergency rental assistance program.
Professor Tu, the other interesting question that a lot of people are talking about here, and we talked about this yesterday on the commercial side, is really your alternative options here. When you think about how everyone is kind of going through the same issue right now in this pandemic, and for malls, there's not really other stores to turn to if you have someone who's going bankrupt and needs to move out of the mall. But on the residential side, you think about renters. I mean, is there kind of also a want from a lot of these landlords to really keep renters there, at least like we've seen in the last few months, to really kind of just, I guess, weather the storm until things improve, hopefully in the latter half of the year?
Yeah, I think there's a microeconomics argument that says that it's better to try to work with your existing tenants and to try to get the rent that you're able to get, rather than to look for new renters at a time in which so many people are experiencing economic hardship.
And lastly, you talked about which cities might actually see if this is to roll off and nothing is here to replace it, because there's no guarantee that we're going to get an agreement here in the week and the end of month that Secretary MNUCHIN has really laid out that he's hopeful for in terms of getting this fourth round. But when you look at it, what cities in your mind stand to lose the most if we don't get additional support here to protect renters?
I think there's a lot of reason to be worried about the mid-sized cities. So with the sort of bigger superstar cities, there are at least some local resources that can be put into place to help renters. When you're looking at mid-sized cities in Virginia, in the Carolinas, in the Sun Belt, these are areas with a lot of evictions under normal circumstances, and also cities that may not necessarily have the resources available to help renters at this time.
All right, so we'll be watching. Again, a lot of reasons to hope for extended benefits under what was created in the CARES Act, but we'll see what happens. For now, I'm going to leave it there. Professor Hepburn, appreciate you taking the time to chat.
Thanks for having me on.
All right, coming up, we're going to be digging into the racial wealth gap here in this country, as again has been a main issue of focus, especially this being an election year, including plans to address that from Democratic nominee Joe Biden. We'll be getting into later on in the show, but we'll join Moody's Vice President and former U.S. Treasury Senior Advisor for more on that, digging into their latest report, some shocking statistics coming up right after the break. Welcome back to live market coverage here on Yahoo Finance. You're watching the ticker as we've been tracking all day. The Nasdaq continues to trade in the red as the S&P 500 gets boosted by some serious gains right now in the energy sector, up by about 6.5% as crude oil enjoys a 2.25% rally today. On the Dow, we are still seeing that as the largest gainer today, up more than 1%, being led by optimism after IBM and Coca-Cola, two major components in that index, delivered some optimistic updates for investors. And right now, I want to dig into another issue that's been talked about a lot lately when we think about economic inequality here in the United States, and mainly the fact that Black households have not seen things improve here over the last few years. When we think about the gap between median wealth in Black households and white households, shockingly, a 10 times gap here when we think about how much wealth has been accrued in white households versus Black households. And more on that, we're going to dig into it right now. William Foster, Moody's Vice President and former U.S. Treasury Senior Advisor. And Mr. Foster, I mean, when we look at it, it's shocking because a lot of Americans don't really understand that the gap is so wide. But why do you think we've seen that gap not really close over the last few years?
Well, there's one broader overarching trend that we see, what we've seen in recent decades is just inequality broadly in the U.S. has really widened, and it continues to rise relative to other advanced economies. And within that, when you look at the data, there's also significant race disparities. In particular, Black households have seen very little increase in median incomes and wealth levels relative to white houses in particular. And so these are important issues to really try to better understand what the drivers are ultimately, and that's in part why we're seeing obviously ongoing debate as to what the policy options can be moving forward to try to make this a more equal society. But there are many different contributors that we've seen over the years to the broader theme of inequality in the U.S. Obviously, there's been globalization of both labor and capital, automation of labor, the decline in the power of labor unions, and education has been unequal. And credit, access to credit. So those are some of the key themes.
Yeah, you talk about access to credit. That's another thing here that we've talked about in home ownership. 44% of Black households owning their homes compared to 74%, so a much larger percentage for white households. But when we talk about this, I think this is kind of why we're seeing localities across the U.S. start to move closer to adopting reparations, because even closing the income gap likely wouldn't be enough when you think about how long this gap has existed. You can even look at inheritance too, something else you highlight in your report here. In 2016, 8% of Blacks inherited wealth, only averaging about $83,000 compared to 26% of whites averaging $236,000 in inheritance, 2.8 times there, the gap we're talking about. So, I mean, is it enough to even talk about income inequality? Because that doesn't seem like it's going to do enough to address the data you're highlighting here.
Well, you're talking about housing, right? In particular, in terms of the wealth of the average U.S. household is really driven by the value of their home, and there's been disproportionate access to credit, mortgages to buy those houses. There's been historically challenges and legal impediments and barriers for Black households to enter certain neighborhoods, and this is a long legacy, obviously, throughout U.S. history. And ultimately today, that's what we're seeing as a product of that. And wealth accumulation has been driven in part by the value of those homes and, of course, financial assets as well. And so there's a much longer history to this, of course, and in terms of what the answers are to try to ultimately address these issues in a meaningful way today. That's a very difficult question, and it's going to take consensus and approaching it from various perspectives. But reparations is one, but there are many different ways in terms of forward-looking policies that need to change as well for future generations.
I think as we're having these discussions, what's interesting to me too is seeing kind of the growing understanding of this, not just in those communities of color, as you're saying. A lot of these problems don't just affect Black Americans, but also Hispanic Americans as well as other societies of color. But when we look into kind of the shifting perceptions from society as a whole, that was one focus point on the Wall Street Journal new NBC News poll digging into this, saying that nearly 3/4 of Americans, roughly 71%, believe that race relations are either very or fairly bad. That was a 16-point increase since February, as a lot of these discussions have now made it into the mainstream when we talk about gaps in this country. But one final question to you, and it's one I've been grappling with here when we think about some of the policies passed in kind of stemming the economic pain here in the pandemic. One of those programs applauded by both the left and the right has been the Paycheck Protection Program. But as we've highlighted on the show, not a lot of minority business owners really out there. We've seen a much smaller representation in that space. So when we think about billions of dollars going to support businesses, is that something that might actually in the long run, might actually grow the divide we're talking about here?
Well, I think in the end, what do businesses do? They provide employment opportunities in addition to obviously the benefit the entrepreneurs themselves. So I think we have to think about it both in terms of the source of jobs and as well as the business themselves. And we don't want to be in a situation economically where we have ongoing bankruptcies or increasing failures in small and medium enterprises. But of course, looking at those issues as you're talking about in terms of who the entrepreneurs are and making sure that there's a level playing field in terms of access to credit, access to benefits from the government and protection programs. Those are all very important questions. But I think we need to look both at keeping those businesses afloat as well as the employment issues that are around that, which certainly are very important for everybody involved.
Yeah, it's a very complicated issue, and it's certainly not one we're going to solve here with a 5-minute segment, but appreciate you guys digging into this and bringing us the data because it does kind of serve to move the conversation forward. So thank you for that. William Foster, Moody's Vice President and former U.S. Treasury Senior Advisor. Thanks again for taking the time. We're going to take a quick break here on the ticker. And before we go, a reminder to stay tuned for some pretty exciting coverage we'll be bringing you today at 5 p.m. Eastern Time. We're going to kick off Yahoo Finance's All Market Summit Extra, The Road to Recovery tonight. Bring you some pretty key names here. The CEO of Airbnb, Brian Chesky, will be joining us, as well as Arnold Donald, the CEO of Carnival there, for an outlook on what the cruise industry is dealing with through this pandemic, as well as an update from Jerome Adams, U.S. Surgeon General, will bring us the update on how this country is battling back the coronavirus pandemic, at least in his eyes. So stay tuned. All of that coming your way, kicking off at 5 p.m. Eastern Time right here on Yahoo Finance. Much more coming your way on the ticker right after the break. Welcome back to live market coverage here on the ticker. Of course, as we've been highlighting, a lot of concerns right now about the, I guess, the timeline to bring schools back here in the fall concern parents as well as teachers. Let's not forget the students as well, not just high schools and middle schools, but also higher education grappling with what the fall school season is going to look like when it kicks off. and a lot of opportunities here as we've seen workplaces shift online. What else could be happening there as we think about education moving online as well? Here to discuss that with us is the CEO of one of those four sought names in the education space, 2U, a company with a market cap near $3 billion, an American educational tech company that contracts with nonprofit colleges and universities to offer online education programs. And the CEO, Chip Pausak, joins us now. And Chip, when we look at this, I mean, this is something that we've seen, obviously, Zoom, one of the companies we talk about a lot on this show, catch a big boost. That stock is up nearly 300% year to date. You guys are up 90%, but clearly after you gave investors your update in the first quarter, it seems like the opportunity right now is rather large when you think about online education. So what are you seeing in that space right now?
It's been an extraordinary 3 months. I would say over the last 3 months, we've spoken to more presidents and provosts than we had in our entire 12-year history. So this is definitely a paradigm shifting moment for online ed, without question. And as people get ready for the fall, to do something really high quality, you have to do it differently than you did in the spring. You can't just put people in a Zoom room. We love Zoom. Zoom's been a great partner for 2U, but you have to have sort of curated path of content for students to flip the classroom and allow students to experience high quality content on their own time in a curated manner from the faculty member. So when they come to class, it's really engaging. It's a small classroom where you're actually answering questions. You're having a dialogue between faculty and students. And we think many of our great partners are jumping right in. So we recently announced a relationship with Amherst. We're taking 40 classes of Amherst fully online for the fall. And then what we're also seeing, Zach, is across our historical portfolio programs, this is absolutely a share shift towards online education. So we'll show that in a survey that we're announcing next week. About 86% of prospects that engage with 2U have shown that COVID is impacting their decision directly to think about online instead of a campus program. So it's a big deal right now.
No, for sure. And when we think about the trade-off, we've had a lot of educators on this program to talk about kind of the trade-offs between online learning and, in classroom learning. Obviously, it's different when we think about the age groups we're dealing with. I'm not sure how helpful the online learning has been for first graders or kindergartners out there. But when we think about higher education, what do you think people are missing about the shift to online learning? Because it gets poo-pooed in a lot of circles. But what do you think about the opportunities there? As I said, Zoom up 300%. You guys only up 90. What do you think investors are missing about how colleges are thinking about shifting these things using 2U for it?
I would say, so I co-founded the company 12 years ago, and we've been doing this a very long time, and we do it quality at scale. We're talking about 225,000 students inception to date. We've done over 800,000 live classes inception to date. And one of the things that's a little frustrating at times is it's almost like we're talking about the fact that we just discovered the internet and now we're all doing it for the first time in the context of higher ed. And it's just not true. Like, I graduated from a 2U back program. So I graduated from MBA at UNC, a top 20 MBA program that we run with Carolina's Business School. Incredible place. And it was awesome. Like, not a little awesome. Like, if you do it well, it's really good. It can be not only as good, but candidly, like, our data shows that it can be better in many ways. So you get an incredibly diverse set of classmates. You can open the doors to people that simply couldn't pick up their life, quit their job, and move to attend. And you get not only the same content quality, but the same brand affiliation, because you really become fully indoctrinated into the school when done well. So one of the things we like to think is that we actually help the school not just deliver its content or market the program or provide the technology infrastructure, but really bring its full ethos and its full spirit to the table when you think about how to do online well.
Yeah, well, let's talk about the financials too, because obviously people who watch this show would be very interested in that when you think about the opportunity here. And last update in the first quarter, you guys reported revenues up 44% versus last year, but costs grew at a little bit of a quicker pace there, up 56% over the same time period. So what's your take on maybe why that is? Because we saw you ended the quarter with $157.5 million. That was down about $32 million. So maybe some questions about cash on hand here. How should people be looking at how you're investing in the opportunity right now when we think about the pandemic and how it could lead to profitability later on?
I would say, we're really, as we think about growth in the future, we're really balancing growth with profitability, and we're being very careful about how we're selecting new opportunities to pursue. Now, obviously, right now, there's a lot of opportunities. So we're being thoughtful about that. Now, we've got an earnings call in a couple of weeks, and I'll get into this in much more detail after the earnings call. So, Zach, you're just going to have me back. I think that would be part of the plan here.
Yeah, and when you think about it, I mean, we've seen a lot of companies right now, Nikola, one that we've talked about quite a bit in terms of raising a lot of money because they understand the opportunity is now. That obviously very different, but same kind of thinking here. When you see an opportunity, you want to go all in. So what's kind of the thinking there as you see a bunch of colleges right now shifting to the online platform? How hard are you guys looking to attack it?
Well, I mean, I don't think we've ever been this well positioned. We put the university front and center. So we are a partner to 75 incredible institutions. We just announced in the last 2 weeks, we announced Ohio State, we announced Amherst. We offer graduate degrees, undergraduate degrees. We have our London School of Economics degree launching in October. That's our first undergraduate degree. We have Simmons University launching in January. So we do think this is a really large long-term opportunity. It's a global story. It's not just a US story. And we're pretty excited about where the company is positioned.
Yeah, let me just push this a little bit further, just if I may, before we let you go, just because the net losses there just jumped out to me when we saw last year, 2019, 235 million. That was up from 38.3 and 29.4 the year prior. So what's really going on in terms of why that net loss continues to grow?
Well, we did make a very large acquisition last year. We acquired a company called Trilogy Education that is not only a workforce accelerator, but provided really high quality technical boot camps, and the only company doing it with universities at scale, over 50 different partners. We think that technology training is not only relevant last year, but if you think about where we are today, where about a third of Americans say to get the next job, they're going to need retraining, and there's great jobs available in the technical field. So, everything from fintech to coding to project management. So a lot of it has to do with our acquisition of Trilogy last year. We think that positions the company incredibly well going forward.
Admittedly, I mean, when you think about the scale you guys are operating on, as we were talking about before we brought you on, a lot of new updates out there, a lot of new partnerships with a lot of universities. So we'll be watching when you do report. Chip Possack, to you, CEO. Appreciate you taking the time.
Thank you, Zach.
All right, we're going to take a break here on the ticker, but coming up, digging into the program being laid out by Democratic nominee Joe Biden, what he's looking to put $775 billion to work for in potentially guaranteeing universal preschool. We'll dig into that plan right after the break.
Hey, thanks, everybody.
Thanks, Chip. Appreciate it, man. Good luck with everything. Welcome back to live market coverage here on the ticker. As President Donald Trump's approval rating, particularly his handling of the economy, continues to slip, we are getting updates from Democratic nominee Joe Biden in terms of what platform he's looking to establish there. And the latest update brings what he calls a return to the caring economy, the third plank of his economic plan, looking to set aside $775 billion with preschool in mind, as well as other services for the elderly. And here to discuss that is Yahoo Finance's Rick Newman. And Rick, really kind of looking to establish benefits here for both very young parents and also the elderly.
I think you could just go ahead and say benefits for everybody. I mean, that is basically the Biden plan. Everybody below $400,000 in household income, I guess you could say, that's his threshold for where you start paying more taxes instead of getting new benefits. But yeah, so he's got a new plan. It's $775 billion over 10 years, so call it $80 billion per year. Lots of new services for seniors. It's not healthcare per se, because that's covered by Medicare, but it's things that aren't covered by Medicare: home care, community services, activities for seniors, and these would be targeted at underserved populations. There's apparently a waiting list, according to Biden, of 5 years for people trying to go through Medicaid to get some of these services. Just things to connect seniors to their community, make sure they're doing okay, enrich their lives a little bit. And then on the younger end, as you mentioned, some big childcare initiatives. Probably the most important of those would be universal pre-kindergarten for 3-year-olds and 4-year-olds. That is proven to have really solid benefits for kids that go all throughout their education system if you can get them started sooner. And it's also childcare to some extent for working parents. So Biden's helping both ends of the age spectrum here if he can get this done.
Yeah, and it's not exactly the time, the era that we're in. No one's really asking the questions of how do you pay for anything when we think about government plans here. But this one seems to be scant on details. What are the tax kind of changes that he's looking to kind of help fund a program like this?
Well, he does have a so-called pay for. He says he would repeal certain real estate taxes, tax breaks for commercial real estate investors. Can you think of any prominent real estate investors that might affect, Zach? So, there are a lot of tax breaks that really do benefit developers. You can defer losses for years and things like that. And then also, he also says he would close the so-called tax gap. This is people who just don't pay their taxes the way they should. Enforcement for that at the IRS has been pretty lax. These are sort of like golden oldies when you want to say how you're going to pay for something. This is basically, I'm going to cut down on waste, fraud, and abuse. This generally doesn't happen. So skepticism is appropriate for any huge plan like this. But Biden is doing a pretty good job of differentiating himself from Trump. I will say that.
Yeah, close the loopholes. We've seen that even when we talk about Republican tax plans as well, and thinking about corporate tax rates getting slashed and hoping that it would bring money back here. We haven't necessarily seen that play out on the scale that it was promised. But when you think about Joe Biden, the strategy that Democrats are playing right now, some people have said that he's been pretty scant on actually announcing plans because it's better for him to kind of just play the foil to President Trump right now anyways. What would you say is true or false about that as we continue to hear a little bit more details about what he's planning on doing?
He is in the process of basically rolling out his 2020 agenda. Now, he already had a lot of plans on the books going back to 2019 in the primaries, and that's how he competed against 20-something other Democrats. And he was able to position himself as a more moderate candidate than, say, Bernie Sanders or Elizabeth Warren, and that was based on plans. But that was also before the coronavirus pandemic. So we really do have a different economy now. We have something like 20-something million people have lost their jobs. A lot of people have lost healthcare coverage along with their jobs. We have a lot of new holes in the safety net. So I think Biden is now tailoring his plans for general election voters based on changes that are happening in the economy. And also, I'm sure he and his team are looking at what Trump is having to say and what Trump is proposing or not proposing, and looking for opportunities where they can get voters' attention away from Trump.
Yeah, just think how far we've come from earlier in this election season of a fringe candidate, Andrew Yang, talking about universal basic income, to now Senate Majority Leader Mitch McConnell saying that he's all right with another wave of stimulus checks.
Dude, some of us have been covering this for like 15 months.
I know, it seems like it's been forever.
Early 2019. So yeah, think how far we've come.
long time already in this year. But Rick Newman, appreciate you bringing us that.
Yeah.
Going to take a quick break. On the other side, digging into one of President Trump's nominees for the Fed, why it looks like she's slated to get approved despite a controversial pass, at least by Fed standards. We'll dig into that right after the break. Stay with us. Welcome back to live market coverage here on the ticker. Today, we're digging into some interesting updates in terms of President Trump's nominees for the Fed. Judy Shelton, one that's been being discussed for a while, looks like she might have a green light. And for more on that, I want to bring on our Fed reporter, Yahoo Finance's Brian Chung, for the latest. Brian?
Well, Zach, in only a few minutes, the Senate Banking Committee is going to determine the fate of two of President Trump's nominees to fill the Federal Reserve Board of Governors. That's St. Louis Fed economist Christopher Waller, in addition to former Trump transition economic advisor Judy Shelton. Both of them will face a committee vote, and it'll likely be on party lines. The reports are that John Kennedy, a Republican from Louisiana who previously had reservations about particularly Judy Shelton's nomination, that was back in February, will now support this nomination vote, which means that she could clear the committee along a party line vote. And keep in mind, it's a 13 to 12 party line in terms of this committee. But something that's also worth mentioning is that this is not going to be the end all for their confirmations to take on those seats at the central bank. It will have to go to a full Senate vote at some point down the line, not yet scheduled, but they will have to get a majority on the full Senate floor in order to get full confirmation. So this would be one step closer, assuming they do end up surviving that vote. Again, that should be starting in about a few minutes or so in the Senate Banking Committee. Zach?
Yeah, we're coming up right against it. But you talk about Judy Shelton. We say controversial in some of her positions. A lot of the reason why it would fall on party lines is because people thought that she was changing those positions based on what President Trump wanted. And she also advocated at one point for the return to the U.S., return to the gold standard here in this country. So, I mean, these are ideas that aren't necessarily mainstream Fed thinking, certainly not in line with what we've seen out of the Fed recently. So, I mean, what's your take on maybe that and some of those concerns and how it seems like not so important anymore?
Yeah, absolutely. Well, Judy Shelton, if for what it's worth, Christopher Waller, the other nominee, has not been too much in the microscope, maybe much to his liking, because he is a career economist at the Federal Reserve itself. He spent a number of years at the St. Louis Fed as a researcher, but Judy Shelton really being the more politically concerning one from the Democratic standpoint. She is someone, as you mentioned, who has advocated for reinstating the gold standard. That is something that even Jay Powell has been on the record as saying would undermine the central bank's ability to target maximum employment and stable prices. She's also flip-flop on interest rate policy. Before she was nominated for the Federal Reserve, she was advocating for continuing to hike rates. But after she was officially nominated by the White House, she started launching all these op-eds saying, I do agree with lowering the interest rate to zero. This is even before we had the COVID-19 crisis. So a lot of people saying it does appear that you're flip-flopping to the political winds of the White House itself. That's something that Democrats have tried to push back on. Actually, we've heard from Sherrod Brown, the top Democrat on the committee, saying we should have one more hearing before we ultimately have this confirmation vote. But again, this confirmation vote will happen in a few minutes, and we'll be watching that right here on Yahoo Finance.
Yeah, and I mean, we say controversial past. As far as the Fed goes, that's pretty much the most controversy we can offer here. And if you don't think it's controversial, don't tell Brian Chung that, because this is what he lives for. But that'll do it for us here in the 1 p.m. hour. We'll be staying on this, as well as other stories here in the 2 p.m. hour. We'll be chatting with Raymond James, Washington policy analyst, on the stimulus negotiations as the U.S. prepares for its benefits cliff. An additional $600 in benefits looks to roll off at the end of the month. Much more coming your way on the ticker. Stay with us.
Welcome to Yahoo Finance Live. This is the ticker. I'm Akiko Fujita. And with just 2 hours left to go in the trading day today, we are seeing the Dow, the biggest gainer today, off of its session highs, but still up about 285 points, gaining about 1% there. The S&P 500 up 22 points, and the Nasdaq, the one laggard on the day, trading pretty flat right now, just down slightly there. Some big gains in the energy sector today, up more than 6% overall. Stocks are helped by a big boost in oil. Some optimism on the improving demand as we see some countries start continuing to lift the restrictions that were put in place. We're also seeing improvement there on the prospects of a vaccine. WTI and Brent crude both up more than 2%. Earnings firmly in focus in the markets. We are seeing some profit taking perhaps in the big tech names ahead of their reports. Microsoft, Amazon, Facebook, Netflix, and Apple are all down on the day. IBM, though, giving a lift to the broader market on the back of better than expected second quarter earnings. That Dow component in positive territory. Coca-Cola also in focus today. It was up as much as 3% despite seeing a 33% drop in profits in the second quarter. The company expressing optimism on demand, though, as those coronavirus lockdowns are slowly lifted. Meanwhile, in Washington, we did hear from Senate Majority Leader Mitch McConnell unveiling a broad outline of the Republican relief proposal as Congress debates yet another round of coronavirus stimulus. We're going to get to that in just a bit in the show. But let's kick things off today with Jimmy Lee. He's the Wealth Consulting Group CEO with his eyes on the market there. And Jimmy, I was just talking about some of the tech names being down today, potentially some profit taking ahead of their reports. There's been some question about we're seeing this rotation out of growth into value, but you say we're not there yet.
I don't think we're quite there, but certainly there has been so much profit that has been made in the big mega cap tech trade that ahead of earnings, it makes sense to take some of those profits in situations. But I don't think that we're there yet, and that those names have reached the top. I don't think that will really happen until treatments and vaccines are really out there and approved.
How are you positioning yourself in the tech sector overall? We've certainly got a number of big earnings on tap, including Microsoft as well as Amazon. These are some of the stocks that we've seen see huge gains on the back of the lockdowns that have been placed. Huge growth prospects, seems kind of like the fallback trade. But how are you positioning yourself overall in this space? Do you feel like valuations have gotten too high?
In some names, certainly. We're still actually overweight tech from an asset allocation standpoint, but not invested in the high-flying, incredible valuation type stocks. And so we're being very, very mindful of valuations. And I think investors should potentially have growth, but also value. And while we don't have a full rotation into value quite yet, if you don't own value now, it's a good time to look at your portfolio. And even though sectors that have been beaten up the most, that are sensitive to the economy opening back up, if you wait too long, that opportunity will probably be gone. So make sure you're balanced between value and growth.
So let's talk about some of those value names. Where are you seeing the opportunities?
Well, I think even in financials, I know that, a lot of financials are beaten up big time. And, you really get earnings announcements from the big banks last week that are mixed. And if you have a trading desk, then obviously the earnings are better than if you don't. So certainly, we're going to have some loan losses for the big banks that make loans, but I think the opportunity in the banking and in the financial sector is still great. I think in the healthcare sector, I think about opportunities. So I think there is also value in a lot of beaten up travel-related stocks that won't go bankrupt. And so it's time for active investing to scrub the balance sheets and make sure that the companies you're invested in have access to capital or refinancing their debt and make it through the other side of this virus.
What specific travel names are you talking about? I mean, it seems like when you look at May and June, it felt like some of that demand was coming back, especially in airlines. And yet the latest data out from TSA seems to suggest that has leveled off as concerns about an uptick in these coronavirus cases have reemerged.
Well, I can't give you specific names, but certainly in the gaming sector, the hotel sector, and even the airlines, if the companies are not going to go bankrupt, you need to see what the additional debt that they might take on during the cycle will do to earnings and try to discount that to get to a true value, or price today. But I think there is opportunity in a lot of those sectors and in names. And so again, if you wait too long and you wait for the vaccine to be out and approved, and those stocks will probably already have gone up a lot. And I don't think we're going to retest the lows. So as the virus case count ticks up, and you have states going back and forth on the reopening plans, what's probably going to happen is if we get a pullback in the stock market, you're certainly going to see more stimulus from the government. It's election year. So between now and November, we're going to probably see some mixed economic data, but certainly more money from the government is expected. And that correction will be supported by that extra money. And I think you'll see a rally in stocks. And so we've seen this playbook or play out before already in March. And so investors, I think, can use this as a buying opportunity. When it happens, if there is some selling going on and some panic selling like there was in March, that's when people like Warren Buffett says to get greedy. So I think investors may have another chance to buy some more equities even cheaper.
Jimmy, you mentioned the stimulus debate that's playing out right now in Washington. Certainly we heard a potential, or I guess a starting point, as the Senator Mitch McConnell put it, for the Republican proposal. How much of what comes out of the ultimate proposal that's decided on between Democrats and Republicans, how much of that actually changes your positioning in the market? As you say, there's a lot of people who are looking to this to see how much additional help there will be, not just for sort of those who are unemployed, but also businesses. How much of that you think is actually priced in the market already?
I think a lot of it. In fact, that's why when people ask me, how can the stock market be so up so much? and back to where we were before almost with the economy doing so horribly, it's because of the stimulus. And I think investors that have bet against the stimulus and against all the Fed action were wrong when they were predicting the retest of the lows. And certainly, again, this is an election year. Between now and November, we're going to get more stimulus, in my opinion, and that's going to help support stocks. And but as we get case count on the medical side, that's negative news on the medical side. We could potentially, as the certain states shut down, see opportunities to buy stocks on the correction. But I think the election has potentially a lot of risk associated with it in terms of positioning. But up until then, I think the stimulus is something you can't ignore. And if you're an equity investor for the long run, you can count on it, and it will help you potentially give you support for a buying opportunity next time again.
Always good to get your insight. Jimmy Lee there with the Wealth Consulting Group. He's a CEO there.
Thank you.
Well, turning our attention to the latest on the vaccine front, executives of COVID-19 vaccine manufacturers testifying before the House subcommittee today on the Committee on Energy and Commerce. We heard from executives from Pfizer, J&J, Moderna, AstraZeneca, Merck, all updating lawmakers on the timeline for the vaccine, as well as the safety and efficacy concerns that come along with an accelerated development of that vaccine.
I think right now they say the vaccine has to be 50% effective. But let's say, let me give you a scenario where the FDA changes its guidance and says, oh, it only has to be 20% effective or 10% effective. Or they keep to the guidance, but that yours is only 10 or 20% effective, and they approve it anyway. What would you do as manufacturers to help us out in that regard, on the assumption that we can't trust the FDA?
First of all of our interactions with the regulators have given us no evidence that they're lowering the standards or thinking about lowering their standards. Secondly, as a company, we will always think about safety and efficacy first and foremost, and making sure that we have an effective medicine.
Let's bring in Dr. Howard Foreman. He is a professor of management and public health at the Yale School of Public Health. We've also got Anjali Kamlani, who follows this space for us. Doctor, it's good to talk to you today. Just let's start with what you heard from these drug makers today. What stood out to you?
First of all, I think the biggest concern that they all seem to agree with is vaccine hesitancy, which is sort of the more formal term for what many people call anti-vax movement, or just mistrust in government and drugs and vaccines in general. And if we're going to have a successful vaccine program, we need to be able to minimize vaccine hesitancy.
So the concern being that even when the vaccine is finally available, many may opt out of it. But let's talk about where the timeline stands on the vaccine. What did you hear today that gave you some assurance that we will actually get through to the finish line, if you will, by the end of next year or early next year, which is kind of the timeline that has been laid out?
Yeah, look, I think that we're making very good progress. We have not had a substantial setback yet. And there's no absolute reason why we have to have a setback. But in general, the process of both drug development and the clinical trials and then the approval process usually come with setbacks along the way. Right now, we have very good indications about immunogenicity and side effects in healthy younger people for the most part, although some of the vaccines have been tested in older individuals, but it's still very early data. And we need to see much more of that, and it needs to continue being positive for us to be able to have a successful vaccine candidate for approval.
Another sort of buzzword or theme that has been going on was about vaccine nationalism. And we heard a lot of comments from the lawmakers about supply chains and where they're manufacturing and where they're ramping up. And it seems like that's playing a really big role in this outbreak. I'm curious on, the comments that you heard, what your thoughts are on whether or not this is one of those things that can help accelerate that conversation.
Look, I am optimistic about the way the process is proceeding right now. I think that the financial incentives are very, very well aligned for the manufacturers. And I think we do well when financial incentives align with what our proposed outcomes should be. the fact that we have several candidates moving along right now is very good. If only one candidate was moving toward fruition in the next several months, I'd be much more concerned about what you describe as vaccine nationalism. So I'm optimistic, but I agree with you that a lot of the questioning was very focused on like where you were sourcing your materials from, where were you manufacturing it, and would you have the capacity to supply these vaccines to a large enough part of the population?
And it seems like another pre-pandemic sort of topic that came up was the cost of the vaccines. We're hearing about each one of those companies being questioned on whether or not they would offer the vaccine at cost or whether they were at profit. And it seems like largely among those that testified, it was for profit. This is one of those debates, right? Because there's so much taxpayer money going into that. What are your thoughts on that?
Yeah, look, we're dealing with a public health catastrophe, and we want to make sure the incentives are set up properly so that in future similar situations that the manufacturers will step in and want to do this. So I want them to make some profit. I obviously don't want them to make $1 trillion profit off of something like this if I were ruler of the universe. So, you know, I'm at root, I'm still a capitalist, and I believe that if we get the incentives right, we should be able to create the appropriate, you know, get to the right outcomes. And I think it's also important to note that if there are several candidates that end up becoming successful, they presumably will compete with one another on price. And some of these manufacturers may make far less than we expect.
Doctor, aside from concerns around the vaccine, there's also this immediate concern about the ability or availability of testing, you know, essentially being processed in a timely manner. And we heard from an executive at Quest Diagnostics speaking to the Financial Times today, saying essentially that we are at max capacity, that we're not in a position to ramp up capacity for what is expected to be sort of this real second wave coming up this fall. Can you address why we're in this position right now? I mean, I guess this comes to sort of the supply chain question, whether we have enough the resources in place, but how troubling is it for you to hear that right now in August when we're sort of still part of that first wave?
You know, absolutely. And this is really the flip side of the coin that we're talking about with vaccines. With vaccines, we seem to be throwing a lot of money, getting the incentives to be so high that everybody wants to reach for the brass ring. With testing, which in my opinion could be just as effective as a vaccine, certainly in the short run, with testing, we've never done that. We've never set the incentives up appropriately. We tried to help out the private labs, and the private labs did ramp up, but they only ramped up to sort of a base capacity that doesn't come close to what we need. And they're really beyond max capacity right now. And we know that because they're delivering results with 2, 3, and 4 week delays.
In the meantime, we heard from the CDC saying that the number of coronavirus cases could be 2 to 13 times higher than the official numbers that have been reported in some parts of the country. Going back to the testing issue, how important is it for us to actually get the full scope of what's happening, even those who are asymptomatic, to be able to come up with a more comprehensive policy, a federal policy, to really try and get this virus under control?
It would be very, very helpful. But at the same time, the main purpose of testing is to identify asymptomatic individuals before they spread to others. So while it would be very helpful from a management point of view, for a planning point of view, to know the full scope of what we have out there, I would be very satisfied just being able to get back 1 million or 2 million tests a day, primarily within 24 hours, because that would change the ball game completely. If we had results within 24 hours on 1 million to 2 million tests a day, we'd probably be putting this fire out already.
Dr. Howard Foreman, always good to get your insights there, Professor of Management and Public Health at the Yale School of Public Health, and our thanks to Angelique Kamlani as well.
Thank you.
We are coming up against a quick break, but coming up, we're going to be talking about the latest on the stimulus debate over in Washington. Republicans laying out a preview of their proposal we'll be discussing on the other side of the break. Welcome back to the ticker. The next round of federal stimulus is likely to include another round of stimulus checks and loans through the Paycheck Protection Program. That, according to Senate Majority Leader Mitch McConnell, who unveiled an overview of the Republican proposal that he said was a starting point for negotiations. In addition to those stimulus checks and business loans, McConnell also proposing setting aside $105 billion for reopening schools and more money for child care. Let's bring in Ed Mills. He is the Raymond James policy or Washington policy analyst. Ed, it's good to have you on today. There's obviously not a lot of specifics in the proposal today, given that it's sort of an overview of where Republicans want to start. What stood out to you?
Akiko, what stood out is that the recognition that there needs to be more done, I think is a very big message to the market that this is going to get done. The real question is what size and how long it's going to take. My base case has been that it gets done by the end of the month. Republicans are, I think, going to start the opening bid at an additional $1 trillion of fiscal relief for the economy. And if kind of McConnell is starting by saying these are givens, I think there has to be an assumption that the price tag goes up as negotiations play out.
To your point, Ed, the question is how big the Republicans are willing to go and whether the Democrats are willing to meet them at that. But the big question mark here right now seems to be about the stimulus checks, especially given that the extra unemployment benefits are running out at the end of the month. There's concerns about sort of this fiscal cliff that a lot of Americans are likely to face at the end of the month. There's been some proposal about lowering the cap, if you will, for those who actually receive those checks. How important is it, you think, when you look at the overall macro picture for Republicans to get that right?
Well, I would look to the comments last week by former Fed Chair Janet Yellen, who said it would be devastating if the $600 were to completely go away. And that kind of you hear economists saying that we need these individuals to be spending to benefit the economy. The simple fact of the matter is that there are tens of millions of Americans, an unemployment rate that is arguably kind of when you add in the self-employed who are getting some of the unemployment benefits that are not always calculated in the official results, where it looks like it's closer to 20%. You have a lot of folks out of work without a single, we don't have tens of millions of job openings right now. So the way I think about this is that to continue the $600 a week is about $15 billion a week. That would be about $350 billion between now and the end of the year. If you were to reduce it, that's a way in which you can kind of have these negotiations and stick to the dollar amount. I do think that it's going to be probably in that $300 to $400 a week when all things are said and done. There will be kind of some extra as we add on this fiscal stimulus check. So the consumer is still front and center in the negotiations in DC, but the total dollar amount is still up in the air.
What about what needs to be done in terms of support for small businesses? There's been some discussion here about the extension of the PPP program, but we've already seen these small businesses who did receive those loans, 2.5 months later saying essentially it wasn't enough, and that even as they were able to reopen their business because of the restrictions that were in place, tied directly to concerns about the virus, they just weren't able to get the business back up and running. What needs to change or what needs to be tweaked about this program to be able to provide support for these businesses?
Akiko, that's a great question. So when we go back to the CARES Act and the creation of the PPP, it was about getting money to small businesses so they can pay their employees. That was only support for 8 weeks. We are 3 months since the passage of the CARES Act, so that money, by definition, should have run out by now. What the conversation in DC right now is there's about $130 billion left of funding that has been appropriated to cover that 8 weeks, plus some additional kind of rent utility payments. Maybe add to that, I think it's probably in that $200 to $250 billion range, and make sure that the next round goes to the hardest hit businesses. Secretary MNUCHIN on Friday highlighted that any additional relief should have a revenue test. We want to see that the revenues of the businesses have come down, that we help, rather than supporting a business that is just humming along, that is technically eligible. if you have that revenue test, if you do that second round, that's the way of supporting small businesses as they get, kind of reopening in transition between kind of the current economy and a post-COVID economy.
One of the areas or points of contention that are likely to emerge is how much funding there should be set aside for cities. And we've already seen cities across the country start to implement drastic cuts in place because of the significant losses in revenue. How big do you think that Congress needs to go in order to provide meaningful support to these cities that are hurting?
Akiko, I think there's bipartisan support at or around $500 billion. You look at different estimates and you could easily argue that $1 trillion has been lost at the state and local level. I do kind of always tell folks when you're looking at money to state and local governments, recognize that money is somewhat fungible. And so you might not see as much of a direct payments to states that some of the state leaders or kind of local leaders would want. But when we look at funding for schools, additional healthcare funding, additional funding for testing, all these different ways in which the federal government sends money to the state and local level, when that gets added up, I think that's going to give some relief to cities and states. It's not going to cover everything, but what we see in DC is that at the beginning of this conversation, a lot of the impacted areas were disproportionately areas represented from Democrats. So there was an opposition. There was almost a partisan feel to this. Now, as we've seen kind of the virus spread throughout the country, it is impacting kind of Democratic and Republican areas almost equally. So my hope is we can get that bipartisan compromise and get at least $500 billion in this next aid package to state and local governments to help them out.
No question, a lot of mayors are hoping for the same, as well as we continue to watch the debate over the latest stimulus play out in Washington. Ed Mills, Washington policy analyst for Raymond James, thanks so much for your time today.
Thank you.
We want to get to some developing news out of Washington. The Senate Banking Committee voting to move forward with both of President Trump's Fed nominees a short time ago. Let's get to Brian Chung for the very latest on that front. Brian.
Hi, Kiko. Where the Senate Banking Committee down in Washington, D.C. just wrapping up their committee vote on 2 Trump nominees for the 2 remaining vacancies at the Federal Reserve Board of Governors, that being for St. Louis Fed economist Christopher Waller, in addition to former Trump transition economic advisor Judy Shelton. Keep in mind that both of these individuals did have their confirmation hearings back in February, but their nominations were stalling for what reasons we don't exactly know. But both of them did advance in the Senate Banking Committee vote just a few minutes ago. Christopher Waller, the St. Louis Fed economist, advancing in an 18-7 vote, actually getting a few Democratic votes in that head count. But then Judy Shelton only advancing on a party line vote in a 13-12, extremely narrow vote, right along party lines. 13 Republicans, 12 Democrats in that vote. Keep in mind, Judy Shelton has been a particularly controversial candidate because of her flip-flopping views on interest rate policy. Before she was nominated by the White House for this position, she had been advocating for raising rates, but then after being nominated, then appeared to sympathize with President Donald Trump's call to lower rates aggressively. This is before the COVID-19 crisis. She was also highlighted for her previous writings on the gold standard and her advocacy to return monetary policy to an operating framework that involves pegging the US dollar to gold. That is something that she has backtracked on. In her hearing back in February, she did say she wouldn't advocate for going back to a regime like that. But regardless, both of these nominations will be headed to a full Senate vote before they ultimately do go to the Federal Reserve Board. That's something that they're going to need a majority vote. And keep in mind, the Senate is a 53-47 Republican leading House, which means that that would be something that Republicans can only afford to lose 3 members of in order for these 2 nominees to ultimately get confirmed as Fed governors. Akiko?
And Brian, quick follow-up there. I mean, how are things shaping up with that vote? I mean, you talk about the very narrow majority that's in place right now. How do you expect the debate to play out on that front?
Well, the calculus is going to be very close, which, by the way, is a quite rare thing for Fed nominees. Usually there's a lot of bipartisan support for Fed nominees because of the unpolitical or apolitical nature of the central bank itself. But Judy Shelton, being as controversial a figure as she is, it could be quite a razor-thin vote, as we already saw in the committee. In fact, we didn't even know leading up to today if Louisiana's John Kennedy on the Republican side or Richard Shelby from Alabama would ultimately support her nomination, which they did, as we saw in that vote today.
Okay, looks like we lost Brian's connection there. Or thanks to Brian Chung there for covering the very latest on that front. We're off for another break, but coming up, we're going to be talking about Tesla, taking a dive today in this session on the back of a downgrade from JP Morgan. We'll go into what that report says coming up. Well, expectations are sky high for Tesla as the company prepares to report its latest earnings tomorrow after the bell, but the stock trading below, off about 2% today after the stock got a downgrade from JMP Securities. Emily McCormick here with that report for us. And Emily, it seems like the analysts here saying that they're not necessarily questioning the long-term trajectory of the company. It's more about the valuation and how far it's run up.
Absolutely, Akiko. We are seeing valuation concerns being one of the primary issues that many analysts on Wall Street are bringing up, especially heading into Tesla's second quarter report after market close tomorrow. If we think about this stock, it's up more than 280% for the year to date, the second best performer in the Nasdaq 100 just after Moderna. So really high expectations here and creating a very high bar for this stock heading into results and heading into the rest of the year before we see any potential new catalysts. And here's what JMP Securities had to say in their note today. Analyst Joseph Osha said, quote, "We continue to believe that Tesla builds the best battery electric vehicles in the market, and other than Volkswagen, it is not even clear to us who can offer viable competition. When we put a $1,500 price target on the stock recently, it was based on our belief that the company could be shipping about 2.5 million units by 2025 and generating $100 billion in revenue with a 20% EBITDA margin. On that basis, we argued for a $300 billion market capitalization, which is around where Tesla is trading now. And we continue to believe that Tesla can achieve the goals we discussed. The stock has now gotten to our target level, however, and we think that investors face challenges in earning additional returns from here." So really, as you mentioned, and as many analysts on Wall Street are now saying, really because of the run-up that we've seen in Tesla's price for the year to date, until we really see those numbers and unless they really surpass expectations heading into these results, it is going to be difficult to see potential further upside. Akiko?
Okay, certainly a hot stock, but well off of the highs we saw last week. We'll continue to watch that. Thanks so much for that, Emily. Shares of United are lower ahead of its earnings report today. The company's already warned it could furlough 36,000 people, up to 40% of its global workforce this fall, if airline demand remains weak. The latest numbers out from the TSA certainly points to a drop in demand on that front. And Sabile Marcellus is joining me to bring us those numbers. Sabile.
That's right. So United reports its earnings after the bell today. Now, what's expected is a loss of $9 a share on $1.14 billion in revenue. Now, just to give you some perspective, the stock hit a record high in 2018 of about $97 a share. But right now, the stock is in the green, but it's trading at about $32 a share. Now, what we can expect after the earnings, if United, they gave us bearish earnings. If they beat them, then that's good for the stock. But if they don't, then the stock will be hurt very badly. When you look at the airline industry overall, we saw many of the airlines were starting to see air travel pick up slowly but surely as states slowly reopen. But since then, we've seen this surge of coronavirus throughout much of the country, states either coming back on their reopening plans or hitting pause. And as a result of that, air travel that was starting to inch up and airlines thought we were going to see upside from this point has started to slow down. So that's basically the situation with the airline. But we'll see what United reports after the bell today.
Yeah, certainly a lot of attention there, especially given just how uneven the recovery has been on the travel front. Thanks so much for that, Sabile. And we will continue that focus or continue the conversation on the road to recovery today with a special later this afternoon. Stay tuned to Yahoo Finance's All Market Summit Extra, the road to recovery, and that kicks off at 5 p.m. Eastern tonight, and you certainly won't want to miss it. Coming up, we're going to be turning our focus back on the U.S. economy. Another major layoff announced today, another major company announcing a layoff today. Where do we stand in the broader economic recovery? We'll discuss on the other side of the break. The coronavirus pandemic is continuing to take a toll on the job market. LinkedIn today saying the company will cut 6% of its global workforce. That's about 960 jobs. Just the very latest company to announce cuts. 3.7 million Americans who are currently unemployed have lost their jobs permanently so far. Let's bring in Michael Gapin. He is Barclays chief U.S. economist. And Michael, it's good to have you on today. there was some surprise with the LinkedIn announcement, partly because we've seen a lot of these tech companies being able to manage or at least navigate the economic downturn relatively better than perhaps some of their other companies. But I'm curious what you make of this announcement or what this says about where we are in the broader economic recovery right now.
So I think there's two things that are probably buffeting the labor market right now. One is that COVID has accelerated structural change in certain segments of the economy, retail being the most obvious, but we've seen and heard of announcements from major airlines looking at cutting workforce. You mentioned LinkedIn today. So I think there are segments of the labor market that are getting hit by a structural shock, and we're just seeing a lot of churn and turnover that's happening much more rapidly. It's bringing forward a lot of the change that was already occurring in those industries. And I think on the other side, the second factor that we're certainly seeing is labor markets are responding to the ebb and flow of existing coronavirus cases. And we see this most notably in the continuing claims data from last week. 4 of the 5 states that showed the largest increase in continuing claims were California, Florida, Texas, and Georgia, states that have obviously had a rebound in coronavirus cases. So that suggests the rate of hiring had slowed in those states. If you look at the Northeast, 3 of the 4 states that had the largest decline in claims were New York, New Jersey, and Massachusetts, which suggests the Northeast, which is having more success at reducing coronavirus cases, may see a pickup in the hiring rate. So I think those two things are cross currents in the labor market right now. One is a structural adjustment being brought forward. The other is kind of an ebb and flow based on where coronavirus cases stand at present.
When you talk about the ebb and flow, particularly the unemployment claims, just the unevenness of that, do you see what's playing out right now? Is this just a blip? In other words, as we see these states and cities sort of pull back on their reopening process, is this actually pointing us in the other direction when you look at the recovery, or should we just see this as sort of a blip in the broader unevenness of the recovery?
So I don't think it's a blip. I do think it's exactly what you said, though, in the sense that it suggests we are in a phase where we will see much more uneven progress. So yes, there will be at risk of a potential slowdown and turnaround, or it's where the direction of travel is still up for the economy, but it's going to be in a much more uneven fashion. So I think the shutdown effect was essentially closing down a lot of parts of the economy. Some of them ex post, maybe they aren't as COVID sensitive as we thought. So you turn the light switch back on, and the good side of the economy in particular looks very V-shaped, and household spending is back to roughly where it was in February in terms of what households are spending on goods. But the services side of the economy is a very different story, as you know. So going forward, if the economy is going to continue to make gains, it's unlikely to come from the goods sector. It has to come from services. And there it's going to be much more of a slog because a lot of services require face-to-face contact. And if the coronavirus is growing and spreading, it's going to put a damper on that activity. So to me, we've entered the new stage of the recovery, which suggests, yes, things will be much more uneven as we go forward. The V-shaped part has already happened. That's behind us. And it's going to be a lot tougher to make up or make new ground going forward.
Let me ask you the same question we asked our earlier guests, which is how much of this the trajectory from here on out is contingent on what exactly Congress does in terms of an additional coronavirus stimulus? There's a lot of concern about unemployment benefits running out, about PPP running out, stimulus checks, and how many people will actually get it. How are you viewing that dynamic right now when you look at what the recovery looks like from here on out?
We definitely think it's needed because what I'm essentially saying is we need a longer bridge between when we reemerged from lockdown and getting the bulk of the economy back to a more normal situation. Obviously, it's unknown if we'll ever get back to a fully normal situation. But as your guest mentioned, the initial rounds of stimulus were really kind of it was 8 weeks to 12 weeks in nature. We're hitting that point. We probably need to up it for another 8 weeks to 12 weeks and get say to around the November election. But additional resources for households to make up for lost wage and salary income. Employment is still 15 million below where it was in February. Increased resources for testing and first responders. That was another thing that's mentioned that's important. And from my perspective, not doing state and local spending would be a major problem, because state and local governments are putting together their budgets for the next fiscal year, and states are on balanced budget amendments, and we should be prepared for large cutbacks in expenditures as well as perhaps even employment. So addressing at least some of the shortfall at the state level would be important. Otherwise, the states are just going to counteract what we're trying to do at the federal level. So all of these pieces are important. I think most economists like myself are assuming we do get this additional stimulus. So if we don't, we think the road ahead will be much more uncertain.
And Michael, very quickly, what about the monetary side of this? You know, is the Fed liquidity support sufficient enough to create that bridge, if you will, as we wait for the additional fiscal side to kick in?
I think it is. I think the Fed's put out the safety net that's there. If the economy turns south and credit conditions worsen and financial markets become dysfunctional again, then you'll see a lot of take up in those Fed facilities. Right now, you're seeing very little take up in those facilities. The Fed's acting as an effective backstop. But if the economy does have a downturn, then they will become lender of first resort, not lender of last resort. But I think that they've put out an appropriate safety net, and they're in a very good position should the economy need it.
Okay, Michael Gapin, good to get your insight today, chief economist over at Barclays. Coming up, we're going to get a unique perspective on the coronavirus and the battle that's playing out in the hospitals. One doctor who volunteered to help during the pandemic, the peak pandemic in New York, now seeing similar scenes play out in her hospital in California. We'll speak to that doctor coming up on the other side of the break. When the coronavirus overwhelmed New York hospitals back in March and April, our next guest volunteered to fly from California to New York City to help doctors there. Now her state is dealing with a record number of cases. Dr. Chi Perloff is a Vituity Emergency Medicine Partner and Assistant Medical Director and Emergency Department Chair at John Muir Health in Walnut Creek, California. We've also got Angelique Kamlani joining in on the conversation. Doctors, great to have you on today. I'd love to get your thoughts, first of all, about what you're seeing on the ground there and how that compares to what played out in New York during March and April.
So yes, thanks for having me. I actually am having a little bit of deja vu in terms of what we saw in New York. I was constantly aware that anybody who came into the hospital or even in the community being out on the streets, that I would be exposed to COVID. There, I had seen numbers and numbers of COVID patients in the ED, and now we are seeing increases in patients coming to the hospital and being admitted for severe cases. It is strangely reminiscent, unfortunately.
What about your ability to respond at this point? When you go back to the beginning of the pandemic, especially when things were at their peak in New York, what we kept hearing was you want to flatten the curve so you can buy enough time to have the right resources in place because the virus isn't necessarily going away. When you look at what's playing out in California, has that time, those months in between, has that actually helped in the response?
I would absolutely say yes. I think we had the luxury that New York didn't have to start planning both in hospital systems, regional areas, as well as statewide, really coordinating efforts to be prepared for that. I think we did a really great job of sheltering in place, and every individual really did their best in trying to keep everyone healthy. But that being said, now with our numbers increasing, I think that we absolutely had the foresight to be able to prepare. And I think that I want to give kudos to our hospital leadership, our medical staff, our nursing leadership, as well as our legislators to have had that foresight to do that.
Doctor, I know that one of the things we kept hearing about during the peak in New York was shortage of personal protective gear, of testing, and some of those things still seem to be around, especially on the testing front. We're seeing those significant delays in turnaround time, but I've been told that the point of care testing doesn't see that same delay. Is that true or not? And also, what is the situation when it comes to all of this equipment?
So I have to say we're really doing a great job at my local community hospital of having PPEs and having testing available. That being said, it's so important for all of us to be really good stewards of those testing because of these delays. And that comes with having the increased testing, people wanting testing, people going to their local sites and testing centers. So that's something that isn't surprising at this point. But that being said, we all have to continue to be very specific about how we use those resources. And what we're doing locally is what many other hospitals are doing, which is to coordinate with their infection control groups and leadership in their hospitals to give them direction on how to use those appropriately, given the situation that all of our individual hospitals are in. And those may be different.
And one of the things that we saw also in New York was the overflow spaces and hospitals, and stories coming out very recently saying that none of it was utilized efficiently and effectively. Has there been any thought into what would happen if your hospital does surge, and lessons that you learned from New York that could help?
Absolutely. I have to say again, I'm so lucky to be a part of a group that's actually already have plans in place and have opened up units in order to take care of those patients in the best way possible to prevent spread of disease, as well as preserve PPEs while we're doing it.
Doctor, can you speak to the changes that we've seen in the profile of the patients? What we heard so often during March and April was that these were largely older patients, those who had conditions that made them more vulnerable. And yet what we're hearing, not just from California, but other states as well now, is that they're seeing a lot of younger patients coming through the door.
Absolutely. And that ranges from young patients with no previous medical history, mid-age patients who are still out working, as well as babies and newborns that we see being exposed and having symptoms coming into the ED, as well as getting admitted. And so we are seeing the full breadth of community members, both old, young, sick, and otherwise healthy, coming in with COVID symptoms.
Dr. Chief Perloff, great to get your insight and appreciate your service both in New York as well as California. Wishing you the best of luck on that front.
Thank you very much.
Coming up, we're going to be looking ahead to Microsoft earnings. Tech down broadly today ahead of some major reports out there. Dan Halley's going to break things down for us on the other side of the break. Shares of Microsoft just off slightly ahead of their earnings report tomorrow after the bell. All eyes certainly going to be on the company's Azure and intelligent cloud service and just how sustainable the growth will be on that front. Dan Halley joins me to break things down for us. Dan.
Yes, it's really going to be an important quarter for Microsoft. Basically, what we're looking for in terms of revenue is $35.54 billion. That's compared to $33.7 billion in the same quarter last year. And as for earnings per share, we're expecting $1.37. That's equal to the $1.37 we saw again in the same quarter last year. And really, as you said, what we're looking at is Azure growth, where the intelligent cloud that Microsoft has, or Microsoft calls it, is going to be growing. Azure, they don't break out specifically. That's the platform that their intelligent cloud is all based on. They call it the Intelligent Cloud Group. That's kind of how they give the revenue for it. And it has seen exceptional growth through the last few quarters. But one of the things we're going to be looking at is how much of an impact the sunsetting of some older Windows Server platforms and Windows 7 will have on the quarters to come. Now, we've talked to BMO Capital Markets, and according to some of their research, Microsoft saw exceptional gains because of the sunsetting of those products. And then going forward into 2021, they're not going to get the benefit of the customers who needed to upgrade because of the fall of those products. So it could be difficult comparisons going forward, but we shouldn't really see that in this Q4 2020 for them. Really, it's going to be about where this cloud service is going, how much of a benefit have they seen out of the COVID crisis with all of the working from home atmosphere, and then what's going on with their other personal computing segment. And that's really where OEMs kind of sell or purchase rather Windows 10 products. And then of course we have the productivity side of things, and that's really going to be based on Office 365, which Microsoft kind of rebranded recently. Those are really the key areas we're going to look at. Gaming for Microsoft isn't really going to seemingly do that well this quarter, and that's just to be expected. They're going to be launching a new console at the end of the year, and we'll look to see how that performs later in 2021.
A lot to take in, Dan Halley. Microsoft reporting after the bell tomorrow. That does it for us here on The Ticker. The final round is coming up next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Southern with you on this Tuesday afternoon. Let's take a look at the market here. Pretty much the inverse of what we saw during yesterday's trading session. Right now, we've got the Dow and the Russell 2000 leading the way higher. Both of those indices up better than 1%. The S&P 500 splitting the difference once again, up about 0.6%. Right now, we have the Nasdaq in red figures, off about 0.1% of 1%, that we did see the tech index move back into the green just a few moments ago. If we look around at the sector action today, again, quite the inverse picture we saw yesterday. We've got 10 of 11 sectors in the S&P 500 higher. Energy, financials, industrials, the three outperformers. Only XLK tech sector is in the red right now. Communication services is up just 17 basis points. And so once again, we're seeing this rotation within the market, sectors that are uninvolved one day or lagging one day, picking up the slack the other. Of course, as we discussed during yesterday's program, because of the market cap weightings that you look at with these sectors in general, but of course, when it comes to the tech sectors, I mean, you've got several trillion-dollar companies in the FANG names. You got your Microsoft, Apple, Amazon. All these stocks are in the red during today's session. Facebook is also down about 1%. Only Alphabet among the major tech stocks is higher today. But even just that small move lower for these names on a percentage basis just takes a larger market cap bite out of the index. And for the NASDAQ and the S&P, that's going to keep the index sort of with a lid on it. Now, the Dow is price weighted, and so we see a little bit more of a pickup there, or more of an outperformance there. And Chevron, Exxon, both up more than 5%. Chevron shares $91 a share. So in the divisor, doing a little bit of work. Don't need to get into whether the Dow should be price weighted or not. It should not, but it is. So we could kind of go through all that. But again, this is just important to keep in mind when you look at the index level moves and how they are explained. And we see such a large outperformance from the NASDAQ yesterday, and we see a more muted outperformance from the Dow and the Russell today. But both days very much indicative of a continued rotation within this market, which we have hammered now 4 weeks, certainly something the bulls want to continue to see in this market. All right, for more on today's market action, I want to bring my co-host for the next 2 hours, Shauna Smith. Shauna, if you have any thoughts on the Dow, please share them with the class now. We could do that at another time. What else stands out to you?
Yeah, I was going to say, I love this I like the hot take here to start the show. But I do agree with what you're saying. I mean, the fact that the big tech names make up so much of the S&P. What is it? I think it's around 27% of the S&P's market cap is a lot of these big tech names. So it really talks about the fact that when we do see a movement either to the upside or the downside here, and a lot of those big names, obviously that has a major impact on the broader market. So even though today we are seeing tech lag a little bit. I mean, the NASDAQ is the only major average in negative territory. The S&P up just around 0.6%. We're at 3271. And we did see some more of those big tech names, like you mentioned, Apple, Facebook, Amazon, participate in today's rally than we would be, broadly speaking, seeing much bigger gains today. So it is certainly worth pointing out. And then that also goes to the question as to whether or not investors should be concerned about this major rally that we have seen in a lot of those big tech names, whether they've gone a little bit too long in the tooth at this point and due for a pullback. I think the debate is out there. We've heard the arguments on both sides, but it seems like day in and day out, I mean, investors sometimes will, I guess, decide to take a little bit of profit when they think that there's been a big enough run up. I mean, specifically taking a look at what happened in Amazon stock yesterday, it closed up just around 8%. So I think the relatively small pullback today is expected, but it will be interesting to see whether or not this tech trade will continue to lead the market higher. And I feel like it is pretty hard to bet against that at this point. We've seen some rotation out of the big tech names. In addition to today, we saw that last week, some of the value names gain a little bit of momentum. But when we've talked to a number of analysts and a number of investors here on the program, they're saying that we need a little bit more in order to have that trade makes sense at this point. There's still way too much uncertainty in the economy. We don't have inflation. So of course that could hold back that trade, at least in the short term. And then really just bigger picture, Miles, I just want to point out that even at these levels, I mean, there's still a lot of skeptics out there that we will be able to maintain these levels in the second half of the year when we take into account what's happening across much of the country with the with the coronavirus cases continuing to climb. We have the S&P right now at 3270. Jared told us yesterday that the next level to watch is 3300. But then we had RBC today. They lifted their year-end S&P 500 price target to 2900. It's up from 2750, but that's substantially lower than where it's trading today. So I think this really speaks to the fact that there's still a lot of question marks out there. The data that we got in May and June, it certainly was trending in the right direction. But now that we've seen this rise in the number of cases here throughout the country, I think there is more belief that the July data and then potentially August, we could see a bigger slowdown than what we initially anticipated.
Yeah, guys, I was just going to chime in on Miles bringing up the big tech names too. I mean, the stat that everyone was throwing around yesterday after these names flew so high was, I believe, that the 5 biggest names in the Nasdaq, 5 or 6 biggest names, comprise more than 50% of the value. I mean, we know the names we talk about on this show all the time. You know, Facebook, Apple, Amazon, now Tesla, Google, and I think Microsoft is in there. And it's just remarkable because remember, there was a time well before the pandemic, probably over a year and a half ago or so, where of course we'd have days where we would lead off the final round and say Amazon drives markets higher, you know, and of course it's not just tech names that can do that. You know, some days in the past it's been industrial names, you know, Caterpillar, but for the most part amid the pandemic, that sort of stopped being the case, right? We'd be talking about stocks moving because of larger news, either number of cases or we started talking about trade again. But it is remarkable how the FANG names just continue to be kind of a Teflon trade. It's like that was the case before the pandemic. That's the case amid the pandemic. A lot has changed and a lot really hasn't changed, right? For some aspects of the market amid this time.
Yeah, I mean, you know, what's the old refrain? The names that got us here will get us through to the other side, and that's kind of it's a pithy statement, but it seems that it's been mostly true so far. So we'll continue to ride with it. For a little bit more in today's action, I want to bring in Jared Blickery. And Jared, we've talked so much about the leadership from the tech names, the rotation in the market today. Just when you look at the tape and how it sets up here today, what stands out to you?
Well, I think we're in the midst of what's going to be a day-by-day, week-by-week rotation, and we're familiar with this because we saw it since last September. Today, it's not correlated with the 10-year T-note yield, which is actually down. I believe it's still down. At least it started out that way. But when you're looking for leaders, probably going to be shifting from day to day with the net effect that the market goes higher over a week. So we're looking at the FANGs under pressure, which we've been discussing. Instructive to look at our canaries here. We have the KBW Bank Index up 6%, and that's really outperformed over the last, I would say, week. Had a nice week last week anyway. Really lost some territory from Friday into Monday, but still up over the last 7 days. Over the last 21 days, we can see really found a bottom here earlier in the month. Now, also looking at retail, we got XRT up nearly 3%, KWEB, KWEB, that is the Chinese internet ETF, that's up 2.5%, emerging markets doing well. All of this kind of predicated on a sinking dollar. Kind of interesting that the euro has become a flight to quality right now, not as much stimulus as they thought there was going to be. And we'll get to currencies in a second, but here's a 2-month look at the S&P 500, and we can see we have now broken convincingly, I think decisively, this resistance level here. Where are we heading? Probably up to 3,300. That's a level that outlined yesterday, and we got this little gap in here to fill. We'll see if that happens, but I don't see much getting in the way of the S&P 500 getting the record highs. In that time, the NASDAQ, I think, will lag as some of the laggards catch up to the rest of the market. But one more thought on the dollar here, because I think this is important. The dollar has now sunk to the lowest level since March, threatening to take out those lows. And in the euro, we have it at the highest spot in, I believe, at least a year or so. So you'd have to go back to 2019 to find those highs. And on a 5-year basis, still kind of in a trading range here, not a lot of trending action. And this is the inverse of the DXY. But we'll have to see if this can continue because there's a lot of space in here to travel. Whereas the US dollar index doesn't have as much space. Excuse me, it does have as much space, but it is to the downside here.
And, you know, Jared, it's just interesting you flag the dollar weakening a bit because Shauna brought up the call from Lori Calvasino over at RBC earlier today, raising her price target on the S&P, but still well below where we're trading today, 2,900. And in that, it's a risk, but I think it would probably be constructive given the U.S. outperformance. The risk is that investors move into international stocks, you know, in markets where we've seen the virus more under control. And obviously, all else equal, a lower dollar makes those markets a little bit more competitive. And so I think an interesting dynamic as we look towards the second half of the year. We've heard a lot about, I remember last year at some point, it seemed like every guest said international is where you want to be with your money, because it's been so cheap and underperformed so much relative to the US. Perhaps the dollar telling us that that rotation may indeed come to fruition over the second half of 2020. All right, let's change gears now over to the coronavirus and everything going on there. And of course, the return of daily presidential briefings. Anjali Kamlani, I guess it's happening. I guess we're back. Everything is coming up March now, and we will hear from the president at 5 p.m. Eastern today in the Rose Garden.
That is correct, Miles. It does seem like we're on rinse and repeat for a lot of things to deal with this virus. Whether you're talking to health experts or policy experts, you're hearing that for sure. We know that we've heard, unfortunately, about the increased turnaround time for testing, which is another repeat situation, and hospitals that are strained, having trouble with equipment and other things. So that is concerning. But yes, we are back to those briefings and hoping that the tone might be a little bit different. There's definitely been some comments on social media from some health experts that it would be helpful if we weren't if the actual content of these briefings was not rinse and repeat, and that it wasn't in fact treated like a season 2 of a show. And so that's something we'll definitely be waiting to hear about for sure. Meanwhile, we know that we had the congressional hearing earlier today about vaccines and their safety and efficacy. And so I just wanted everyone to get a minute to listen to some interesting points being made about the whole process of this vaccine race right now. Take a listen.
Why did Pfizer choose not to take any government money and take it all on yourselves, as well as the risk?
No, great question. And our focus, as I mentioned in my oral testimony, was on speed. We recognize that the world is in a completely unique situation. We also recognize that, both given the experience that we have as a company, as a vaccine development company, but also given the financial strength of Pfizer, that we were maybe uniquely placed to be able to put our own capital at risk in order to be able to move as quickly as we possibly could.
So this is really interesting because we've heard so much about vaccine development and how much the federal government has poured into it, and that is taxpayer money being put into that. And this sort of this pre-coronavirus conversation that is coming back up about how much does in fact the government put into research, and how much of that should be then a discount to the taxpayers that then end up sort of utilizing this. And so you see Pfizer, which is this huge vaccine leader, saying that they didn't, while you have, in conversations and in an interview with Yahoo Finance, Johnson & Johnson did say that they are looking to see the governments across the world really take on a greater role when it comes to supporting production. And you're talking about two very similarly large pharma companies taking these two very different stances on that. So I thought that was kind of interesting. Miles?
Yeah, and it does seem, Anjali, like we're all sitting here. I mean, yesterday, right, we have multiple positive headlines on vaccine news, and everyone's like, oh, great. So now there's going to be a vaccine. But as we discussed just a little bit, who makes it, how that gets distributed, who pays for it, how much it costs, who's subsidizing it. I mean, these are, there's many questions that follow from this. And I suppose there is a time and a place for them. But the closer we get to the development of anything like an efficacious treatment, it becomes time for some of those questions to be asked. All right, Anjali, thanks so much for joining the program. Coming up on the other side of this break, we're going to talk about our call of the day. Joe Osha, friend of the program over at JMP, downgrading shares of Tesla ahead of their earnings tomorrow night. We'll get into all that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Time now for our call of the day. And today we're talking about a name under pressure ahead of earnings, and that is Tesla. Stock is down some 4% here, trading around $1,560 per share. And Joe Osha, analyst over at JMP Securities, downgrading the stock to market perform. That is from a market outperform rating. And just a couple weeks ago, we had Osha on the program after he upgraded the stock and raised the price target to $1,500 per share. But Sean, a fairly standard downgrade here, looking at the stock and saying, well, it's at our price target, and we're not so sure that we can confidently justify an overweight or an outperform or a buy equivalent rating on the stock, considering the run up we've seen over the last couple months.
Yeah, Miles, I mean, this call makes sense. Tesla's stock is up, 280% so far this year. And Osha, I mean, we need to give him credit just in terms of his recent target calls that he has made. So he had $1,500 price target on shares. It's not too far from where it's trading today. So he's leaving that price target on, and he's lowering the call here to a hold. And I think that, I mean, if we take a look at what's happened in Tesla's stock, and what Osha's really main argument here is that what's priced in at this point, an earnings beat is already priced into the stock. And with his earlier calls, I mean, they have actually seemed to be true. He had an early call with a $1,000 price target on Tesla. That was back in March when Tesla was trading just below $800 a share. He raised it to $1,500, like you said earlier this month, when Tesla was still below $1,400 a share. So he's not making a change to the price target. And I think that's fair given what the valuation is today. You said it's off just around 4%, trading at $1,567. So not too far from his current price target. But I think going forward, obviously with earnings results expected after the bell tomorrow, I think all eyes are going to be on whether or not we see any sort of disappointment, because anything here that would cause a little bit of alarm or stick out to investors, I think could really bring some downside risk to the stock price, at least in the short term. And we've talked about this before. Tesla's big hurdle, and this is not just in terms of consensus expectations of whether or not Tesla will be able to post another profitable quarter. And that's expected, I think, in terms of where maybe shares are priced at this point, but the street's consensus right now has them still posting a loss per share. So if Tesla does in fact report a profit, it is significant because it's the fourth quarter in a row that they would have done so. So then of course that qualifies Tesla for consideration to be included in the S&P 500. But like I said, the real downside risk going forward is anything disappointing in this report, I think has the ability to trigger, could be a substantial downside move in the stock, just given how far and how fast it has come so far this year. And then going forward, this is also mentioned in the note, but I think China is going to play a bigger and bigger role here in Tesla's future success. We know that a lot is riding on their factory that they built in Shanghai. So I think the question here going forward is whether or not production, not only in the US, but also overseas in China, can remain on pace and even increase here over the next couple of years.
And, you know, to Shauna's point, I do give credit to this note and just some of the analyst community who is kind of self-aware enough to say, hey, it's already run past the sort of metric that we had envisioned and forecast. So we're going to kind of accept humility and say, we don't actually know where it goes from here, because even at this point, it seems like it's well run its course. I think a really interesting factoid in the note itself was that, you know, the analysts are saying other than Volkswagen, it's not even clear to us who can offer viable competition. The phrasing, the kind of rhetoric around Tesla has definitely shifted. I mean, Miles, when we're sitting on the couches of the morning meeting with Dan, even just a year ago, it would be like every so often we'd hear a potential Audi competitor, potential Volkswagen, okay, the Benz is in the running. And then now it's almost like all of those options are off the table. If you actually look in earnest at the capability, at the viability, at just desirability and demand, it seems to be that there is no competition at all. So I do feel as though, yes, overall, it's a moment of reckoning for some folks in the analyst community, but still the bottom line to me is overwhelmingly positive.
Well, one part of this note that was interesting to me, guys, you know, the idea that JMP believes Tesla can still become a $100 billion car company by 2025. We're talking about sales, of course, and currently, I believe 2019, about 25 billion in sales. Well, that's a pretty big jump in the next 5 years, really less than 5 years now, because 2020 is a wash, 2025 not so far away. And so what's interesting is the idea that in the note, it says, you know, we can't justify the stock price being much higher than it is right now. Well, and yet, if you really are that bullish on the company, as so many of these notes are, and I believe the note qualifies other than outlook for the future. Well, based on that outlook and so many of these bulls that we've discussed, usually upgrades recently. I think the last 3 times we've done a call today on Tesla, it's been an upgrade. Have kind of the same view for the future outlook that, things are going to keep chugging, and maybe there will be some disappointing quarters here and there because, as Shauna said, now the expectations are so high that Tesla gets dinged for things like, not reaching its own shipment goals, its stated number of cars shipped, or whatever you want to nitpick at. But point being, for these analysts who really think it's going to get that big that quickly in the next 5 years and see that kind of growth, well, then maybe if you believe that, it does justify the stock continuing to go up, even though it's been on a crazy ride. So it's just funny to me, to say that we think it makes sense where it is right now. Well, give it a week, because I feel like we have seen notes that said that before, and then, it just keeps going.
It is interesting just that it was a $900 stock in February, and that was up from a $250 stock like 4 months before that. So now we're like, $1,500, no big deal. Got to give the analysts credit. Great job. It's like, well, it's still like up 6x from where it was basically yesterday in market years. And so it is interesting, Dan, how everyone's sort of floors get raised along the way, and you can back into any justification. And of course, as we all said, got to give OSHA credit. We can talk to Joe OSHA, 4:15 coming up here on the final round. We'll talk to him about this downgrade. And also, we'll do a closer look on what to expect tomorrow night when Tesla does report their second quarter earnings. Those results, again, expected in the 4 o'clock hour. And of course, we'll have them live for you when the numbers break. All right, coming up on the other side of this break, we're going to talk everything markets and economy with Anvita Bahuguna, head of multi-asset strategy over at Columbia Threadneedle. We'll get her take on where the economy could be headed over the second half of this year. We're back with that right after this. All right, welcome back to the final round here on Yahoo Finance. Let's take a quick look at the market here. We're losing a bit of steam. The S&P moving towards session lows, as is the Nasdaq, as well as the Dow right now, though the S&P and Dow both remain in green figures. Just some headlines crossing within the last 15 minutes or so. Senate Majority Leader Mitch McConnell suggesting there will not be a CARES Act extension by next week. Now, again, we're in the hardcore posturing phase of all this. We've seen a lot of headlines on what's happening in D.C. just today. Wouldn't read too much into any of them, but the market is moving just a bit on what we heard from McConnell, again, just within the last 15 minutes or so. So we'll, of course, keep our eye on everything coming out of D.C. over the next couple of weeks. So let's turn our attention back now to where we stand in the economy and the markets and where we may be headed over the second half of the year. We're joined now by Anvita Bahuguna, head of multi-asset strategy over at Columbia Threadneedle. So let's start, I guess, with where the economy is right now, Anvita. You write that you don't expect real GDP to hit pre-COVID levels until 2022. And I would also, I guess I would ask, would it seem that there's actually a downside risk in that forecast, considering the recovery we saw after the financial crisis and just the sluggishness of global growth that's really, kind of taken hold here the last 10, 15 years?
Right, Mal. So what I would say to your question about the economy is that forecast is actually fairly out of what consensus is at this point. Most folks expect a pretty sharp recovery in the second half, or at least back to 2019 levels by 2021 at least. In fact, that's the street forecast that will be back in 2021 when we see growth back to the real GDP levels we had seen before this crisis hit. And if you look at the data in April and May, the payrolls data, the retail sales data, that data was indeed making the case that recovery is going to be fairly quick, and then this is just a small episode in U.S. recovery of around 2 to 3% growth that you has been in for the last 10 years. What we are looking at is data that has started to flatline in mid-June to early July period. This is coinciding with increase in COVID cases in many parts of the country. And this is coinciding with sort of flatlining in some of the mobility data that we are watching on a higher frequency basis. That suggests that this is going to be likely a pretty slow and protracted grind out from the -7-8% number decline in year-over-year GDP growth that we are likely to see in the second quarter of this year.
And so then when you think about, kind of that data you outlined, the slowing, trajectory of growth right now, and we think about, that first wave of layoffs, furloughs, and kind of how that all unfolded, I've been thinking more about this second wave, perhaps, as the recovery drags on. And we're going to talk a bit later in our show about, some big white collar job losses. But does it seem perhaps to you that the W shape, or that there's another round of recessionary tendencies from corporations and consumers? The market has certainly discounted that, but does that seem, in your view, like a real risk as we end this year and head into the beginning of next?
Yes, absolutely. The only data to watch is sort of the COVID data really at this point, because what happens to people stepping out of their homes, going back to their jobs, is so very reliant on what happens to the virus data. And that data is flatlining. There is some good news in that data, in the sense that the death rate is actually not as bad as it was when it first hit the Northeast in the April and May timeframe. And I think our hospitals are better equipped to take care of the patients at this point. But all the recovery that we are seeing is on the back of tremendous fiscal support. And we are right now, as you have been discussing on your show, in the middle of deciding whether that support is going to be extended in the next 3 weeks or so. So we need a lot of fiscal support to continue, because that's the backbone of keeping those unemployed workers at a level where their incomes are supplemented and spending can continue. And at the same time, we're going to continue to see Fed supporting.
So then, to that extent, what exactly do you think the market is expecting from the stimulus package, or what do they want to see, I guess, included in this stimulus package? Because right now the debate is just about how much help the economy is going to get and where the negotiations stand at this point. So from a market perspective and from what investors want to see, what do you think should be included?
Shona, from the investor's perspective, the more the better. And I really, I have this discussion internally quite frequently. I don't even think of this as stimulus at this point. It's not stimulus. It's really a bridge to the other side of the economy when everyone's back at their jobs. So from that perspective, I think investors would be pretty happy if they see both sides of the aisle come to some agreement. Maybe it's not the $3 trillion number. Maybe it's closer to $1.5 trillion, but they would want these policies to continue.
And I think, Anviti, that's a point that we've heard many guests make, but probably perhaps not often enough, that it's not really stimulus. This is it's just money. It's just money. We're just trying to get ourselves from here to there. And, we can call it whatever we want, but I do think that's correct, that stimulus is perhaps a pejorative term of sorts in some fiscal circles, and it may hamper the conversation that really needs to be had in terms of helping the economy get through this period. All right, Anviti Bahuguna with Columbia Threadneedle, thank you so much for joining the program. Hopefully we can talk soon. All right, and coming up later today, right here on Yahoo Finance, we will have Yahoo Finance All Market Summit Extra, The Road to Recovery. Some big guests coming up on the program. Brian Chesky, CEO of Airbnb. We'll also talk to Jerome Adams, the U.S. Surgeon General, Byron Allen of Allen Media Group, among many others. Again, that's coming up here, 5 p.m. Eastern, right after the final round here on Yahoo Finance. All right, coming up on the other side of this break, LinkedIn announcing surprise job cuts. We'll talk a bit more about what it could mean about the state of the labor market as we head into the later phases of this recession. We're back with that right after this. All right, welcome back to the final round here on Yahoo Finance. Let's go over to Jared Blicker now for a look at this market losing a bit of steam as we head towards the closing bell. Jared.
Yeah, we can see the Dow selling off a little bit, but still maintaining some of its gains, up about 145 points now, or about 0.5%. Nasdaq digging a deeper hole here. It is now at session lows, down about 0.8%. And the S&P 500 climbing down to that unchanged line. Bigger picture, not that concerned about that. A lot of times after you have a breakout of an important price level, you come back down in the coming days to test it before advancing. But in case it is a false breakout, need to be prepared for that too. Could see some lower bond yields in the near future and also a higher dollar. So those could be triggers, and we'll keep an eye out for that. But I want to switch over now to the Yahoo Finance Premium idea. of the day, and that is a long in Walmart. This comes by a fundamental report by Argus Research. And just looking at the year to date, and we know this stock well, we can see it's up 11%. They have raised their price target on a long-term basis to 145. That would be up here, and we can see it has been pressing and making new highs rather recently. So here's some of the logic behind it. They're backing into their 145 target based on the dividend yield versus a 10-year Treasury yield. They're saying that Walmart has raised their dividend every year since it initiated a payout in '74, and their indicated dividend yield is 1.6%. Based on that and comparing it to the 10-year Treasury yield of 0.6% or 60 basis points, they like that, and they back into that calculation, raising it to 145. They report earnings on August 18th, so you want to watch out for that. And if you're looking for a stop, you probably want to place it somewhere between 126 and 130. That would be this area in there. You can sign up for a test drive of Yahoo Finance Premium for 14 days for absolutely free at our website, yahoofinance.com. Miles?
All right, what a world. 1.6%, an attractive dividend yield. Jared Blickery, thanks for that. All right, let's turn our attention now to some surprising news today coming out of the Microsoft-owned professional social network, and that is LinkedIn. LinkedIn today announcing it'll lay off about 6% of its workforce. That's about 960 jobs, many of these coming from sales and talent acquisition. So essentially a suggestion there from LinkedIn that growth at the company and growth as they see it broadly is just not in the cards. Now, the company did say that this is likely, or that this is the only round of layoffs they were thinking about at all, targeting at all. But Melody Hom, a running theme here and a running concern has been that, the economy has done far better than expected over the last couple of months. Consumers are in much better shape than you would have expected. But we're only 4 months into this process, and it seems likely, and it's scary that there might be a lot more of these kinds of rolling white-collar layoffs yet to come.
And of course, Miles, not all white-collar jobs are created equal. As I understand it, positions in, of course, tech, healthcare, financial services, CPG, still up, right? Still being listed quite rapidly on LinkedIn. Of course, retailers, apparel stores, airlines, hotels, universities, basically desolate when you think about the hiring activity there and the kinds of opportunities. And just thinking about the landscape right now, you mentioned that it's 6% of the global workforce. LinkedIn right now makes up about 6% of Microsoft's overall revenue, was considered to still be a growth driver in addition to the cloud business at Microsoft proper. And I don't envy the task of this new CEO who took the helm just a couple months ago. I think his first day was June 1st after Jeff Weiner, the founder, actually stepped down, or Jeff Weiner, the original CEO, had stepped down. And just thinking about the kind of tasks that he was burdened with of trying to figure out, okay, clearly advertising budgets are slashed. Clearly, in a tight labor market, we were the place to go to really recruit people. But I think you had mentioned it in the intro that you were surprised. I think if you think about the nature of LinkedIn's business, it shouldn't be surprising, right? Just because even though maybe a lot of people in our peer set who are in white collar positions have not lost their jobs, we do know of pay cuts. We do know of maybe a couple month furloughs. We do know across the board, I have seen people continuing to try to apply to jobs. One of my friends actually applied to 20 jobs and hasn't actually heard back from a single one, even a rejection. So just thinking about this current climate, I do think that unfortunately, LinkedIn is almost a good representation of what the potential kind of content side of things in the tech space. It could be a real warning sign there.
Yeah, I didn't find this news surprising because it's a time when places are, if anything, cutting. You hope not. I mean, many places have avoided cuts for now, but you don't see as many places staffing up right now. And so there's a stat in here about white collar job listings down 36% compared to this time last year. Now, of course, I think it's really important we emphasize, I think you did say it, Miles, in the intro, but some of these jobs are in sales. So Melody mentioned that we're just seeing a pullback in advertising. So it's not all that, no companies are hiring and that's why LinkedIn had to lay people off. I mean, there's also sales because companies are not spending right now to advertise. I mean, I remember Uber had a big round of layoffs pretty early in the pandemic. And when you drilled down, I'm not sure if this was out there or not, but most of those people were in marketing or sales because not a time when you need to aggressively market. I mean, people are going to take an Uber ride right now if they're desperate, but you're not going to hook new customers by doing slick ads online on LinkedIn or on Facebook at this time on social media. So I'm not surprised that a lot of those jobs were in sales. They don't need as many people on that side of things. Now, what's interesting in terms of the white collar aspect, so many of the companies we cover and discuss have been relatively okay, right? Relatively unscathed. And every day we say, look, stocks are up. The market is behaving pretty well, even though we're in a pandemic. But what a lot of our guests will tell you, and maybe not some of the more idealistic bullish ones, but a lot of them will say, we're really not going to see the full financial impact thing for many months to come. I mean, some companies are going to be seeing ripple effects from the pandemic a year from now, 2 years from now. So it's just not surprising that a company like LinkedIn would have to make some cuts. I think that we have to remember that the way the stock market is behaving is separate from how many kind of death by 1,000 cuts, so to speak. We're going to see those stories about big companies, whether it's tech or other industries, even if the economy improves relatively quickly.
And just trying to analyze a bit more what we mean by tech, right? Because we've spoken in such broad terms, but within a company like LinkedIn, also in that memo to all employees, Roslansky said that he's moving the two separate media businesses, which is the learning management system and the talent solutions business, into a single entity. So there is redundancy as is, right? So when the economy's flush, when there is that opportunity to have people in dual roles. And to be honest, I think everyone on this call can kind of identify with that feeling. If anyone who works on B2B projects, anyone who works with the sales team, you kind of wonder, okay, this feels like a redundant role. This feels as though I've talked to 3 different people who seem to be doing the same thing. Maybe this is a sign of what's to come. I'm not jumping to AI, right? But I am trying to understand what this does mean for those product manager roles, for those sales strategists, and a lot of those quote unquote hot positions that really heavily relied on commission. And in reality, a lot of them kind of were duplicate jobs. So not to shade some of our peer group and our cohort, but I do feel as though those are the jobs on the line right now.
Well, I mean, I think, yeah, maybe that's my focus on this, kind of theme, Melody, is my own anxieties around, I mean, Shauna does a fine job, so it's sort of like, why do you need 2 of us? But I mean, in seriousness, I think that, to Dan's earliest point, oh, well, every company wants to trim some fat. Microsoft worth $1.5 trillion. Like, I mean, I know every company has a little bit of excess, but in this time to see a company with a market cap nearly $2 trillion for them to say, oh, we need to pare a little bit. You wonder, what does it look like at a media business? What does it look like, at some of these other, at an airline, forget about it, right? So I think everyone's guard is just up at this time because it feels like maybe things shouldn't have been so smooth, right? It feels like summer vacation, like, oh, we're just working at home for now. It's going to be fine. And I don't know. It just doesn't sit right with me that that's kind of how we'll remember this time. Maybe it works out, but it does seem quite precarious and a little bit more precarious perhaps than data, at least in our sector of the economy, has so far suggested. All right, coming up on the other side of this break, our next guest says big tech stocks soaring while everyone else just meandering. George Ball of SMH Group will tell us what he thinks about this bipolar market coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Again, mixed market here. The Nasdaq in the red, the Dow and the S&P in green figures, with about 15 minutes to go in today's trading session. For a little bit more on everything going on in the markets right now, we're joined by George Ball, the CEO of SMH Group. And George, thanks so much for joining the program. Let's just start with the market right here. And you write a very interesting commentary here saying the market's torn between good vaccine news and a V shape that has no legs. And so in that statement, it's interesting. Sounds like you're admitting there's been kind of a V-shaped recovery in some of the data, but it certainly would sound like to you it feels a little bit hollow to this point.
Well, hollow is probably a very apt word. I might say bipolar as well as hollow. Right now, you've got a division between what traders are doing, where they're prospering, and what investors really aren't doing, and their semi-paralysis at this juncture. The market is trading on coronavirus news, vaccines, and cures, day to day, minute to minute. Then if people step back and look at the economy broadly and whether it's recovering or not, I don't think that there are many people who are confident that we are truly in a V-shaped recovery. There's been a improvement from the bottom, which you would expect because of stimulus, but how lasting is it? I don't think people are confident of that, nor should they be at this point.
George, Dan Roberts here. In your notes to us for the show today, you mentioned Robinhood and the sort of effect we've seen from that app, which obviously a lot of the retail traders on there are just young people who maybe don't understand the market as much. We saw a real strange phenomenon with Hertz stock that a lot of people placed on Robinhood. But you discussed the phenomenon we're seeing from that app and maybe from other apps and called the general take of overcrediting that affects blithering. I wonder if you could talk to us a bit more about how you think it sounds like you think people have misinterpreted the influence that those kinds of traders have had on the recent gains.
I think there's something that's really been unspoken, but is very real. If you talk to traders, retail volume is normally plus or minus 10% of total volume, not a big part of it. With the Robinhood effect, with people being at home, with some individuals talking about making a lot of money, trading Robinhood, just trading stocks, what's happening is there's a disconnect between fundamental stock prices, what the Robinhooders are doing, and most importantly, what the algorithmic traders are doing. The algorithmic traders don't care about fundamentals. They don't care about earnings. They care about being one step in front of the rest of the crowd. The Robinhood traders, I don't think, are terribly connected to earnings, stock prices, that sort of thing. And so they're buying a very limited number of stocks, the FANGs plus Microsoft and a small group of other things. The algorithmic traders, who are probably 50% of the for-profit traders in the world, are trying to get and successfully getting in front of the retail traders. Neither group cares terribly about earnings, price earnings, multiples, growth, and that sort of thing. And so a small group of stocks are going up really exponentially rapidly, but disconnected from fundamentals. I don't think that'll last for very long. It usually ends badly.
And so then thinking about that environment, George, what do you like here? What have you done? What have you felt compelled to do? What's looked attractive? Because it is quite confounding. NASDAQ's at a record high. S&P's almost back there. We all know the leadership groups. Where have you been looking these days?
Well, two things. First, remember the truism, almost all traders die poor. There have been books written about that, and most traders die poor. They can make money for a while, but then they get swallowed into an abyss that can be called a bubble or what have you. More constructively, I think that investors can look to the markets for today's special situations, for hedges against their normal portfolio equity balances, and for some small number of stocks that are just so damn cheap that you don't care which direction the market goes, they're going to go up. And so is it a stock picker's market? It's probably a market where you want to stay away from what's popular and go toward what is today unpopular, which is apt to make money for you tomorrow.
And then just quickly, George, before we let you go, if we came into 2020 in January, we all would have agreed that the election was the biggest event coming up this year. Now, the pandemic certainly usurped that for most of the year, but we are about 3 months away from the election. As you think about that event, are you starting to maybe change up some positions ahead of that? How important do you think it will be? And will it indeed kind of capture investor attention the way that a presidential election typically does?
It has not up to now, as you're implying. The pandemic story, the layoffs in the economy, just uncertainty has swamped what's happening next in the political markets. And so let me make a non-political statement, which is that all of earnings are after tax. A Democratic presidency is apt to lead to taxation that's, depending on who you listen to, 20 to 30% higher tax rates than exist today. And all things being equal, that isn't good for the market. I'm not arguing for Trump, I'm not arguing for Biden, but I'm simply saying that after-tax earnings are quite apt to be lower at the end of the year than now. But that's not good for equity prices on balance.
All right, George Ball, Chairman and CEO of the SMH Group. George, thanks so much for joining the program. Have a great summer. Hopefully we can talk soon.
Enjoyed it. Thanks. Bye-bye.
All right, coming up on the other side of this break, watching the market losing steam here. S&P briefly turning into red figures. We're back with a check on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Let's take a look at this market that has lost quite a bit of steam here within the last hour. The S&P 500 right now is up just 1 point, less than 1/10 of 1%. The Nasdaq at session lows off more than 0.9%. The Dow also losing steam here, as we mentioned. Some concern and some commentary, I shouldn't say concern, commentary from Mitch McConnell about there likely not being a fiscal stimulus bill due by the end of next week, or ready by the end of next week. Now, of course, at this stage in the negotiations, there will be a lot of headlines, but the market certainly reacting in a negative way to what we heard there. Tech stocks again under pressure after such a big outperformance yesterday. All of the major FANG names are in the red right now as we head towards the closing bell. All right, coming up here in just 2 minutes, we're going to have the bell live from the floor of the New York Stock Exchange. We are back with that right after this.
Welcome back to the final round here on Yahoo Finance. I'm Shauna Smith. We're less than a minute here from the closing bell, and stocks losing a bit of steam here into the close. The S&P briefly dipping into negative territory, back though to the upside, up just around 0.1%. The Dow holding on to gains, up 145 points today, so off the highs of the day. The Nasdaq though was the story. It was weak all day today. That wraps up the trading day today. Again, the Dow and S&P looks like they're holding on to gains, closing in positive territory. The Nasdaq, though, off almost 1%, off just around 0.8%. Weakness in the tech sector, that was the big story today. We had the Nasdaq hitting a record high before falling into negative territory. Investors look like they're taking some profits from some of those big tech names and adding to value names. We saw some value names leading the way today. Technology looks like it's the worst performing sector and one of the only sectors in the red today. Facebook, Amazon, Apple among the losers. And I want to point out, we talked about this in the last hour, but the weakness in tech, it's muting some of the broader gains that we're seeing in the market. Remember that technology tech stocks make up just around 27% of the S&P's market cap. So weakness there today is capping some of the gains that we're seeing specifically in the S&P, with S&P just up around 0.2%. The standout today, though, on the flip side, was energy. The Dow outperformed Chevron and Exxon by a wide margin. I want to bring in my co-host for the next hour, Miles Udlin, along with Yahoo Finance's Rick Newman. And Miles, I mean, talking about today's action, it was interesting taking a look at the trading heading into the close. We seem to lose a little bit of steam with the S&P briefly dipping into positive or negative territory, closing above the flat line, but the gains relatively muted today.
Yeah, we did have those negative headlines, as we talked about during the last hour, coming out of Washington, D.C. But I think ultimately the story of the day doesn't change a whole lot, even though we did weaken up a bit at the close, which is, again, that move back into, and I think, again, energy, the big leader here, but energy is not going to be leading any major market rally for any period of time higher. So let's look at financials and industrials, both up better than 1% among S&P sectors. And I think that's the story is we continue to see leadership. We saw it trading off on a weekly basis. We're kind of now down to a daily basis almost. And so it'll be interesting to see how long this trend does stay in place. The VIX yesterday, we didn't even hit on it yesterday. VIX got crushed during yesterday's session. Today perking up just a bit, but not up more than 1 point, and still trading or still sitting right around 25. And we've looked at, the VIX under 30 as a real potential positive for the market. So again, I think overall, the idea of a more constructive market that continues to see different pickups in leadership remains again a positive for those who want to be bullish this market. There's clearly a consensus view that something like a deal will be reached down in DC. And so I think, we kind of, again, saw that weakness in today's tape, but I don't really feel like that changes, just that 1 hour trading changes the overall setup that we're looking at here.
Yeah, it is interesting. And of course, we've seen these headlines like that move the markets before. So I think it was maybe just a reaction here to the headlines that we did get rather than really the start of a bigger, broader move here in the markets. But Jared, I want to get your thought, though, on some of the rotation that we did see today, because I think it is worth pointing out some of the strength that we saw. Miles mentioned energy obviously can't lead the markets higher from here, but then more specifically talking about financials and industrials and some of the cyclical trade, I guess that's becoming a little bit more favorable, at least at this point.
Yeah, I think it's natural that we're going to see a certain amount of rotation. The question is it going to kind of flip day by day, maybe week by week, or is it going to be something more sustained like we saw in mid-May to early June, where we had the cyclical and value stocks just really tear to the upside and really leave FANG in the dust? Hard to say which is going to happen, but if we continue to rally, we're going to see more stocks dragged up. And what happens is investors and traders, they look for stocks that are cheap because, well, especially this is kind of the Robin Hood mentality. They want to buy something cheap because they believe it has the ability to appreciate faster, and over the short term it can. And so that's driving a lot of this FOMO, is that they don't want to be in the big names that have already advanced so far. But just looking at the day's price action, not going to read too much into it. Dow still up 159 points here. I take a look at the longer term charts over the last 2 months, just kind of testing this area in here. Reminds me of where the S&P 500 was just a couple of weeks ago. It had that same island reversal pattern, and it was finally able to come through it, and could see a similar situation with the Dow. And even if the FANGs do outperform on a day-to-day basis, probably going to be the underperformers on a net basis if the indices continue to grind higher here. One thing I would watch out for is a potential double top here. Way too early to tell, but if we come back down and break this neckline, that would be something to consider as maybe the precursor to a more prolonged sell-off. Here's a 10-year T-note yield still hanging out by 60 basis points. Kind of have a quasi floor right there, and it's just been consolidating, waiting for a break. Could still go either way, and the net direction over the last year, or year to date, has been down. And so a lot of times these things do resolve to the downside, which could be trouble for equities, especially those value and cyclical plays. Just looking at the Nasdaq 100 heat map, lots of red to the left in the Nasdaq. Biotech also underperforming today. Tesla down 4.5%. That's kind of a standout. But a different picture in the Dow, where we have mostly green outside of those two tech names, Apple and Microsoft. Just a final look at the sectors here. Energy, the big standout. No, it's probably not going to lead the way higher unless we return to the 1980s. Not going to happen. But we haven't heard the last of tech or those FANG names. They're going to outperform again one day soon, just a matter of when.
I know it's impossible to bet against them because every time I feel like we talk about maybe they're falling out of favor, they come back and they're leading the way once again. Well, for more on the market action that we've been seeing, not only today, but over the last several weeks, I want to bring in Brian Nick. He's Chief Investment Strategist at Nuveen. And Brian, let's just start with one of the first lines that you sent over in your note. And you wrote that equity markets are taking a glass half full view of the dual healthcare and the economic crisis right now in the U.S. So with that in mind, I guess my question to you is, do you think the rising number of cases that maybe it hasn't been priced in, and then therefore what's the downside risk to the market right now?
First of all, thanks for having me. I think that you are seeing the market sort of price in over the last couple of weeks that spike that we've seen in new cases. We've only seen the fatalities, which are the lagging indicator, but I think the more important indicator, obviously, move up a little bit relative to the spike in new cases. But during this time period, when things have reversed from things getting better to things no longer getting better, apparently, you did see a more narrow leadership of the market. You did see more of those FANG names. When growth seems like it's going to be scarce because the economy may be closing back down, I think those names are going to tend to lead the rest of the market. On a day like today, when really stimulus is the thing that people are talking about, whether it's what's going on in DC, what happened in the Eurozone with the extra $900 billion that they added to their budget for stimulus, or some of the good news we've been getting trickling out about potential vaccines, which I actually consider a form of stimulus as far as the market is concerned. What could bring us back to normal the quickest, whether it's economic stimulus or a healthcare related stimulus? Those tend to be the days when you see cyclicals and value outperform. So it is a little bit day to day, as you were just talking about, but we still think being in these kind of more somewhat defensive, but also growthier names is probably going to be the place to be for the next couple of months, at least, as we get through what we think is going to be a more difficult period for economic data, because those new caseloads do tend to lead the resulting economic data. We're already seeing high frequency data suggesting that small businesses are closing again. Not as many people are working. Foot traffic in stores is not what it was in the middle of June. So I think we're just anticipating the data is not going to be as good, and there's going to be more reasons for investors to feel defensive once again.
Yeah, so then Brian, going off of that, if maybe the data won't be as good, we've been talking about that, kind of the early indication that we're getting out of the data that for the current month, for the month of July, we're seeing a little bit of a slowdown. So then what are your thoughts just in terms of the pace of the recovery? I guess, what do you think it's going to look like? We've talked about, it sounds like the V-shaped is out of the question at this point. Will it be a W? Will it be some sort of other shape or letter that we could see play out?
I think we've definitely seen a V-shaped bottom. So the recovery in May and June for things like retail sales was almost as sharp, if not as sharp, as the downturn in March and April. So I think that if you're just looking where we stand today, it does look V-shaped, but we think that V is going to start to flatten out. I don't think it turns into a W unless we really do get a complete resumption of the caseloads and the fatalities and the lockdowns that we saw in the spring. It doesn't seem like that's particularly likely. So what we are going to see is a flattening trajectory of economic growth. If you could track this month by month, May would have been the strongest month, June not far behind, and July, to me, is a pretty big question mark. We've already seen consumer confidence come back down, especially the leading indicators within the consumer confidence readings, and that high frequency data that we're increasingly looking at, whether it's restaurant reservations or consumer mobility, that started to flatten out as well. So overall economic activity is already flattening out at the start of the third quarter. We'll still get a big positive Q3 GDP boost because the first part of the second quarter was so bad. So relative quarter over quarter, it's going to be a strong growth number, but it's not going to be, I don't think, 25 or 30% or wherever or changing the sign on whatever the second quarter negative number is going to be.
Hey, Brian, Rick Newman here. It sounds like you're describing the square root recovery. That's been my favorite shape. So it's down, up a little, and then out. But I'm not going to ask you about recovery shapes. I want to ask you about what is overvalued right now, and how does that sort itself out?
We are certainly concerned about some of the names in tech, especially the recent outperformers, whether it's the higher momentum or the higher growth names. So we have to be a little bit more discerning when we're looking at valuation. And I think that's where you would see it would be in tech, given that it's been such a strong leader this year. That doesn't necessarily mean that we're due for a big pullback, though. If you look at tech just as a sector compared to other asset classes, let's just say the Nasdaq compared to the treasury market or the corporate bond market. The question is, where are investors going to go? If the rest of the equity market doesn't look as attractive because the cycle is not picking up as much steam, and these financials and these industrials names and even energy names are not going to be able to sustain leadership, where else are you going as an investor? You're going to corporate bonds that are yielding somewhere around 1 or 2%, treasuries yielding 0.6%, cash giving you close to zero. So it's possible, I think likely, that even the quote unquote overvalued parts of the market can continue to lead, or at least provide a decent rate of return, probably somewhere in the mid-single digits over the next year, even if growth doesn't quite meet expectations.
Yeah, Brian, does tech's market dominance, the narrowness that we're seeing just in terms of leadership, does this worry you at all, just in terms of the fact that we were talking about it last hour, 27% of the S&P's market cap is made up by these tech names. Is this something that you think signals at least some concern?
when you're talking about the sector weighting for the entire index, I mean, there's individual companies in there that have obviously grown quite large as a percentage of the overall index. But you look at what they're earning, and whether it's top line or bottom line, they're out earning the rest of the S&P 500. So they're not, they have become this year more expensive compared to the overall index. But that wasn't necessarily the story for the 5 or 6 years prior when they were still dominating. So it's been through a number of different types of market environments, some quite good and some quite difficult as we've gone through this year, that those names have been able to lead. So if one sector gets to be too large, does it present some kind of systemic risk? Potentially, but we're still looking at companies that are innovating, companies that are able to earn revenues and also cut costs to provide good quarter-over-quarter earnings growth, which not every sector, not every company is going to be able to do. So it's understandable why that's become a favorite in the markets, especially in this year where we had so many different signals and so much whipsawing going on.
All right, Brian Nick, Chief Investment Strategist at Nuveen. Thanks so much for taking the time to join us today.
Thanks for having me.
I want to get to some breaking news here after the bell. Snap is out with earnings. Taking a look at shares, we're taking a deep dive here, off just around 11%. Miles has the numbers for us. Miles.
Yeah, Sean, a stock off sharply, as you mentioned, and it really all comes down to the active user number here. Daily active users for Snap in its most recent quarter, 238 million. The street was looking for 239.1 million. Now on the financial side of things, company beat on the top and the bottom lines, reporting a narrower than expected quarterly loss, 9 cents per share against 10 cents expected. Revenue coming in better than forecast, $454.2 million against 441.6 that the street was looking for. But again, that's slower than expected daily active user growth, really pressuring the stock. Now this stock has had quite a run up over the last, I'd say, year or so, let's call it 6 months or so, and especially from its pandemic lows, right around $8 a share. Stock had closed today's regular trading session just under 25. So tripling from the low, under a bit of pressure here. Now, just going through a couple of numbers that they call out on that active users front. And again, the top line there with the total number, 238 million, disappointing. But they saw sequential increases year over year, sequential and year-over-year increases, I should say, in all of their geographic areas. They also saw it on both iOS and Android platforms. Also, Snapchatter's opening the app over 30 times per day in the second quarter of the year. And here's one for the team here on the final round. Daily average number of Snapchatters over the age of 35 engaging with Discover content increased 40% year over year in the second quarter. Sean.
40, you said? 40? 40?
40%. 40%.
Wow. Well, then that proves our theory wrong, because earlier in our morning meeting, we were talking about how we don't really know anyone that's older that uses Snapchat. But clearly, people are coming to the app.
Unclear what the baseline is there, but they definitely, you can see where it's going for them longer term. They want to emphasize that it's not only teens, even though it's mostly teens that are, of course, their core user.
Yeah, I mean, I think that's important for the company because that's been one of the biggest points here of the critics. But it's also going to be interesting, I guess, just to see how Twitter and Facebook trade off of this, because I think just more broadly speaking, the question mark here going into Snap's earnings is whether or not it's going to offer some clues about how those two social media giants will fare, especially as we talk about the fact that we did see so many companies cut back their digital advertising spending, how that could be a negative impact here in the midst of the coronavirus pandemic. So certainly that will be interesting just to keep a close eye on Facebook and on Twitter. All right, well, up next, one Wall Street firm giving Tesla, another high flyer, a surprise downgrade ahead of its quarterly report. The shares off just around 4% today. We're going to talk to the analyst behind the call. That's straight ahead. Welcome back to the final round. It is a big week for Tesla. The company is set to report earnings after the bell tomorrow. It's a stock that's recorded massive gains so far this year, up just around 280%. Shares, though, moving lower today, closing off more than 4% on the heels of a downgrade from a JMP. So for more on that call, we want to bring in Joe Osha. He's with the JMP Securities. And Joe, you downgraded the stock to market perform today. It surpassed your recent price target of $1,500 a share. I guess the question to you is, one, is this, it looks like that it's a valuation call, and then therefore, do you think Tesla has run too far, too fast at this point?
Thanks for having me on. And yes, it is a valuation call in the end. I think that the business can continue to do well. In fact, we said it can be a $100 billion company, but everything has a price. And when I sat down and I looked at the stock and I said, can I, in good faith, go out and continue to recommend that people buy it here? I just, we're required as equity analysts to have a reasonable basis for our recommendations. And I just couldn't get there.
So then, Joe, going off of that, what is priced into Tesla's stock at this point? Is an earnings beat priced in there? And then if it is a second quarter profit seen as key really to maintaining this rally that we've seen in the share price?
I think second quarter beat is priced in, but I want to emphasize this is not about the quarter per se. I went out in front of the quarter because I want people to be familiar with what my thinking is. But actually, as I'd indicated in my note, I think that they can beat consensus expectations. It's really much more about the longer term future that's being impounded in this kind of valuation. So maybe if they beat, the stock goes up a bit. But the basic question is, with a $300 billion market cap, how much more money can you make over the course of the next several months, regardless of what happens tomorrow?
Hey, Joe, Rick Newman here. I've asked some Tesla bulls on our air, look, this company is now valued more highly than Toyota and any other mainstream automaker, and it has 1% market share or less. How do you square that? And you're saying you don't see it at 300 billion, you see it at 100 billion. That's a third where it is today. So how do you put together Tesla's relative dominance or lack of dominance in the marketplace with its market value?
Well, I do want to be clear. The $100 billion I referred to as revenue target in 2025. My stance on the stock is neutral, so I'm not saying the market cap's going to get cut by 2/3. And to some extent, people are fond of saying, hey, Tesla should be valued like a car company. But guess what? Most car companies don't grow. Tesla does, right? So I think it is reasonable to try and take that into account when you think about how the company can grow. But what I had said is, let's imagine Tesla becomes wildly successful. Let's imagine that by 2025, they're 5 times the size as they are now, earning a 20% EBITDA margin, which is pretty darn good for a car company. It's still unclear to me, even if the company is that successful, how you make a lot of money from here, right? So I think that's the important point. I'm not saying that they're not going to be successful. I'm saying that any reasonable valuation exercise makes it difficult to continue to recommend the stock.
If Tesla were 5 times the size it is now, it would still have only 5% market share compared with 15% for General Motors. It would have to be taking pickup truck and SUV share away from all the other automakers at a big pace. Do you even think that's possible?
Hey, maybe they can continue to take some share, but I'll give you an example, right? Let us imagine it's 2025 and Tesla is 5 times as big as it is now. And let's imagine that they are as dominant and as loved as Apple is now. Apple trades for 4 times revenue. If Tesla trades for 4 times revenue, that's $400 billion. Okay, the stock's $300 billion now. So the point I'm making is that even in that success scenario, we seem to have impounded an awful lot of that in the stock, right now today. And I think Apple's an interesting comparison.
And Joe, forgive me if we discussed this when you were on a couple of weeks ago, but when you think about Tesla, and I guess any of the names that you're covering in this market, how are you trying to tease out how much of the market's momentum has been embedded in some of those stock price rises versus outlooks for the company? We talked to an Apple analyst a couple of weeks ago who said, I'm really bullish on the stock, but I think 2/3 of the move has just been the market itself. How do you kind of think about that calculation?
Honestly, I don't to some extent, because I think as a fundamental equity analyst, first and foremost, I'm expected to really think about the businesses and how stocks are valued, right? And that's that's going to cause me to be wrong sometimes. And maybe I'll be wrong here short term. But I think it's very important for people sitting in my seat, again, to return to the earlier language, to have a reasonable basis for saying, what I say. And that does not mean I'm recommending the stock just because it's going up. I'm recommending the stock because I can make a coherent case for why it should be valued more highly than it is. And the reason I downgraded it, this morning is because I can't get there anymore. So I admit, I kind of try and make my job simpler. I don't think a lot about momentum, to be honest.
I just want to get your thoughts on a report that we just got from Electrek, and they were talking about that there's a Chinese dealer saying that Tesla sold its Model 3s as part of a group buy discount. So the theory here, I guess what some shorts are saying, is that they're saying that Tesla did this in order to, they sold it to the resellers in China in order to improve their delivery results in the last quarter. I'm just curious just to get your take on that, because Tesla is denying it, and Tesla has been very outspoken that they don't want to participate in this type of behavior. But do you think it's at all possible?
It's possible. I'm not sure that it's, that's super significant one way or the other. I think it is going to be the case over time in China with Tesla that they're going to encounter well-financed, sophisticated domestic competition. In buses, for example, BYD has been enormously successful globally. So I think, to think that China, that Tesla's going to take over the Chinese EV market is naive. I don't have a comment one way or the other on that report, though, to be honest.
All right, Joe Osha of JMP Securities, always great to have you on the program. Thanks so much for taking the time to join us today.
Thanks.
We're going to take a quick break here on the final round, but when we come back, President Trump is set to resume his coronavirus press briefings in less than an hour, just around 45 or 35 minutes from now. What should we expect to hear from the president? Well, more on that straight ahead. Welcome back to the final round here on Yahoo Finance. Let's get to the latest on the coronavirus pandemic. And for that, we have Anjali Kamlani. And Anjali, I mean, the headline that stands out to me today, there was a couple of headlines that are pretty big relating to the pandemic, but the CDC basically saying that cases could be anywhere between 2 to 13 times higher than reported in parts of the US. Talk to us just about the significance of this and why it matters.
Right, Shauna. So that's significant because they're actually able to put an actual valuation on what the estimates could be. And until date, there's been discussions among health experts about the fact that the numbers aren't in fact accurate and are probably undercounted, especially when you consider how many people weren't tested when they did have the virus, or were turned away, or saw turnaround times, or could have had false negatives. And so all of that pulled together definitely paints a picture. And this also actually bleeds into the conversation around deaths and that counting, because there are so many situations, especially early on in the pandemic, when we were talking about individuals who died, who were not counted because they were not in a hospital or not in a nursing home, and therefore outside the radar of the CDC. So it's very significant that they're putting that range of values on it right now.
All right, Anj, thanks so much for that update. In just about 30 minutes from now, we're going to hear from President Trump. He's going to resume giving his coronavirus briefings. And just in terms of what we should expect, I want to bring in Rick Newman. And Rick, I mean, I'm assuming that President Trump is doing this. He's going to try to put a positive spin on this. He has been criticized with how he and the rest of the administration has handled the outbreak so far. What do you think we should expect to hear in just around 30 minutes?
Well, the show is back on. This is not a one-time briefing. He supposedly is going to do this either daily or near daily. And apparently the idea is Trump thinks that he's lost the narrative on the coronavirus. I mean, honestly, the virus determines the narrative, honestly, and it's not Trump. But he's obviously been getting a lot of bad press. It has been contributing to his decline in the polls. Just his overall approval rating, his approval on handling the virus is deeply negative now. And of course, he's way behind Joe Biden, if you believe the polls. So I guess what Trump is going to do is he's going to come out and try to, dance a happy dance and tell us the good news about coronavirus, which I suppose is that we're making progress toward a vaccine. But this is not likely to go smoothly because no Trump events like this go smoothly. These are supposedly going to be press conferences where he's going to take questions from reporters. That means it's going to get very testy. The reporters are going to say, why don't you support more testing? Why are you trying to kill funding for testing? Why aren't you doing more to get help to the states in the South that need it? There'll probably be questions about the federal police troops in Portland, Oregon, and Chicago. It's going to go off script. And of course, Trump just follows all these things off script and sometimes leads it off script. It's not even clear if the medical experts, Dr. Birx and Dr. Fauci, and some of the people from HHS will be there. So as usual, it will probably be interesting theater. I'm just not sure it's going to accomplish what Trump wants it to.
Well, and Rick, you mentioned the fact that he's falling in the polls. So I guess how much of that do you think has to do, or the fact that he's doing this has to do with his approval ratings dropping? Do you think he's being forced to become a little bit more vocal about the subject?
I don't know if it's become more vocal about it because, look, Trump does not have a problem getting publicity. I mean, honestly, I think it's a desperation act. Based on what we know about Trump, this is going to be a lot of spin. I mean, he essentially cannot speak for 30 minutes without saying something untrue or misleading. So I think we're going to get a lot of these fact-checking, monologues we're familiar with. What did Trump say? What's the actual truth, and so forth. Has he? The question is, can he do something to kind of regain the confidence of voters with the coronavirus going as badly as it is? I mean, just to put this in context, we have hit record highs for new daily infections for 40 or 41 days in a row. I think only in the most recent day or two have we ticked down from that high, but we're losing. We're losing the battle against the coronavirus because, there's this explosion of infections and cases. So I'm not sure there's anything Trump can say that can actually change people's minds when they know in their communities in Florida. I mean, it's getting into nursing homes in Florida now and in Arizona. So people know what's going on around them. And I don't think Trump is going to change their opinion of what's happening, but who knows?
Yeah, well, we will certainly give it a go. But again, President Trump resuming his coronavirus briefings from the White House in less than 30 minutes from now. Right, Rick? Thank you. We're going to take a quick break, but when we come back, United is out with earnings. The stock moving slightly higher here after hours. We're going to have the numbers for you, plus how one Victoria's Secret supermodel is pushing for racial equality and diversity in the fashion world. We're back with that in just 2 minutes. Welcome back to the final round. United releasing results just a few minutes ago. The stock moving higher here after hours. Jared has the numbers for us. Jared.
The stock's up nearly 2% now. It has been whipsawing a little bit, had been down, now up. But revenue was a beat, but still down 87% year over year. Not a big surprise, but it came in at 1.48 billion. Street was looking for 1.27 billion. The loss per share, worse than expected, $9.31 versus estimates of $9.18. Just truly staggering numbers. But passenger revenue was a beat, coming in at 681 million. Estimate was for 530 million. And then cargo revenue was a nice surprise too, 402 million versus estimates of only 188 million. Kind of a new line there post-COVID, excuse me. And they're saying that they increased the second quarter cargo revenue by 36% by serving strategic international cargo-only missions and optimizing aircraft capacity. Also, more than 6,000 employees have taken voluntary separation. That is allowed them to cut their costs by 69% versus the second quarter in 2019. And also, since the start of the crisis, they have raised $16.1 billion through debt offerings, stock issuances, and through the CARES Act payroll support, which I believe ends in August unless it's extended. And then just one more fact, their second quarter cash burn was 40 million per day, but they see going forward, at least in the third quarter, the current one, that it's only going to be 25 million per day. Shauna?
All right, Jared, thanks so much for that. Obviously, airlines here are in focus amid the coronavirus pandemic. We, of course, will keep a close eye on the other airlines as well. All right, we want to switch gears here a little bit on the final round and talk about a very important subject, racial equality. Supermodel Joan Small is calling on the fashion industry to make some changes and says that it's time that it recognized racial injustice and systemic racism. And for more on that, I want to bring in Joan Small, supermodel and founder of DonateMyWage.org, along with Yahoo Finance's Reggie Wade. And Joan, you called out the fashion industry was extremely interesting, and I think it's a must read almost for everybody out there, because you were accusing them of largely staying silent on the issue. Talk to us about your frustration that you have with the fashion business and then the changes that you would like to see implemented.
Yeah, so, you know, to begin with, you know, just like everyone, I feel like during the pandemic, it awakened an activist in all of us. So just seeing an industry that I love so much and be silent in a time that is so important for all of us, and me being in it, I felt like they had to step up and voice out that they were supportive in this fight as well. So Donate My Wage came out of a place of frustration because I felt like I had to take also responsibility in where I can do more. I wanted to take action. And in order to do that, I just had to step up and lead by example.
So talk to us about what exactly Donate My Wage is, because it's a very important step that you are taking. You're obviously leading by example, and then also what the reception has been like to Donate My Wage, if you're able to get some other fashion brands or other supermodels like yourself on board with what you're doing.
So basically DonateMyWage.org is an online platform where you can donate, and it basically calculates your yearly income, and you can donate by the hour, the day, the week, or any given amount that you want. But it came out of where I wanted to donate my wage, and I felt like it had to be impactful, it had to mean something, and I decided to donate it. 50% of my remaining salary from till 2020, December 2020. And the outreach has been incredible. I've been overwhelmed with positive feedback from people within the industry, designers, stylists. My agency, IMG, donated $250,000 to support Black Lives Matter movement. So the reception has been incredible, and I feel like it's a case-by-case basis every time I work with a company that they are able to match my rate. So whatever I'm donating, I have a conversation with them. On top of booking me as, you know, the model, they can also participate.
Joan, Reggie Wade here. I know that you're a native Puerto Rican. I'd like to ask, how has the Black Lives movement been received on the island? I know they're going through a myriad of problems with the coronavirus and economic issues due to natural disasters, but how has it been received on the island?
To be honest, I don't think people are paying much attention to it, because I feel at times, you know, in the island, it's something that they deny, and they feel that it's not existent, which, you know, has always been a challenge for me, being a native Puerto Rican and being, you know, on a darker tone and what people consider to be Latin. And right now, I think they're just focusing on the pandemic and how to keep the numbers low and how to protect the people. So in that aspect, I don't think is as much as, you know, the support should be, and that's a bit unfortunate.
And Joe, going off of that, I mean, it's important just to still change here. The importance of making sure that this is not a moment that just passes, that we actually do see effective change come from this. So I guess going back to what you were saying before in terms of what the fashion industry's role can be and the role that you're playing, how do you think fashion brands can then be held accountable? I guess, does there need to be more transparency in the industry just in terms of employees and then also pay for minorities?
Correct. I think, you know, there's so many different facets to an industry, which is not only who are they hiring to front a campaign or to be in the magazines, is also in-house. So a lot of the times in these rooms, there's not a diverse group of people. So I think in order for there to be actual change, they need to have an internal cultural team or hire a more diverse staff. I feel like they need to put more effort into recruiting people that are of different backgrounds to expand within their company, and not just rely on just giving money. Like, that is great, and I feel like constant funding is what's going to create, you know, positive change and encourage others to do the same, but it has to start from inside as well. They should have mentorship programs within their companies, or also create internships where opportunities for the Black communities are more accessible within the industry, and just be more creative on how you can incorporate and talk about inclusivity within your company.
Joan, you've obviously taken a great step forward. What advice would you give to anyone who's looking to spark change like you have within their own industry and may be afraid to speak up?
I think this is the time to speak up, because everyone's ears and attention is put into this matter. So I feel like we're stronger in numbers, so people should definitely feel encouraged to speak up and know that they have a support system behind them, and do as much as you can to change. Like, you know, talk about it, create a system within your group so it feels organic, and make sure that I feel like people need to, it's a conversation a lot of people don't want to have, or they don't know where to go because, you know, they don't know the proper ways to do things. So I feel like a conversation is always, it's needed. Hello?
Shauna, you're muted.
I'm muted. See, it happens to everyone, even though the general is saying that this is such an important conversation to have. And that's why we thank you so much for taking the time to join us here on the final round and giving us your insight in exactly what the fashion industry can do to address this problem here of racial injustice. So thanks so much for joining us.
Thank you for having me.
All right, up next here on the final round, it's one of the fastest growing e-bike companies in the world. We're going to talk to the CEO of Van Moof about the company's recent boom in sales and why some are calling it the Tesla of e-bikes. We're back with that in just a minute. Welcome back to the final round here on Yahoo Finance. I want to bring in my next guest. We have Taco Carlier. He's the CEO of Van Moof, a fast-growing e-bike company. And Taco, some of the trends that we talk about here on Yahoo Finance that are taking place because of coronavirus. One business that has gotten a huge boost is the bike industry. And people can't seem to be able to get their hands on bikes fast enough. And you're dealing specifically with e-bikes. So I'm just curious to hear about what demand has been like and whether or not you have seen a huge spike in demand because of the pandemic.
Yeah, it's crazy. I think our company was already growing very fast in the past 5 years, doubling revenue year on year. But this year it's going much faster, and demand is much bigger than we can produce. So to give you an insight, this year alone, if you compare April to June, so Q2 to 2020, and you compare that with 2019, we're 380% in the plus right now in revenue. So it's a big change that's going on.
And Taco, you're saying that you're struggling to keep up with demand. So are you doing anything differently, or have you adjusted your business model at all just in order to try and keep up with that demand and increase your production?
No, we haven't changed anything. So we just the plan was already for 2020 to double the revenue. I think this year we're gonna triple it. So it's just ramping up production as crazy, trying to get some more investment in order to build more production capacity. So it's full hands-on here, and a lot of vacancies, a lot of hard work. There's it's a lot of work.
Hey, Taco, Rick Newman here. I live in the suburbs north of New York City. We had Lime bikes out here for a while, but they kind of went away, and there have been other bikes that have come. There tend to be some problems with them getting left in places where people don't want them. The same with scooters. So why should we believe this is not a fad and this is really going to draw more people into biking on a permanent basis?
So this is not about sharing. This is about commuting on bikes. I think what's going on is this. Like, I'm from Amsterdam in the Netherlands, and over here, almost 50% of all commutes are on a bike. And that's easy because Amsterdam is flat, it's pretty small, and the climate is very bike friendly. But in San Francisco, in New York, or Chicago, it's much harder to commute on a bike. But e-bikes change that. So they flatten hills, they shrink cities, and they prevent you from sweating. So therefore, it's from now on, it's also possible to commute on an e-bike. Thanks to e-bikes, it's now possible to commute in basically every city on a bike, so more and more people are discovering now that cycling is the most affordable, most fun, most healthy, and definitely the fastest way to get around town in modern cities.
What about winter? Can you put a heater on this bike?
It's no, that's still hard. But in Amsterdam we cycle all year long, so a good coat. And I have cycled a lot in New York, also in the winter. Chicago can be even a bit more. It can be even a bit tougher, but just wearing a big coat should be fine.
Well, and Taco, speaking of biking here in the States, our company's based in New York, and I think a lot of people in the city would like it to be a significantly more bike-friendly city. You're in Amsterdam, which is the most bike-friendly city probably in the world. What, in your view, are the things that cities need to do to ensure that it's safer to bike in the city and to get more people, using biking as a commuting method? Because riding down the streets of New York, as you know, you've been there, not the friendliest experience or safest experience. What are the kinds of steps that you think local leaders need to take to make cities more bikeable?
I think it all starts with the people. E-bikes will cause more people to ride bikes. So that's how it started in Amsterdam too, and many other European cities. It just starts with people getting on bikes and making the commutes on bikes, and then you see more and more bikes on the streets, and then governments have to react and build more. And that's the most important thing: separated bike lanes. So in Europe, there are a lot of bike lanes that have some kind of separation from the cars, from the roads, and that brings a lot in safety. So it starts with people, and then local governments react with building separate cycle lanes. But I don't agree. I think New York already is a great city to ride a bike. Of course, you shouldn't end up on Fifth Avenue, but you have the beautiful West Side Highway along the Hudson, and you have the most beautiful bike lane in the world, and that's the bike lane over Brooklyn Bridge. It's still I've cycled over in every city in the world, but that one is still my favorite.
Wow, that's a big endorsement for the city of New York. I know it is. It's definitely improving. I mean, I feel a little bit more comfortable biking, but I still get kind of nervous with all the traffic that we do have. But Taco, I want to go back to something you said before, and you said that you're not about sharing, you're about commuting on bikes. But I'm just curious, as you do expand and these cities become more friendly to bikers, could you potentially make any sort of deal with a city? I mean, we've seen how City Bike has really caught on in New York and how successful it has been, not only in New York, but really across cities around the world. Is this something that you could potentially be looking into?
Yeah, it could be. So I think bike sharing is great, and scooter sharing too, but it's mainly focused on tourists and visitors. Our bikes are for people that commute on a weekly or daily basis, and then owning a bike makes much more sense. So we don't need local governments. Yeah, hopefully they can build some more bike lanes, but we sell direct to consumers. 90% of our bikes are sold online, so we just sell bikes to consumers. What we do offer is to companies. So that's bicycle programs to companies. So companies can subscribe to VanMoof bicycles. The employees get a bike, and maintenance and insurance is included. We do offer that to a lot of more American companies, and it's very popular.
Yeah, it certainly is popular. Well, I mean, I started looking at your bikes. They look a lot of fun. I think I'm going to have to try one out sometime soon. But Taco Carlier, CEO of VanMoof, thanks so much for taking the time to join the show today.
Thanks a lot. Have a great day.
We're going to take a quick break here on the final round, but when we come back, we'll talk about today's market action and what we're looking at as we head into tomorrow's brand new trading day. We're back with that in just 2 minutes. Welcome back to the final round here on Yahoo Finance. Stocks closing mixed today with the Dow and S&P holding on to gains, with the Nasdaq closing in the red, off just around 0.8%. As we turn our focus to tomorrow ahead of the opening bell, we want to get our panelist, Rick Newman, his thoughts on what he's watching tomorrow. Rick, what do you have?
Well, the latest episode of the Yahoo Finance Electronomics podcast drops tomorrow, and it is always scintillating. I'm telling you, once you start watching, you can't stop. You'll be begging for more. I have a feeling also I might be covering whatever controversy Trump generates during his 5 p.m. press conference today.
Yeah, that certainly will be something to watch. Well, both are your podcast, then also coming up here in just 4 minutes from now, we're going to hear from President Trump the first time in a while on the coronavirus pandemic, I guess specifically during his briefing. But Miles, what do you have for us?
Wow, can't believe I've never been invited on these scintillating electronomics podcasts.
You're on, man. You're on.
So tomorrow we have big earnings day, Microsoft, Tesla, but we all know that I'm really invested in what's happening with Chipotle results. They'll be out at 4:10 tomorrow. Chipotle has been a huge winner during this pandemic period. Digital orders through the roof. Stock is at a record high. Brian Nichols had a tremendous run in the last 3 years since he's been the CEO there. So that'll be a result that we'll be watching in a busy after-hour session tomorrow.
And we're also going to be watching Snap tomorrow on the heels of its disappointing results on daily active users. We're seeing the reaction in that stock today, trading right now in after hours to the downside. And then, of course, taking a look at how that's impacting shares of Twitter, that stock under pressure, as well as Facebook. So it could be a look ahead here and what to expect from some of the other social media giants here this earnings season. We'll keep it right here on Yahoo Finance, our AMS Extra Special Road to Recovery that starts in just a few minutes from now at 5 p.m. Eastern Time. We're talking to some of the biggest names in business, including Brian Chesky, Airbnb CEO. We'll talk to U.S. Surgeon General Jerome Adams, and my interview with Mary Mack, Wells Fargo CEO of Consumer and Small Business Banking. You're not going to want to miss it.